All righty. All right, Neil. I think we are live.
Hello, everyone. Boot campers, are you there? Can you hear us? Let us know in chat if you see Luke and me.
I did see in chat that people are waiting. So we know that
Probably running late. Always some.
Hopefully we're
Hey,
good.
chat.
All
Always
right,
okay.
Neil, I think we are live.
Yeah, I think we're live. Good morning, JX Prez.
Hello,
Always
everyone.
some technical difficulty. Boot campers, are
Here,
you
let
there?
me mute myself.
Can you hear
here.
us? Let us know in. Guys, this is live television. Stuff always goes wrong. We need you to bear with us, okay? We're not perfect.
But
what I want to do is what?
You know what I want to do, Neil? I want to
Okay,
start.
let me go. Let me do a thing.
Joke. Can I start with the joke?
Okay. Okay. Yeah, Luke, tell him one of the jokes that you just Googled.
Okay. What do you call
Jokes
a
for
lazy
webinars.
crawfish? A lazy crawfish. A slobster.
I don't know.
That's pretty good.
Okay, so that will be the last joke of the day. Guys, welcome to the August Boot Camp. New and returning visitors, thank you so much for taking part in this day of education. I can't tell you how excited I am. Again, I am Neil Hamilton from Benzinga. Go ahead and follow me on Twitter. Just look at the bottom left of my little screen there, Neil's tweets. And with me, as always, my zany sidekick, Hot Stocks Luke Jacoby with the jokes. Hopefully the last one for the day. Luke, thanks for being with us.
Thanks, Neil, for introducing me as your zany sidekick, and I will say that the jokes will keep rolling throughout the day.
Okay. Excuse me. Okay, we have a lot in store for you today. What I want to do is set some expectations. All right. This is not the event where at the end you will be able to afford a Lamborghini. We're not here to promise you that you will own a menagerie of tigers and mountain lions and giraffes, what have you. This is not the Joe Exotic seminar. We're not going to get you there today. What we are going to do is make you feel confident and give you the skills to make you equipped to actually make money in the markets. That doesn't mean become a millionaire overnight. Anyone that's telling you that is full of it. But what it does do, I mean, if that was the case, every high school reunion that you go to, if it was that easy to get Lamborghinis and yachts from these courses, every high school reunion that you go to, everyone would be doing it. You'd be say, "Hey Rick, hey Sherry, what have you been up to for the past 10 years?" They'd say, "I've been trading. I've been doing Forex. I got really into crypto, and that's all I do now." But what this will do is this will make you that confident, quiet, maybe wearing a turtleneck with a gold chain around it. People ask you what you've been doing, and you could smugly smile and say, "The markets have been kind to me." And that's it. All right. And that's a better place to be. Let's admit it. So that's where we want to get you today. We got a lot in store for you. This is 80% education, but we do want to provide some entertainment. We want to make it as fun as possible. It is a long day with a lot of content. So we want to keep you awake, engaged, and loving what you're hearing. So not only do we have a lot in store for you with some of the best thinkers. We've got CNBC contributors, Matt Maley, who's your 100% your trend analyst, who's going to tell you what's going on with the market so you can orient yourself in this crazy storm of a market that we're in right now. Followed up by some fundamental and technical analysis from Nick Shaheen, who's our star options trader, and a whole slew of individual tactics. You can really just take these tactics and put them to work on Monday. Or today during the webinar. I'm not allowed to say webinar, actually during the boot camp, if you are able to do so.
And I'm going to cut in really quick, Neil. I'm going to say the thing that we're doing differently with this one is okay, we've got the full day where we're going to go from zero to hero is the idea. But we're not just leaving you at the end of the day. We're actually going to be kicking this out to an entire month. So today is where we're starting. But we're going to be following up with additional lessons every single week, right? We're going to have the opportunity to write in and ask questions. Hey, I learned this trend strategy. I learned to think about stocks like this. You know, what do you think of my thesis here and that sort of thing? So it's today. Today is the kickoff. Today is the action-packed day. I believe that we have the videos available for today, so that way you can continue to study them throughout the month, but we're going to be following up with subsequent webinars as well.
Yeah, so that Luke, you're actually touching on the most important part. So if you are a returning visitor, this is Bootcamp Evolved. I mean, it's kind of silly just to have a one-day boot camp, right? We're doing 3 weeks of ongoing education where you will be using our paper trading platform to test out your lessons, and then we'll have the opportunity to sign up for group mentorship sessions based on your experience in that paper trading competition. So 100%, yes, we want you to compete to get the prizes at the end of that paper trading competition, which include all kinds of Benzinga stuff, shirts, subscriptions to our products, all kinds of cool stuff. But at the end of the day, the best prize of all is figuring out what your problems are and then getting solutions to those problems so you can actually advance as a trader during this 3-week session. So if you haven't signed up for that portion of this bootcamp, make sure you do. It's going to really be much more bang for your buck. So something new that we're trying out, and hopefully it really brings you, hopefully you come out at the end a much more confident investor or trader. So we've done a lot of talking. One last thing that I want to do is I'm going to probably during the next presentation share with you guys a link. I want you guys to pitch to us your best stock. Give us your favorite stock. Tell us why. I want the story analysis. I want any pictures. If you've got charts that are interesting, mark them up. Draw your lines on them. We love technical analysis. We love lines on charts. Go ahead and submit those images, and we will select our favorite one for a prize raffle. Luke, real quick. But what I will say is, favorite doesn't necessarily mean the most performant stock. It's all about how good your pitch is. You can pitch us, I don't know, like L brands, and we will still love it if you sound like an analyst, a professional analyst in there. So really,
and if you don't sound like a professional analyst, make sure you take notes today. Today will get you to that point.
Exactly. But you've got all day to submit this. It will be available all day, and we're not going to select a winner until the very, very end of the show. So I'll get that link out to you. It will be available in chat here shortly. But without further ado,
another joke.
First speaker, where did you go? Oh, geez. Okay.
All right. How does NASA organize a party, Neil?
I don't know.
They plan it. It's pretty good. Come on.
Okay. All right. So moving on, we've got Matt Maley on the line. Matt, are you there? Can you hear me? Looks like you're muted. Just turn on.
Hey. You know, I even brought my son in here this morning. Make sure I got all my technology stuff all squared away. So I'm in great shape.
Okay, good. So your IT support rep is on site,
which I need.
Okay, wonderful to hear. So. Hey, we all need it sometimes. I'm sure there are going to be plenty of hiccups, but it's live television. That's just how it goes. Matt, today you're going to be talking about trading versus investing, which is actually a really broad topic. And I think you're the perfect person to talk about this. I was just wondering if you could tell folks a little bit about yourself and what you're going to teach them today.
Sure. Yeah, I've been on Wall Street for over 30 years. I started at Salomon Brothers, where I spent my first 15 years. Some young people may not know of Salomon Brothers, but back in the 70s, long before I was there, but in the 80s and 90s, it was by far the most important trading firm on Wall Street. Goldman Sachs was right there with us. They were a more important overall firm, but we were the top trading firm, and people like Merrill Lynch and Morgan Stanley hadn't really gotten up to that trading aspect of things. And I spent 15 years there working on the trading desk as a trader. And then I moved to Merrill Lynch, which is the biggest trading desk on Wall Street, where I spent almost a decade. And then I moved into what are now the the chief macro strategist for Miller Tabak. And one of the unique things that I think I bring to the table is we get all these people, and again, there's nothing wrong with what other strategists do, but most of them were analysts and never worked on a trading desk. And so they kind of tell you what should happen. And the thing is, having worked on for 25 years on two of the most important trading desks on Wall Street, we really felt, I really feel that I bring something to what is going to happen, or at least, I'm certainly not right all the time, but there's a big divergence between what should happen and what does happen. And I think that's kind of the key. So I want to try to talk to you about today is that difference between long-term investing and short-term trading. Now, and I think everybody should be involved in both. Now, that short-term trading can consist of swing trading, which people who are looking for, they can trade something over a couple of days or a couple of weeks. And then they have day traders, of course, who trade intraday every single day. But even those who are day traders, which really takes a lot of time, that just really has to be a full-time job if you want to be successful. But there's no question in my mind that if you do that, you still should do some swing trading and definitely do some long-term investing because they're all important part of your long-term goal. Of course, is to have a nice nest egg when you retire.
That's great. And I love you touched on something I was going to ask you right away. Are they mutually exclusive? And it seems that they are not, that they're complementary.
Absolutely. And it's you want to take and at least in my opinion, there's some people, they're day traders and that's all they do. But to me, there are some great, there's something to be said for having that kind of a base kind of investment that is long-term oriented. You kind of put it into the market or maybe it's on a monthly basis, quarterly basis, depending on how you want to do it. Maybe do that with your 401k, et cetera. And those are the things where you get, let's face it, on a long-term basis, the market goes up. Ever since the Federal Reserve was instituted in, I think it was 1913 or 1914, we've had they push for inflation. We do have deflationary periods, but as inflation goes up, the markets go up over a long-term basis. So you want to have a certain amount of money just tied into a long-term investments, kind of equal investments. Before the Federal Reserve in the 1800s, they had just as many deflationary years as they've had inflationary years. Since then, since the Federal Reserve came along, you had the 1930s and a little bit here and there when we had, of course, the financial crisis a decade ago. But for the most part, the markets do go higher. And of course, there's a lot of benefits to it as well, because you have the tax implications. Short-term capital gains are taxed at a higher rate than long-term ones. You have to hold something for over a year to get that long-term capital gains, which is down near 20%, where you have in the trading, it's anything less than a year, you're going to be taxed on whatever your regular income tax is for you individually. So there's a lot of benefits for that. And also, of course, there's a certain amount you just don't want to stress about. You take the emotions out of it. It's like, I've got a nice base. This is going to work nicely. I'm not going to worry about every single time the market has a hiccup. Just let it sit there. But the thing for me is that I don't want to keep droning on here too long, but the biggest thing is that for trading, when you do this swing trading and things, one thing that people don't understand, at least in my opinion, and a lot of people don't realize, is that the biggest profits, the way to really maximize your profits, is to be in there at key turning points in the marketplace, whether it be an individual stock, the overall market, different groups, and sometimes different asset classes of people thinking about gold and if they want to get into currencies and such. But there's also overseas markets, commodities, not just gold, and it can just, those is what Warren Buffett. They always say Warren Buffett doesn't time the market. Well, he actually does. He just does it in a very different way. He goes when the market's flat on his back, and he comes in when there's complete blood in the streets, and he buys when nobody else is willing to buy, and he steals these investments at unbelievably low levels. And at the same time, he makes some sales when things get ridiculously overvalued. And I think that's where swing trading comes in, and even day trading, because it can really make a big difference in how you maximize your profits over time.
Yeah, I think that's a really good distinction to make about Warren Buffett in particular. He's come on, I would say, into question a lot lately for some choices on things like airlines and stuff like that. but there's a reason that the man has been successful over time, and it is discovering those key investment points. Matt, I was wondering if you could discuss any asset classes or any individual assets that are experiencing some key points right now.
Well, I must admit, one of the things that I think is at a is getting to a extreme in terms of getting overbought are some of these great mega cap tech stocks. And I'm not one of those. You look at an Apple computer, great company. There's no question that company is going to continue to do well. Microsoft going to continue to do well. Tesla will probably continue to do well. Little less certainty there. But these stocks, especially Tesla, has gotten so overbought. You have so many people. I mean, you look at the stock, when you look at technical analysis, which is very important to, I want to step back on one thing before I go on with this, but it's just the whole thing on technical analysis. And some people, they kind of blow it off saying, it's just a bunch of lines drawn on a page and you can make it look like anything you want. To a degree, for some people, that's true. But if you really learn the basic ones, you don't get too involved in it, it can be incredibly invaluable. And all the top hedge fund guys, Paul Tudor Jones, Jeff Gunlock, Stanley Druckenmiller, you name it. These guys all follow technical analysis very closely. Certainly not the only thing they follow, but they do follow closely. And the thing is, it's fundamentally based. People say, well, it's just a bunch of lines drawn on a chart. But these fundamental guys say, well, yeah, but let's say the stock market always moves 6 months in front of the economy. Well, that's technical analysis. I mean, you think about an individual stock. A company's not doing well. The stock goes down. They've been going through a couple of years of tough times. All of a sudden, things start to turn up. Well, the senior management, they decide, okay, we got to hire back a lot more people. We've got to reopen those factories. Maybe we've got to build a new factory, and we're really going to ramp things up because demand is really picking up. Well, you know something? It's going to take time to hire all those people to retool those factories, and you're not going to get earnings to kick in for 6 to 9 months before things. Are you going to wait for that? Well, the professionals, the guys who are really watching the markets closely, they're talking to the suppliers. They're talking to the company. They know that this stock's going to go higher. They're not going to wait for the earnings to get better 9 months from now. They're going to buy it right now, and therefore this chart, the stock will move up before the underlying fundamentals do. And the same thing tends to happen on the downside, where first of all, you got corporate managers that have big egos. They don't want to admit things are going badly. Number one, and number two, most people don't like to lay off people, so they want to hold on, and they kind of hold on too long. But the professionals, they look and they find out, hey, they're talking to the company. This stock is having some troubles. I'm going to sell it now. I'm not going to wait for them to report their earnings 3 months from now for me to lighten up on my position. And so again, the chart rolls over early. You can see it before the fundamentals come out. And so it's fundamentally based. It just leads those fundamentals. And that's why it's vitally important. And right now, some of these technicals in these mega cap names are really getting, I think, extended. And those people will own them, especially even if they own them on a long-term basis in their long-term, not in their trading portfolio, or you can have that base portfolio that you trade within. You can have a separate portfolio that you trade around, and you can lighten up and take advantage of what I think is what we saw in January and February, where the market got equally overbought and overloved. And these stocks, now I don't think the market's going to go down 30% like it did in the first quarter, because the Fed is there. But as we heard yesterday, and we can get into this later if you like, but some of the Fed people were telling us that we can't rely on the Fed to push the market a lot higher. And the point is, so that tells me that they're very conscious of the level of asset prices. They don't want to push them too high. They don't want to cause another bubble. And these stocks should come in. So if you take a few profits, you can also take advantage in it's like a reverse ETF, like the PSQ, which is the inverse of the QQQ, and it will go down the same amount as the QQQs go. It will go up in the same amount the QQQs go down, if they do indeed go down, which I think they will. And you can take advantage of those kind of situations, because this is kind of one of those turning points when, Tesla is trading at a 400, and I think it was yesterday morning was 425% premium to its 200-week moving average. Then the most extreme it had before that was 253 times. 253%. It's almost double more extended than it was before. That doesn't mean the stock is going to go down like tulips and stay down. I mean, the stock's getting into bubble territory. The thing is, though, Amazon got into bubble. People forget Amazon got into bubble territory in 2000. Okay, it went down 90%. 90%. Okay, and now you sit there and say, well, tulips went down and stayed down. Well, Amazon sure as hell didn't stay down. I mean, it came roaring back and basically taken over the world. And my point is that great companies and great stocks are two different things sometimes. Sometimes the stock gets so far ahead of even the underlying fundamentals. And again, I don't think Tesla's going down 90%, but it's seen two corrections of 20 to 50% every year for the last 10 years. It's had one this year. There's a good chance it's going to have another one. And I think there's a time to take some profits in that one and then take advantage of it when it sees a big dip, because markets nowadays overshoot in both directions. Right now it's shot to the upside, raise a little cash. You can take advantage of it when it overshoots to the downside.
Yeah, I think that's really great. And I was going to ask you specifically about Tesla. So you have a great newsletter where you share a lot of your research and your thoughts on the market. And in a past edition, you did point out Tesla as it's great right now if you got in and you're riding the wave, but perhaps not to chase it as it goes to the top, because that downswing in the price is probably going to happen. We're not exactly sure when, but all signs point to it happening. And that might just be the best point to get into Tesla. So a lot of folks out there that are thinking about it, maybe don't chase, maybe wait for this dip, because there are a lot of indications pointing to it happening.
Exactly. And it's one of the things that I talked about in that piece in my newsletter, is that I'm not one of those. There's some people who are just perma bears. They like, this stock should be at zero. I'm not one of those people. 15 months ago, when Tesla got to $200, I was actually got to 250, was going down. And I said, lighten up on the stock, because the technical factors I was looking at, I said, this stock's going below 200. Well, it got to 200. And then I came out and said, okay, it's getting a little dicey here. It's getting oversold. It drops below 190, back up the truck. It got below 190 for just a couple of days, and I was pounding the table. Buy this thing, both hands, back up 2 trucks. Buy it, and of course, it just took off. So I'm not one of those guys that says this company's, Elon Musk is a nutcase. Forget it. Not at all. He's a genius. This company could very well change the world, much like Amazon has. That doesn't mean the stock can't go down. Amazon has had Microsoft, Apple, they've seen many, many big declines. That's what happens in these high-flying names. They get too much momentum into it. People think they can't never go down. And they do come down, and they present unbelievable opportunities. And that's one of the big things about trading. We saw, people talk about 1929 and 1999, that the individual trader came in and they got absolutely killed. Well, if the people are smart, and I think people have a lot more resources to their effects, I think resources like me in my newsletter, but you can take advantage of it both ways. They rode the wave up and didn't even know that you can make money on the way down, or at least save money and create out yourself opportunities. And with some of these ETFs, now you need to be very careful on the leveraged ETFs, because if the market goes sideways, they won't go sideways. They'll go down. In other words, sorry.
I was just going to say, but before you go further, could you explain a leveraged ETF to the folks that are watching?
Right. So you have, when I mentioned the QQQ, which is basically the NASDAQ ETF. It's actually the NASDAQ 100, which is more tightly it corresponds to the big cap names, because it's just the top 100 names in the NASDAQ. And that's just you hear a lot on CNBC and Bloomberg and Fox Financial News, et cetera. That's, kind of the big technology ETF that you can buy. The PSQ is the inverse. And so basically, if the QQQs and NASDAQ goes up 2%, the QQQs are going to go up 2%, and the PSQ is going to go down 2%. However, they have these leveraged ETFs where you can get they don't pretend to be exact, but they do usually give you 2 times the upside. So if the NASDAQ goes up 2%, you'll make 4%. If the NASDAQ goes down, the inverse leveraged ETF 2 times will go down. We'll give you you'll lose 4%. So you get twice. And there's also 3 times. In some cases, even 4-time leverage ETFs. But the 2-time and the 3-time leveraged ETFs are very are popular. I don't want to say overly popular, but they're very, very dicey, because to get this kind of leverage, you have to go into the options market, the futures market, and leverage the people who make these options. You know, the State Street Global and these others who create these products. They have to go in and hedge themselves on the products that they're selling. So they have to go into the options market. Therefore, and as we know in options, as you get close to the expiration date, the option goes down in price, no matter what happens to the underlying security. And that means, so in other words, what I'm saying is that if the QQQ goes flat, doesn't do anything for a month, okay? I'm sorry, if NASDAQ does nothing for a month, the QQQ is going to do nothing. You're not going to lose money, you're not going to make money. The PSQ, you're not going to lose money, you're not going to make money. It's going to be right in there. If you own the 2 times call, or the 2 times bullish one and the 2 times bearish one, you're going to lose money on both of them. They're not going to stay flat because they're leveraged. So flat markets are killers, and that's why they're very much trading tools, not long-term investment tools. You can use the QQQs on a longer-term basis. You can't use the leveraged ETFs. They will be, because of time value and such. They will go down if the market goes sideways. You know, so in other words, they don't only go down if the market goes the opposite way you think it's going. If the market stays flat, you will lose money. So it's you got to be very careful with those.
Yeah, for sure. I have fallen into that. When I was first getting into options, I was purchasing options on leveraged ETFs, which was too much for me to handle.
Well, you really need to know. You really need to be very sure of what you're doing, and that's not easy to do when it has to be perfectly timed.
Yeah, no, it wasn't a home run for me. It was straight to the bench, right back to the bench. All right, so Matt. I know that you have a lot of stocks that you like right now. I was wondering if you could sort of use some stocks that people might know, and you can start off with Tesla. I think Tesla is probably an example that everyone's familiar with, probably even familiar with Tesla's charts right now, and delineate an investor's mindset and approach toward that type of holding, and a trader's approach toward that type of holding.
Okay, great. So I'm just going to do a little screen share. If you can see that, can you see? I don't know if you can see my.
Yep, we can see your charts here.
Okay, great. So you know, we're looking at Tesla here, and I'm going to get. So this is a. How do I put this so I can put up top? Just drag it up, grab it. Move it up.
We've got Matt Maley's
I got my there we go. I got there. Now we're all set. He's helping me out. He's great, my son Peter. Okay, now here you can see. Now here's the stock on a daily basis, and it's just going back a short period of time. But let's go back. Look at that. You don't think that's a parabolic move? That is unbelievably straight up. And have things really improved that much for the company? They have improved, no question. But you are betting on, there's a certain amount of hope that's getting involved here. And look at the relative strength index. This is down here. This is the relative strength index chart. Now the RSI, the relative strength index, you probably hear a lot about that, whether it be in print media or on TV. And it's a great gauge of momentum. And what it does, it just takes how the stock is acting when it's advancing versus when it's declining within a small period of time. In other words, we all know, even if you don't know a lot about technical analysis, and it totally makes sense. If a stock is moving up an increasing volume, that means there's more buyers. That's a healthy move. If it's moving up, but when it gets up to a real high level and the volume starts to drop off, it tells you the buyers are getting tired. And there's the same thing with the RSI. They do it on a much shorter term basis, and usually the 14-day period is kind of the base, and they measure those movements. And when it gets up to a 70 reading, that means that the momentum has gone too far. And that's one of the things that's important to know for a lot of investors who don't realize that there's certain things in the investment world where if something is, they're contrary indicators, where you have, if things are too good, they can't go any higher. And it's like the old thing with Sports Illustrated cover. If you were on the Sports Illustrated cover, that meant that you couldn't go anywhere but down. And that's a little bit different because somebody they're a baseball player, they can keep hitting well and they can do fine. There used to be the Time magazine cover story where whenever a stock, wasn't so much that they couldn't go any higher, is that it becomes so ingrained in with the popular in popular minds that everybody was in. I mean, and of course the same thing on the downside. If something was, you have a really negative article that made the cover of Time magazine, there was a thing called The Death of Equities, a famous Time magazine cover in 1982. And about 2 months later, the stock market bottomed and never looked back. It's been going almost straight up ever since. So the thing about this is when you get a market, now I'm looking down here, now if you can see the arrow there, when it gets down to a level and starts rising, it's got good momentum. That's a great time to buy the stock, okay? But look what happened here. When it gets really, really extreme, it got up here, it got above 90, okay? That obviously you see what happened to the stock. It got absolutely clobbered. Now we're getting close to that level once again. Now I have not here, but you can see on this line here, this purple line down here, that's its 200-week moving average. Right now, the stock is trading at about 425% premium to its 200-week moving average. Okay, the record before now was a premium of only 250%. Now, 250% for most stocks is out of control. This is going to 425%. It's just too many people. There's not enough left people to buy it. People are not shorted. Although at the beginning of the year, people were short. You know, there's the old saying goes from that commercial, short up the wazoo. They're not short anymore. And so they're not going to be forced to buy the stock. And when the thing turns, the momentum traders are going to bail out of the stock really, really quickly. And so I think it's very dangerous to chase the stock up here.
So, okay. So let me run this back from my perspective. So if I'm looking at this as an investor, I want to hold Tesla over the next 3-5 years. I really think that it's going to get to $5,000. I'm looking at this and saying, yes, because on the RSI, we have gotten to points that are overbought, meaning that it's getting up to 70 or higher on the RSI indicator. Yes, that means that there's probably going to be a sell-off following that. So the stock price is going to dip, but I'm going to average into it perhaps, or I'm going to hold it and I'm not going to panic because I really believe in this stock over a longer period of time. And if anything, when I'm looking at the RSI and it starts to get to 70 or higher and it's really looking overbought, that's just an indication to me that there might be another entry point for me to pile even more into the stock that I believe in as an investor. But from a trader's perspective, when I see that RSI hitting 70 or higher, indicating that the stock is being overbought and that folks are getting ready to sell off to take their gains, I have an opportunity to perhaps even short it to get the ups and downs of the price action and follow it using RSI as sort of a leading indicator of what's about to happen with the actual price of the stock. So more moves in a shorter period of time using overbought or oversold as a leading indicator of what I'm going to do next. Is that a good way to sort of delineate the investor's perspective against the trader's perspective?
Absolutely. I mean, and even for a long term, I mean, this one has become used to, as you mentioned, 70. You know, you can see in this case where there's a bunch of times where Tesla's gotten this overbought because it's it's obviously it's high profile name. You very, very rarely see a stock get up into the 80s. And I remember one time Cat Tractor, which is certainly not a technology stock, it got up to 93 with this RSI. I was pounding the table. Sell this stock if you own it, short it if you don't own it. This stock is going down. Great company. They're not going out of business anytime soon, anytime in a long time. But it was the stock had gotten way ahead of itself, and it was a great call. The stock came down. So even for long-term players, they say, "Hey, maybe I'll take 20% of my holding." And in some cases, geez, maybe I only have $1,000. Okay, take 20% of that holding and pull back. For a trader, you can take 50% or even the whole thing. take profits and even consider shorting it, or look in the options market. And because when a stock gets that far up, especially when a stock gets that far up in a market that's strong, and a lot of people hear about the VIX. That means the VIX gets down low. That means it's less expensive, cheaper for you to buy options. And when a stock gets really high, you can go out, even just 3 or 4%, and out of the money, and buy a cheap option. And a stock, when it gets that overbought, can easily fall 10%. And you really get it, instead of getting those doubles and singles, doubles, and triples that you really are looking for as a swing trader, and even a day trader, especially day traders. You can get that home run in the options market when things get to huge extremes.
Yep, and I think guys in chat, if you have an appetite to hear more about how you can pair options with your general investing or trading strategies, we can talk about that a little bit. But for now, I think we'll just talk about actually buying the asset itself, and how to play that as an investor or a trader. We do have some questions, Matt, coming in from chat. So this one is following a drop. So let's say you're in Tesla, the stock drops 1,000 points. Would you still buy it since you believe in this stock or company? Just based on, and this is specific to Tesla.
Right. Well, I think, one of the things is, as a trader, what it's important to do is stocks drops 1,000 points. And again, you can look at the RSI chart, and it gets down towards 30, like it did back in June. When it got back in June, back in June of 1999, this is back when I said back up the truck. I mean, you saw that the RSI chart, this is the weekly RSI that got down to 30. You look at the daily RSI charts, they can overshoot a little bit more often than the weekly ones. But this prevents, so you sit there and you go, geez, the stock has gotten clobbered. It went from $400, it got cut in half down to below $200. Cut in half, and its weekly RSI got down to 30. Unbelievable opportunity to buy the stock. But you have to be careful also, is that when you buy the stock and you buy it in here and it's not oversold yet, but you believe in the stock, that's fine. You have other reasons, there's other technical reasons or other fundamental reasons why you like it. But if it doesn't work, and when you're trading, one of the most important rules is limit your losses. People say 10% at the absolute max. I totally agree with that. I tend to maybe want 5%. If it's a trade and you like the stock, it drops 5% or more, get out. Okay, take it. You are not going to be able to get 100% of your trades. You're not even close to be 100. You get a batting average of 1,000. You are going to be batting. You want to be batting in the above 500. You don't want Major League Baseball player 3 to 350 is great batting average. You want to do a lot better than that, but you cannot win them all. Get out while you can. Well, live to fight another day. Get out of that stock, and then you can buy a little bit more. However, it doesn't mean you can't average down a little bit, especially when a stock gets oversold. Now, if you bought at 188, now again, I'm not saying if you buy a stock at 200, it goes to 199. Oh my gosh, no. That's okay, because you're not going to get the absolute bottom. You're not going to sell the absolute. If you decide to short, you're not going to short it at the absolute top. No way. You can add a little bit more if it raises a little bit, and you can average down. But you do need to limit those losses on the trading side. On $1,000 a point, and you want to buy more, absolutely. And the one thing I don't want to, again, sometimes I get going. You can't shut me up. But the one thing that's very important is that too many people think I want to average down. I want to average down. Don't be afraid to average up, especially if a stock gets really oversold. And if people say, oh no, I missed it. I mean, I was nervous. Tesla had gone from 400 to below 200. I bought a little when Maley told me to buy it. When it got below 190, I bought it at 188. Boy, and I bought a little bit more at 186. And then it took off. And I missed it. I wish I had bought. I wanted to buy more and I didn't. Well, guess what? If you buy it at 185, let's say you bought it at a couple of different prices, your average is 185. Okay, but you want to buy some more. Okay, the stock goes to 200 and you buy an equal amount at 200. Okay, so you've got a bunch at 185, you've got a bunch at 200. Your average price is 192.50. Okay, your average price is $192 and it's trading at 200. You've got a profit. Okay, you're in the money. Okay, these people sit there and go, "Oh, I missed it." No, keep buying. It's okay, especially when a stock is come from a ridiculously oversold position. Let's look at the flip side. If you buy it at 200 and then you buy a bunch more at 185, okay, now your average is 192. The stock's at 192, is at 185, but your average is 192. You're losing money right now. Okay, don't be afraid. So on the way down, be careful when you scale down. It's okay to do a little bit, but at some point you say, I'm out. I can get back in another lower place. I still like the play, but I want to see the stock bottom out. That's trading rather than just using this esoteric theoretical stuff that a lot of these analysts and strategists use. You be smart. Don't be afraid especially once you've got a position to buy it at higher prices if you believe in it and get that full position that you've always wanted. Because believe me, if you were buying it at $250 a month later, you're still feeling real good right now with the stock at $2,200.
Yep, absolutely. And I like that distinction. So a lot of times we talk about overbought, and we start to see that a potential reversal on a small scale is coming, because all the people that are buying the stock, therefore driving the price up, are just about ready to take profit. So when they sell, that price is going to go back down. So that's why RSI, when you're looking for overbought, especially a heavily overbought thing that's hitting 80, which is 10 points above 70, which is officially overbought on the RSI indicator. That's why that's so useful for you to time entries and exits. But something, Matt, I'm just trying to summarize is that the inverse also works. So like when you're hitting 30 on the RSI, that's when a stock is officially oversold. And then once you pass below 30, you've got some serious sell off happening. Folks are taking their profits, and that's a great entry point. So whether you're investing or trading, that's an indicator for you that stock is about as cheap as it's going to get for the time being. It can be a great entry point regardless of what you plan to do next. So I want to look. Okay, so we've got some questions about Elon Musk going on Joe Rogan's show and smoking weed with him. I'm not sure how much that affected his stock. He is definitely one of the most polarizing CEOs in the markets today. And yes, his Twitter account does have an effect on the price of the stock. Right now, we're talking mostly about investor behavior affecting the price of the stock, which, yeah, certainly can be in response to external events such as what the CEO is doing, or how the company's performing on a fundamental basis. All right, folks, okay, that's good advice. All right, if you guys have some more questions, I would love to hear them. Drop them in here. Right now, the main topics that we're talking about is how we use RSI, or Relative Strength Index, which is a study or an indicator, depending on what your platform is. They call it different things. A study or an indicator that you can add to your stock page to get an idea of what buyers and sellers of the stock are doing to help you identify trends. So this is very important from both an investor and a trader perspective. So in lieu of some questions specifically about these tactics, Matt, I was wondering if there was another stock that really interests you right now that perhaps you could discuss.
Well, this one, yeah. I mean, and I'll just pull up the chart while we're talking about it. And this stock is Colgate, Colgate-Palmolive. And you're like, oh my gosh, wait a minute. All I care about are the tech stocks. These ones are going to be the ones that are going to really, that's the only place where we can make money. Well, to be honest with you, Clorox, which is obviously a different company, has had an unbelievable year. It's traded, even though it's what they call a consumer staple stock, because people need to get cleaners no matter what they have, no matter what they're doing, whatever, if they have a job. And there's certain stocks that are very defensive, food stocks, of course, because you have to eat. And some of these names, Colgate is one of those names. And the thing about Colgate, though, is that, I guess what I'm talking about now is that a lot of people are worried about what's going on with the stock market. The stock market has had this huge move. The economy certainly hasn't kept up. People are hoping that the economy will get a much better in 2021, that earnings will come back in 2021. but that's definitely, hope is not a great investment strategy. And right now, people are looking for earnings on the S&P 500 to be about $163 in 2021. Forget about this year, 2021. Well, guess what? Guess what they were in 2019? Okay, they were $163. What were they in 2018? $163. Earnings haven't improved at all. And kind of the consensus now is only looking for us to get back to 2018, 2019 levels. How can the stock market really rally a lot more under that kind of scenario? So people are nervous. So that's why it's okay to go after these high flying stocks that do well in the economy. Is obviously they're changing the economy. But if you want some safety, you can go into a stock like Clorox, like Colgate. Well, look at this, where I just pointed that line. I probably should have made a different color line, but you can see where this line is. This stock has been bumping up against the 77.5 level all 4 different times. It finally broke above that level. This is very, very bullish on a trading basis. But this is where trading is an art. I mean, it's not just flat in. Now you can see also, you look down here, its RSI is getting overbought. It's above 60. Now this is the daily RSI. Okay, so this is getting above 60. It's at 60, well, let's see, 69. So that's getting extended. And that's why it's a great opportunity for investors right now. I think, no, you don't want to pile into it yet. But let's see if the stock comes down a little bit and comes back and retests that line. There's nothing more bullish. It's the old saying in technical analysis, old resistance becomes new support. And just the opposite on the other side, sometimes it's old support becomes new resistance. Here we have old resistance. It couldn't break above. It finally broke it. So now we're going to watch that 77 to 77.5 level. If the next pullback comes and kind of works off this overbought condition and it holds that level and it trades higher, it is going to fly. And again, people think, well, geez, it's Colgate. They make toothpaste and stuff like that. I mean, how can that really be? Well, it's really not going to go up as much as the tech stocks. Well, when a stock has not been doing anything for a while and it finally breaks out of a multi-year kind of sideways trend that Colgate had been in, it gives you an unbelievable opportunity. And I'll look at, again, Colgate. Now, again, this is Clorox. All right, there we go. Boom, 55%. Clorox rallied 55% from March until the highs in early August. That's not as good as Tesla did, but it's as good as most of those tech stocks did. Microsoft and Apple and those names. It is an unbelievable move. So here's a stock, Colgate, which is very similar stock. It hasn't. Here is where when Clorox finally broke out, it just took off. Colgate has that same kind of potential. Now we know the Clorox because they made the wipes and things that gave it a lot of attention. So it may not, Colgate may not necessarily rally 50%, but it's enabled to protect you on the downside because it's a consumer staples if the market sees a pullback after this great rally, but still gives you a huge amount of upside if the market continues, if and when the market continues to rally. I think it'll pull back, but when it rallies again, it's just one of those names that nobody's looking at, and you can really make some upside, some nice upside potential, but still get some downside protection.
And before you move on, you touched on a couple of key concepts that I really want folks here to understand. Number one, support and resistance. All right, so support and resistance are terms that you're always going to hear when talking about the charts for a stock. So when we talk about resistance, and correct me if I'm wrong, Matt, when we talk about resistance is that price level that the stock just can't get past. And what you'll see is the stock going down and then getting back to that price point. So in the example of Colgate, we were looking at it, and over the course of years, the highest it would get was a particular price point and then would go back down. Months and months and months and months would go by. It would get back to that price point, and it would kind of retest it. Is it going to break through that resistance? And it didn't. It would go back down. Now, the support is the same thing, but on the low end. So when the price gets low, this is about as low as it seems to be getting, because every time it gets to this point, the buyers are coming in and they're pushing that stock back up. So the support and the resistance is sort of that range, high and low, that a stock will be in. And what we're looking for as investors and traders is a breakthrough on either side. What and how do we time that? And what Matt has pointed out is, one, fundamentally, it's a fairly safe bet, because consumer staples are still going to be needed. We're still going to need toothpaste in the advent of an economic recession or something like that. But also another thing that I want to touch on is that, Matt, you made a point of saying this is extremely bullish. So if this sort of price action occurred over a shorter period of time, it would be less bullish than it would be over a much longer period of time. Is that fair to say that the longer the duration that we see this activity, the bigger the potential for a breakout is?
No question. And anytime you break out, again, if you've tested something 4 times like you did on this over a 2-month period, it would still be very bullish that it broke out. But there's no question. It's a lot more bullish the longer it goes and the more times it tests that level. And I just drew another line here, a purple line here on the support level for Colgate back in 2018. At the very end of the year, it retested that low and held. Nice double bottom. Here was a double top. Double top. You'll start to hear a lot about that. Double tops. That's horrible. Look at that double top. Look what happened. Stock got creamed. Here's the double bottom. Look what happened. The stock just took off. Okay. But it still couldn't get above that level. But it finally has. And this is another important point I do want to show. We always want to make sure there can be a lot of head fakes. And we saw right here in 2018, they got slightly above that level, only slightly. It did again at the beginning of this year in February. Only slightly. So you always want to see that meaningful break. These two were head fakes, and the people who piled in, there's nothing wrong with buying a little bit, but people who piled in, they got absolutely killed. So you want to make sure that you got more of a meaningful breakout. I usually like to see 2%, 2 to 3% of a breakout. And that's that's when you really get more content. You don't have to wait for it to get 2% above, and that's why I talk about you can people too much is I'm going to buy all my stock at one time. If you're a trader, you shouldn't do that, number one. If you're a long-term investor and you just want to sit on something for 30 years, that's great. Buy it once and let it ride. And you can add a little bit on each year when your 401k payment comes up. But for traders, be nimble, be willing to buy and sell at a couple of different prices. And that's especially when you have a nice profit. I mean, one of the things that I don't want to get off on a tangent, but one of the real basic rules that if you double your money in a stock, why not sell half? Now, if you really believe in a stock, especially if you work in the industry and you really understand, hey, I think it's going a lot higher, fine. But if you double your stock, especially in an option, I don't really want to get too much on options, you double your money, sell it. That means you have zero risk. You cannot lose money. If your stock is doubled, it goes from 50 to 100, you sell half of it, your initial investment is safe. It's in the bank. The rest is just gravy, and you can let it run. So don't be afraid. Oh, geez, it's doubled. I'm going to sell it all right now. I still believe in the company. I'm willing to sell some and let the rest ride. I'm going to put something in the rest of my money in a stock that I think has a lot more upside potential. Things like that. So again, as you mentioned, yes, those levels are very important. But again, just a few pennies above or a few pennies below, that's not enough to really to confirm that a breakout or breakdown has taken place.
Okay, yeah. So we want to see a price to reflect the breakout and confirm the thesis on it. Right. So we got some questions about time frame. So again, delineating between investing in a stock versus trading it. What are the types of time frames when you're looking at your chart as an investor versus what you're looking at in terms of time frames as a trader?
Yeah, this is. I mean, let me tell you the thing. On the charts, whenever it's good for an investor, it's always good for a trader. Okay. So if you are a long-term player and you really like Colgate, I mean, when a stock breaks out a 4-year, it can't get out of a 4-year range. It's a wide range, but a 4-year quadruple top or triple top anyway, it breaks out of that. That is a great thing. If you like that fundamentally, it's a great buy. If you like it as a trader, jump in with both feet. And you can be a little bit more nimble. Again, a trader might want to wait until now, as I mentioned earlier with the RSI, they might want to wait and come back, see if it retests that level, successfully retest it. That's another thing too. If you get look at this here, higher low, higher high. That's obviously a higher high there. If it comes back a little bit and then gets another higher high, then you add to it. But to answer your question more directly, the time frame that I really look at as a trader, it can be anywhere from a couple of weeks to even a couple of months. And I guess my thing is that if you have a winner, don't be afraid, okay, to let it run. Okay, and it's like Tesla. How many people, when they bought it at 190, thought, okay, I'm going to sit on this till it gets to 2,000? Nobody did. They're saying, geez, if this thing can go to 400, I'm going to get out. Well, they would have sold way too early. So what you do, maybe you sell a little bit, and then you put what they call a trailing stop below the market. As the stock goes up, okay, it gets down, and then the stock comes back down. Then you sell it. It's like, well, wait a minute. And that's again another rule where people are like, why wouldn't I sell it at the exact high? I mean, it's come down a little bit. I want to wait for it to get back. No, you're up 200% in a stock, and it comes down a little bit. Hey, it may be topping out. Here's a level that you get stopped out at a nice profit, and it kind of keeps you honest. So if you constantly, they call stop orders, you're constantly moving up that stop as the stock trades higher. If you did that in Tesla, you still own it. Okay, you own it 190, and its stock's trading at $2,000 and $2,200, and you have a stop now at 2,000. Well, geez, you'll be bummed out that you sold it at 2,000 rather than 2,200. But you'll be like, yeah, but if I had really been doing it without a stop, I would have sold it at 400. I made a huge profit. So use those stops is in both directions can be very helpful as well.
Yep. So trailing stop losses, if any of you guys have questions about a trailing stop loss and how to make that work on your brokerage, go ahead and drop them in chat. After this talk, Luke and I will be discussing different brokerages and how they work for different investment styles and what your goals are. So we'll definitely dive deeper into that. And then in terms of increments on your chart, I think that in general, if you're swing trading, you should be looking at days, 4 hour, and then potentially hour, just to keep track of how things are going with your investments. And then with more active trading, you're going to start getting into the minutes. Really want to be around that 1 minute is kind of a nice place where any type of trading can agree on. If you're scalping, which is like the most frequent, really high frequent trading, if you're sitting there and doing this all day, you are going to want to get into seconds. So here's a nice one from Timothy Bender here. When we're talking about trailing stop losses, do you have a rule of thumb, Matt, for what percentage you would set for a trailing stop loss?
I don't, and I just think with certain things we need to be. Again, I do this every single day, all day long, so I get a good feel for what the market is doing, and the broad market can influence the way I'm thinking on any given day, because if the stock's coming in and the stock market is really strong, I'll give myself a little bit more leeway. And again, certain stocks are a lot more volatile. And geez, if you have a stop loss in Caterpillar Tractor, you're going to have it fairly tight. Maybe it's 5% below where it's trading right now. But especially if Tesla, it's such a big gain. You've got hundreds of percentage. Well, do I really need to sell if it drops 5%? No, it could drop 5% tomorrow and still go higher. So you want to do the volatility with the stock that the stock usually sees. I tend to keep it in the, again, and of course, the bigger gain you have, the more leeway you have. Geez, I've got a 50% gain in this stock, so I'm going to give it 10% before I do it. My usual thing is kind of a 5%. I keep it usually 5%, but I don't want to say that is a set rule because different stocks act different in different manners. The marketplace is acting differently. Last March, I would have used even tighter stops because it was so much volatility and it was just a very, very difficult market to trade in, but a very lucrative one if you had the right stops. And I just think risk management is so vitally important. People, you never want to lose a lot of money in one trade. 10% I think is the max. And when you have those trailing stops, 5 to 10%, depending on how much you've already made, is kind of good in my mind. With 5% kind of being my usual basic rule.
That's something you guys can really hold on to. I'll admit, like even kind of recently, I've gone into some trades without just forgetting to put in a good stop loss because I'm not disciplined enough yet. But really, a stop loss is something that you've got. It's a must. You've got to go in there knowing the most that you're willing to lose. And it doesn't mean that the trade itself was 100% bad. It just means that you're getting yourself out before you lose too much money. And then if the stock does dip to a lower level, that might be a buying opportunity. All you did was prevent yourself from losing too much. And then you're being smart and you're agile, and you can use that money that you allocated for the initial trade and then go in at a better entry point given the new circumstances that have shown themselves.
Absolutely. I mean, one of my favorite stories is my wife's great aunt, and she loved to go to the slot machines. And she went in one day, we were down visiting, and she said, Donna, I made $3,200 at the slots yesterday, 2 or 3 days ago. It's like, oh, that's great. That's unbelievable. And of course, her other aunt went over and said, well, she lost 7,000 over the last 2 months. I mean, it's like, if you lose so much money, what good is it that you made a little bit back? You got, if she had limited her losses early on, that 3,200 would have been a much better gain for her. So that's a great thing. And if there's one more thing, because I know we're probably getting close to the end of the time. The one thing, just for investors and traders alike, remember, it's vitally important to remember that the world, not just the stock market, the world acts in cycles. I mean, think about it. We have 7 days in a week, every week. We have 12 months in a year. We have 52 weeks in a year, et cetera. We have winter, summer, spring, fall, every single year. Sometimes it's more severe. Sometimes each one lasts longer or shorter, but there's those cycles. They're not perfect, but they're cycles. The stock market has the same thing. And the big thing with this long-term investing, and why I think trading is so vitally important as well, is that I'm telling you, one of these FANG names that's doing so well right now, they're all doing so well right now, 25 years from now, one of them is going to be out of business. Okay, maybe some of them. Okay, General Electric 25 years ago was the best, most important company in the world, and had been one of the best and most important company in the world for 70 years. Now it's an afterthought. Okay, IBM was by far the most important tech company in the world in the 60s, 70s, and even into the 80s. 90, and now it's still around and it's still somewhat important, but nothing about what it was. Apple saw, and people say, oh, there's no way that will ever happen to Apple. Well, it actually already happened to Apple once in the 1990s, and it's made a great comeback. Even Microsoft, although it didn't fall as far, has made a big comeback. Facebook, Google, Netflix, NVIDIA, Tesla, one of these stocks these companies will get tired. Somebody else will come along and challenge them, whatever it is. You have to stay nimble, even with your long-term investments, because cycles always change. I mean, think about it. The San Francisco 49ers were unbelievably great in the late 80s and 1990s, stunk for a long time. Now they're getting good again. It happens in every part of the society, not just the markets. So make sure that you stay nimble, even on your long-term investments.
Yep. And okay, so I want to play a short little game. We've got 5 minutes left in this talk. I do think that is very interesting because, guys, tech stocks are carrying most of our indices, are carrying much of the S&P, but they're not invincible, as Matt has pointed out. I mean, if you guys go back to the fairly recent congressional hearing, a lot of reasons for why some of these tech stocks might begin to suffer here in the mid to near term we're had some light shed on them. We've got consumer protection laws coming into play. We've got even some interplay between the tech stocks that might be leading to some trouble. And then what if new privacy laws come into place that threaten ad revenue, and these types of things. So I just want to, and this is 100% a hot take. I know that we're not going to hold anyone accountable. I was just wondering, Matt, out of the big ones, we're talking FANG, who do you think is going to be the first one to get broken up, maybe start to suffer a little bit? Who do you think is going to be the first one to drop out?
Well, I'll say I would guess Facebook. Well, let me say Amazon, but that's not bad. It's actually positive. I think Amazon is going to be broken up the way Standard Oil was broken up, and the people who owned Standard Oil in 1917 or whatever it was, and got all those companies. Put it this way: John D. Rockefeller made more money owning those stocks, or paying. I'm sorry, in owning the dividends of the split up of all those companies, and than he did in the oil business. Okay, so and Jeff Bezos is a brilliant man. So I guess my point is, I think they will get broken up, but that's not a reason to sell the stock. This stock is a great stock. In fact, it's a reason to buy it. Facebook, on the other hand, I just think that at some point, same with Google, this is just getting, once we get past the elections, you're, especially if we see a Democrat win, but either way, it's too much Big Brother. They know what everybody's doing all the time. They're selling this stuff out. I think they're going to have to be broken up at some point. This year, because of the pandemic, it didn't become as big an issue. It was ripe for a political issue this year for them to get hammered. And then the pandemic came along and says, oh, we can't live without these things. So they actually did just the opposite. Yeah. So be careful of those. But those were the ones the two that I'd be worried about. And Amazon, like I said, that's going to be a breakup, but that's going to be a home run. It's one that it's still going to be a home run.
All right, so different for the investor perspective on these companies. So it's not as simple as just which one's going to get pieced apart, because it can be pretty good for investors. I'm seeing just in chat. I do want to highlight. We got some picks from chat. We've got Facebook and Google. We got two. It looks like Facebook is really the winner here. And something I will add to that is that Facebook's brand is suffering. I mean, when you've got consumers that are concerned about a company, they're going to pressure the lawmakers. They're going to pressure the folks that are in power to do something about it. And they want to win those re-elections. So Facebook does seem to have the biggest target on its back. And then we also got Tesla will come down. Yes, it does seem Tesla will come down. Tesla's not necessarily one of the stocks that's carrying everything, like these, what we call FANG stocks. But, Tesla is an anomaly. Matt knows a lot better than I do. Tesla scares me.
Yeah,
Tesla's like a roadster that it goes too fast. I'm too afraid to drive it.
I honestly think Tesla is a bubble. But Amazon was a bubble. It doesn't mean it's going out of business. If it's a bubble, I think it's going to get hit hard. Very hard, and it may come out and rule the world 5 to 10 years from now. But I think it's going to get hit. And like you said, but the thing with Facebook too is that if they're going to have regulatory pressures that are going to dampen their business, or a Microsoft will Amazon will just be split up like Standard Oil was. I mean, their cloud business will be one thing, and their retail business will be another thing, and they'll have all these different businesses, and they'll just be run on their own. That would be positive. Or Facebook will be like, no, you got to stop doing this. All that stuff that made you so profitable, you've got to stop doing some of it. And that's why I totally agree with you that there's much more risk there than there is in a stock like an Amazon.
All right, and we'll go ahead and end on that note. Some very interesting takes on some stocks. I think that's probably the most nuanced and thoughtful take that you'll get, especially if you've been hanging out on Twitter all day, looking at the TSLA cash tag. So Matt, thank you so much for being with us today. Where can folks find more of your research and your stock?
Well, we just started just recently. Benzinga Picks, where is Stock Picks? I'm sorry, and this is up on the Benzinga website. I make 2 picks, long-term picks every month, and another for my second iteration of the newsletter is a one where we give more shorter term picks. And in fact, right now my pick with the NASDAQ trading at ridiculously high levels, I think that PSQ is one that people should consider buying. And I think as the stock market goes down, they'll make some nice profits in the other direction. So that'll be nice. But that's where you can get it. I get picks on a regular basis, and then there's also the Maley report, which I go into a little bit more in terms of the macro pictures and what's going on in the world. And that's also, you can get the MarketFi, which is a part of Benzinga.
Yep. And what I'll add to that is a lot of what we're doing here during this boot camp is a lot of what you get when you do subscribe. So Matt can talk about the markets all day, every day. The man is always on top of things. One thing that I've gotten out of it is just reading what he writes, and it really helps you develop an eye for what's going on and an understanding of the environment around you. That's very empowering. That's a powerful thing to have when you're going out there and investing. So Matt, thank you so much for your time today. And
Thank you,
we
Neil.
hope to have you again at our next boot camp.
Would love to do it, and enjoyed it as
All
always.
right.
Thanks a lot. We'll talk to you soon.
All right. Talk soon, Matt. Thanks. Have a
Okay.
great weekend.
You too.
All right. You too. Thank you. Thank you. So, all right, moving on. We've got my zany sidekick. He's back. He's looking trim, looking wonderful. He's got some ideas
I got my haircut,
for some picks.
Neil.
Yeah, I know, guys. Okay. So really quick in chat, Luke made the decision to go out and get a haircut. Can we get a 1 if you like his haircut? Can we get a 2 if we don't like it?
See, I don't have
Looks
the
like
chat
everyone
up,
hates
so I
it.
just have to sit here in suspense.
Yeah. I haven't gotten a haircut in about 4 weeks. I'm gonna beat Nick now. I'm not gonna lie. So during this session, Luke, I'm very excited because we're going to be talking about one of the things that I still today find a little bit frustrating, which is picking a brokerage that matches my level of understanding and my goals as an investor. So I wanted to get an idea from a chat, lots of ones. Wow, guys, I don't have hair, Timothy. Luke made a presentation, guys. All right, so Luke, why don't you kick us off on this session about picking a brokerage?
Okay, so Neil and I are going to attempt something that no human being has done in history, which is we are going to review 15 brokerages in about 25 minutes. All right.
Wow.
This is what I like to call our brokerage battle session, and I even got a soundboard.
This is Sparta!
Okay, I hope that played through for everybody.
I heard it.
All right, great.
This is
everybody else heard it. So basically, what we want to do and drop questions into the chat as they're coming. But something that we're experts at over here at Benzinga are all of the brokerages out there. We've been working every single day with all of the brokerages in the US, in Canada, for 10 years. We know them inside and out. So what we're going to try to do is we're going to try to go through and do a best 4 in a really quick summary of each of these brokerages. As of last count, can you see my sheet here, Neil?
Yeah, we got a spreadsheet. We got
Okay.
Luke's brokerages.
It's called Luke's Brokerages. I know my brokerages, okay? As of last count, we've got 40 different brokerages in the US. So I'm going to be going through, I'm going to be endorsing 15 of them and basically giving the one-line summary. If you have questions about them, drop them in the chat. If you want me to, if you want to say what's the best brokerage for options, etc., drop it in there. But I'm going to get to hustling through these. So first thing that we have up, brokerages for stocks that are simple. Number 1 on the list, hard to ignore this one, is Robinhood. This is the one that everybody has heard of. Almost everybody has an account there. There's not a ton of super interesting things that you're going to do. But if you want to buy a stock, you want to track a stock, you want to find news on a stock, especially Benzinga news on a stock, Robinhood is a good solution for you. Neil, any other Robinhood comments? I know you are a Robinhood customer.
Yeah, thank you for not calling me a Robinhood trader, which has become a pejorative. Guys, if you're familiar with Robinhood, go ahead and drop a 1 in chat. Let us know if you're familiar. What I will add about Robinhood is they were the first brokerage to offer commission-free trades, which is great for beginner investors and traders because you have a small account, you don't have a lot of money, you don't want to pay $4.99 every time you buy and then sell an asset. I mean, that can really put a dent in a lot of younger, perhaps, early traders. So that was pretty groundbreaking for them to do that. And they actually led the industry and sort of pressured everyone else to offer that. And one thing that I will add also to Robinhood is it's so simple. It really is perhaps your option for your first brokerage. I think it's a good, you just install it on your phone. It takes a few minutes to sign up. And it's great for simple investments. They don't do any complex trades. If you want to do some more complex trades, Luke's going to talk about some better options. But it has both stocks and options. Very simple layout, not totally robust, but a good entry level brokerage.
All righty. The next two that I recommend for stocks for a simpler experience. The first one is Doe. This is one that you guys might not have heard of. You can't actually Google the word Doe. You need to search Doe brokerage if you're interested in checking it out. I believe Shelby is also going to be dropping some links into the chat. What's really interesting and unique about Doe is that the brokerage itself produces a lot of content. Every day they've got shows, they've got clips coming out that are focused around idea generation. It's if you care about cannabis stocks, here's what's going on in the cannabis market. If you care about tech stocks, here's what's going on with Tesla. Here's a take on it, and that sort of thing. So check out Doe brokerage if the content side of things is interesting for you. The third one that I'm going to recommend for a simple experience is called Public. This is another one that you guys might not have heard of. It launched within the last couple of years. What's really unique about Public is that it's community driven. I've got my app up here. I don't know how easily you guys can see, but on the homepage of the app, it has an idea feed, right? So you can follow traders, right? Now it's not like Twitter where you're following personalities. You're following whoever is trading on the app. And you can see, hey, here's what they're investing in. Here's why they're investing in it. It's a really, really neat social idea generation app. So if the community aspect is interesting to you, or if you want to get your ideas out there, check out Public. All right, Nielski.
Yep. Very simple one. One thing I like about Public that I'll just add really quick. I just want to add something about Public. Is not only is it the idea generation, you're actually able to look at your friends' portfolios on it. And so what I would say is it has the simplicity of a Doe or a Robinhood, but it has this extra level of trade together. So if that's something, if you got a group of friends that are actually investing actively, you can really benefit from each other. And this app just makes it that much easier. All right. Sorry, I cut you off there, Luke.
No, that is all right. Next, we're going to move on to stocks for intermediate trading, brokerages for intermediate stock trading. I've got three names here. The first one that I'm going to go ahead and drop is Webull. This is maybe the brokerage that is having the best run right now in terms of going after some of that Robinhood market share. What's unique about Webull is that they pack so much news and data and research into their mobile experience, into their desktop experience. It's insane. I don't know how they fit it all in there. I will say it takes a little bit of getting used to just to navigate everything in there because they have so much. But Webull is really interesting if you want to research stocks. I'm dropping news and research. You can also find your Benzinga news in there. A little plug. The second one I am going to name is Fidelity. What is interesting about Fidelity is they've got really, really good tools for investors. So if you are not actively day trading, but trying to research stocks to invest in for the long run, they've got tons of ways to compare stocks to others. They've got a great stock screener. The interface is easy to use. They have research in there. So Fidelity is my number 2 recommendation for intermediate. And I'll say these lists are not ordered. And then the number 3 one is I'm going to drop in JP Morgan's You Invest. All right. What's neat about this one? They have a lot of the standard stuff that you would expect out of a brokerage. But what's great is that if you are a JP Morgan or a Chase banking customer, it makes the money management experience really seamless. So, versus something like a Webull or a Fidelity where you're transferring money between your bank account and your brokerage account, if you are a JP Morgan, a Chase customer, that experience all runs together. Pretty simple like that.
So Luke, I want to ask you, are you going to talk about margin at all?
I'm about to get into margin.
All right, cool. Just making sure.
Ready? We're going to advanced.
Ready.
All right, here's where we're going to get into margin. I will say that I am a big fan of trading on margin. I think it's great, especially when interest rates are low. I do not advise that for everybody. But again, when you know the interest rate is close to zero and you can borrow money to buy stocks, you know, let's go ahead and do it. I bet big. But of course, you do not want to get blown out, right? If you have $50,000 in your portfolio and you own $200,000 of stocks, if those stocks go down 20%, your portfolio is essentially at zero. So use it sparingly, high conviction, and make sure you're diversified. But
let me add some color to margin. So let me add some color to margin. So different brokerages are going to give you a different amount of margin. And really what they're doing, just to be totally clear, is they're loaning you money to invest with. So when you put cash in your account, you'll actually see that your spending power is higher than the amount of cash that you have in your account. That's that margin that they're offering you. And I think in most cases, margin is safest if it's a long-term investment that you plan on holding for a long time with a high time horizon, so that if the stock does go into the dumps, it's not the end of the world and you're not losing all of that. But if you're going to be doing some really short-term stuff on margin, most people don't do that. As far as I understand, Luke, definitely maybe you can confirm, but I don't think most day traders that are really doing it professionally are doing much on margin. Let me know.
Yeah, I mean, there's definitely a lot of, especially prop traders are definitely leveraging themselves. But I agree. When you're borrowing money and you're using borrowed money to make bets, essentially, you want to be safer than sorrier. You know, like here's a way that I utilized margin in you know, when the market is selling off March, April, you know, I went past 100% long. I went to about 130% long. I just kept buying another 5% of SPY every 5% that the market went down, right? So if the S&P 500 fell 5%, I would go from 110% long to 115% long. And basically my thesis is, if with the cost to borrow so inexpensive because of Federal Reserve / interest rates, I don't mind holding on to these stocks for the next year if I have to, right? The market's down 25, 30%. We know, you know, when we get through coronavirus, when we get a vaccine, at the very latest, it's going to come back. It came back way before that. So I said, all right, I'll buy stocks at a 30% discount on borrowed money, hang on to them for a year if I have to. But anyways, back to the brokerages on margin. First name I'm going to drop in here is Interactive Brokers. So they have a very, very low, what's called cost to borrow. That's the cost, the interest cost that you have to pay to borrow money to buy stocks, options, etc. What's also unique about them is that they've got access to international markets in a major way. I'm not sure of any other brokerage in the US that you can use to buy stocks in, let's say, Germany or in England or Brazil, etc. So Interactive Brokers, that's my first one on the list for advanced stock trading. The second one that I'm going to give is TD Ameritrade. They are the owners and operators of the Thinkorswim platform. It's, I would say, Neil, tell me if you agree with this, it is the most widely used platform by day traders. It's got great charting. It's sturdy. It's known for options. Neil, any thoughts on that TD Ameritrade Thinkorswim?
Yep. So what I would add to this one in particular is that it's great for day trading because the charts are just so damn good. What they call the extra indicator. So if you want RSI that Matt just talked about on your ticker view or on your chart view, it's called a study. And what they have is a fantastic library of studies that you can add to give you extra indicators on what's going on with a stock. Of course, the most important thing whenever you're looking at a stock chart is the price of the asset. Price trumps everything, but they have a lot of great studies in their charting tool, and that's why a lot of very serious, quick, rapid day traders and even swing traders really like Thinkorswim by TD Ameritrade.
Yep. Alrighty. And then the third option that I'm going to drop for advanced stock traders is going to be TradeZero. They recently made waves by being the broker of choice for Dave Portnoy. That's the Barstool Sports president. He uses them for his trading. What's unique about TradeZero is that they are great for shorting. So if you are somebody who likes to use shorting in your trading and you want to short stocks that are not readily available, so maybe smaller stocks or hot stocks that other brokerages might not have, TradeZero is probably going to be your best bet to find those stocks.
Mm-hmm.
All righty. And now it is time to roll over to options. I accidentally gave you guys the preview by having the name in here. I was trying to get the suspense to build on every slide, but I left it in when I was doing my run through. But the one brokerage that I will recommend for options trading for a simpler experience is Gatsby. Gatsby is essentially the Robinhood of options trading. If you want to go in and you want to make one-legged option call or option trades, like you want to buy a call on a stock. If you don't know what I'm talking about, we will get to that later today. So stay tuned. Maybe get the recording of this session so that you can go back and run through them. But Gatsby is my recommendation for simple options trading. And you use this one, Neil, don't you?
Yeah. So after I like to spend a couple hours on Wall Street bets each night before I go to sleep. And the first thing I do is wake up in the morning and buy a bunch of aggressive puts on stocks like Netflix. So Gatsby is a great brokerage for that.
All righty. So that's our simple options trading recommendation. He is not joking. Wait, but if he is,
I did buy puts on Netflix. I did. It was dumb. What's up, dude?
There we go. That was. I brought my soundboard back in response to your joke. I've got so many sounds here, but I'm not quite sure what all the buttons do.
Yeah, we got to get the Kramer soundboard. We're gonna get to Tastyworks most definitely now that we're in the option section.
Okay. Intermediate options trading. This one is new. I bet you guys have not heard of this one. It is called Options AI. What's really unique about this one is if you're trying to learn more advanced or intermediate option strategies, is that they give you the strategy. So with Options AI, what you do is you say, as an example, I believe in Apple. I think the price of Apple is going to go from $500 to $550 over the next 3 months. And then they say, okay, here are options trades you can make to benefit if Apple makes that move you think it's going to make while still limiting your downside. So that's our first one in the intermediate options recommendation. The second one that I'm going to drop is called.
Hold on. Before you go on, I just want to add really quick to Options AI that when you are getting into the world of more complex and actually better options trades, frankly, Options AI has one of the coolest, most understandable ways of visualizing those trades as you generate them. It's something that you don't see on any other platform. I'm not sure if they invented it, but I actually love going into Options AI to help me visualize option spreads.
All righty. Second one that I have is called First Trade. They have a shiny new mobile app. I got to preview it. I got to play around with it. It is awesome. They make it really easy to input some of these more intermediate multi-legged options trades on a mobile app. Also, if you are a Chinese speaker, they have everything. The full suite of the brokerage product is available in Chinese. So that's unique to only them as far as I know. Interactive Brokers, I think, might have that support as well. But First Trade, that's a core focus of theirs. All righty. And then moving into the last grouping of brokerage recommendations I have are advanced options. The first one that I'm going to drop, Neil, I know that you talked about it just a second ago, is Tastyworks. So if you like Thinkorswim, this is actually made by the creators of Thinkorswim. It is specific to options and futures. What's really unique about them is that they have a ton of content around options, sort of similar to Doe does on a more stock-focused basis. Tastyworks does live shows. They do Q&As all around options trading and option strategies. Neil, you've used this one in the past, correct?
Yep. And what I'll say about it is if you are at the point where you're very comfortable with different option strategies, namely different types of spreads, it's tough to beat this. It is advanced. You want to start off with something simpler like Options AI as you get into that world of spreads. But Tastyworks it's tough to beat once you're really cooking. It's got idea generation. It's got great visualization for constructing spreads. It even has like a very simple tool where you just select the type of spread that you want to build and it builds it for you.
Yeah.
So yeah, very interesting, cool brokerage.
Alrighty, the next one that I have on our advanced option side is eOption. They have very low cost options trading. So if you already know what you're doing, you want a low cost solution, eOption is a potential solution for you. The very last one that I'm going to mention in our advanced options brokerage session is TradeStation. TradeStation is really designed and optimized for the active trader. So if you are trading intraday, you're in and out options. They also do stocks, and they're really well known for their futures content. TradeStation may be a good solution for you. All right, how is that for a recap, Neil?
I think that was pretty good. If I had a sound effect for applause, I would hit it right now. Okay, that works. All right. So you did have a question.
Okay, yeah, hit me with the questions. I've got an overview slide up too.
Okay, so Timothy, we're going to talk about options, puts, and calls and stuff like that a little bit later. So we'll answer all those questions. I'll even give you my own experiences with them, good and bad. Happy to do that. Explaining how shorting works. Yeah, we can talk about shorting in a bit. Actually, I think at this level, we'll actually use options to short. So those questions are kind of linked. Okay, so quality of.
Okay, go ahead.
Luke would do this whole event by himself if we let him.
Yeah. All right. Let me go on. Let me do a quick shorting lesson. But basically, what you're doing is Neil's pissed. But basically, what you're doing is you're betting on a stock to go down. You make money when a stock decreases. The way that it works is that you sell a stock that you do not own. So for example, if I do not have Apple in my account, I can go onto my brokerage account and I can sell shares of Apple that I don't own. Okay, so Apple is, let's say, $500 right now. My broker lets me borrow the shares to sell. I don't own them. My broker owns them. I borrow them. So let's say I sell one share of Apple at $500. I still owe my broker that share back. So what I can do is if the stock price declines to $400, I can then buy the stock back at $400 and say, here, broker, take your share back. I just made that $100 differential there. All right. Sorry, Neil, for interrupting your program.
No. Yeah. And disclaimer, outright shorting stocks, the way that Luke just described, carries a lot of risk.
Because you've got unlimited downside
strategy for a large portfolio.
Yeah, you can lose more than 100% of your assets. Because if Apple, if you're betting against it, it goes from 500 to 2,000, right? You just lost $1,500 on a $500 trade. So there's where the risk goes.
Exactly right. Yeah, and so there are some strategies using different tools or financial instruments to get around that risk that we can talk about a little bit later. This is a great list of brokerages. One of the questions that we had is the quality of fills versus payment for order flow. Sen, you're specifically asking about, is it worth paying for the commissions for trades because you get better fills? I think that can certainly be said. And Luke, perhaps you do. I don't have a robust answer for every single brokerage listed here. What I can say is that Robinhood, you are trading good fills for that simplicity. With Robinhood, you're not always going to get the best price when you do a market order. And the same thing goes for options. You're going to get something a little bit better, and something that's closely comparative to Robinhood is going to be a little bit better on Webull. And then these more established brokerages, when we do start talking about Thinkorswim, from TD Ameritrade, we start getting into Tastyworks, etc.
Yeah,
those
Interactive
fills are gonna
Brokers
be
is the
a
other one
lot
that I'd
better.
recommend if you're really worried about fills. The Interactive Brokers and the TD
Okay.
Ameritrade are two great options.
Yep. Okay, so Michael, in terms of losing that 1,500 on a 500 price stock, the idea with shorting a stock outright without getting too complex is, if the stock doesn't go down in the direction that you believe it will go down, you're going to owe money to your brokerage that's commensurate to the amount that it goes up. So the stock goes up, it can keep going up and up and up, and you're going to keep having to owe money to your brokerage with no ceiling on it. So that's pretty much how that works in a nutshell, without going into too many of the details. Probably the best option there would be to bet against it with a put option, so you have a fixed level of risk, which we can get into a little bit later. Does Robinhood sell your pre-market information to institutions? So Luke, you might know something about this. What I will say is that previously Robinhood's APIs have been open. So a lot of organizations, news organizations, brokerages, etc., other brokerages, institutions, have been able to use their data in terms of what are the most held stocks, what is the Robinhood only volume around those stocks, stuff like that. Which has gone into research reports, has probably definitely gone into trading decisions by big institutions. But they recently cut that off. I think maybe within the past week.
I think that they're still doing the payment for order flow. I think what was changed was the public access to that data.
Okay. So it used to be just open to everyone. A journalist could go in and pull it and pull some report, but now you can actually pay for it. So really the answer is yes.
Yep. But the other thing that I'll say
trading?
is, this is sort of a hot take / controversial opinion. Everybody gets worked up about this, right? My brokerage is selling the trade activity that I'm doing to institutions who can trade against me, et cetera. It really doesn't matter. Unless you're trading super actively, right? If you're scalping, you're making, 24 trades a day, and a 1 penny difference of your fill matters, and can hurt you, with such an active strategy. It doesn't matter, right? If you're buying Tesla at $2,000 because you think it's going to go to $2,200, does 1 or 2 cents hurt you on a $200 swing? And so is it not ideal? Sure, it's not ideal. But should you spend your mental energy thinking about that or being frustrated about that versus going ahead and picking the stocks, monitoring the trade, making sure that you're getting out at the right points, et cetera?
Yep. All right. And that's a great note to end on, guys. Yeah, we'll deliver something to help you sort through these if you want some more details after the event. Something I'll remind you guys, if you're not signed up for our the paper trading portion of the 3-week bootcamp, make sure you do that, so we can simulate trading and make sure that we're delivering you ongoing education and more mentorship, so that we can improve based on your
do we have
habits.
prizes for the paper trading competition? That's what the people want.
Yes, there are prizes. I will get into those, but we have to go on to our next guest from Schaefer. So Luke, thank you for your time. I'm going to give you the boot. Let's get one more sound effect, please.
Okay, hold on. All right.
Okay.
We got to wake everybody up. We got to wake everybody up. We're doing the air horn. Woo!
All right. That means where our next guest is coming in. Matthew Timpane from Schaefer's. Shelby, can you please cue him up? Luke, Hot Stocks Luke, thank you so much for going through those brokerages. That's a
Absolutely.
great list. I'm
And,
very
and if you
impressed
guys
with it.
haven't experimented with other brokerages, I'm a customer at 4 brokerages right now. I have tried maybe 10 or so, a dozen throughout my trading career. Try them out. Check out other things. You might find somewhere where you fit a little bit better.
Excellent. Thank you. That's a great note to end on. And what I will say is I announced the wrong person. Next up, it wouldn't be a Benzinga Bootcamp if I didn't mess up someone's name or announce the wrong person. Next up, we have Joel Elkanen from Benzinga's Pre-Market Prep, veteran trader, expert in the markets, horse racing lover. Joel, welcome to the show. How are you doing today?
Why were you guys even talking about shorting stocks?
Someone asked about it. Someone asked about it. And I tried to tell them.
Not
Okay,
only do I recommend not shorting stocks, if you have a sell key on your butt, well, this is old days. You used to have the buy and sell keys on your keyboard actually to do it instead of point and click. Rip it off or reprogram it as a buy button. Okay, so when you actually go to sell something, you actually buy more of it. Now, being a little facetious here, shorting is, in this market, I guess you have to pick individual issues. The one thing you got to remember is you do have unlimited risk, and your downside is whatever it goes to zero. But I just thought I'd tease you guys about that a little bit before we got started.
Yeah, and especially in this market too. Like if you're betting against companies, the next thing you know, they're up 10% on no apparent reason. So
right. And also just one thing along those lines, and we talked to many different people, many different guests on the show. And it's hard and it's not as exciting. But if you think that a stock is like reached a level and it's not going to be going any higher for quite some time, selling calls is obviously a tricky way to go. But some other people will talk about selling call spreads, is something where depending on the width of the spread is the amount of money that you could lose. And if the stock goes down, you take the money. And so there's a lot of ways to do that, but we're ready. We want to roll here and get started. We got the market open. I'll do a little screen share here for you. And first, before we go to the individual stocks and the markets, what I'm looking at here is the S&P 500 futures. And if you guys listen to the show, Dennis and I have a lot of debates. He likes, he doesn't trade the futures because they're too efficient. He likes the spiders. I think that they both work well together for arbitrage. And I think if anybody does a paper on the financial markets in March, in April or February, March, I think the interaction of the two really made the markets work well. But I'm going to get started. Triple D, you're not already here, are you?
I'm fast. I was late today. There wasn't that many positions.
Happened?
I got out fast for you guys. Usually I'm like 8:45, but I was like, I got to get out of all these positions because I got to go do this Benzinga boot camp here, and I want to be there for you guys. So I didn't want to make you wait 10 minutes. So I only made you wait 5.
Okay, so why don't we do, before we get to individual markets, we got 5 questions here that we're going to go over back and forth. And Neil, am I in control of the screen here? I am, right?
I see you. I see your screen, so I'm assuming you are.
Yeah,
it looks like pre-market prep.
Okay. Yeah, I wanted everyone to see your mug there while you're talking. But first, let's just start about, daily preparation, the time that you do for your trading day. Mine's a little different than yours. I'll go through mine real quickly, and then you can talk about yours. We can move on. I'm much more price sensitive than Dennis. And so my primary vehicle, as you see up here, is the S&P 500 futures. So the first thing I do when the market closes at 415, I'll get that closing price in the S&P 500 futures. I'll let things shake out between 430 and 5 because that is, you still get some action there. But the closing price is the most important price for me. And I will spend, depending on the market action, 10 to 15 minutes doing, my own levels, coming up with my own predetermined buy and sell points for the evening session. So, Dennis, you wanna tackle that question first?
Yeah. So in my prep my morning prep starts the night before, and if you followed us on pre-market prep, we talk a lot about overnight action, and I watch the after hours action, the stocks, to try to get a feel for where stocks might be going the next day. And I'm taking positions in trading. I trade headlines off the Benzinga Pro. I trade different types of arbitrage strategies, and I trade index arbitrage. I do a lot of different trading, but overall, I do swing trading as well, which is a lot of what our listeners are going to be interested in here today. Correct. I'm trying to identify the theme, trying to identify the driver for the day and the theme for the day to get ahead of the trade. Because if you're day trading and you can get ahead of today's theme, you're probably going to make more money more often than not. Now, sometimes the themes change, but being able to identify those themes early can make you some money. For instance, yesterday's action, and if you bring up the charts, Joel, if you want to show your charts again, because I think we're just showing our mug shots here. Yesterday we had some very big news from Abbott Labs. It actually came out the night before, where Abbott Labs came out about 7:30 at night with the 5-minute saliva test for COVID. So what does that mean? It means, first of all, that I'm probably going to, see a rally maybe in the next morning in the reopening trades, because if you just think logically through it, if you've got, a 5-minute test, well, that's going to be a big step into getting us back to reopening the economy and reopening a lot of these businesses. And what do we mean by the reopening trade? I mean the stocks that have been directly hit from COVID, the airlines, the cruise lines, the banks, the casinos. Those stocks are kind of all moving together. They are grouped together because of COVID, and we have called them on the show as the reopening trade. And then you have the stay-at-home trade, where you've got a lot of your technology companies that are benefiting actually from staying at home. You also have companies like Peloton, because obviously if everybody's staying at home, Peloton is going to be, doing better. Zoom, another one, Teladoc, TDOC. These are, some classic stay-at-home stocks. But yesterday's focus for me was to focus on the reopening trade. So what I was trying to do was buy some of those reopening stocks overnight and then selling them into the strength the next morning. So being able to pick up a Boeing, being able to pick up American Airlines, being able to pick up a Carnival Cruise Lines, all the night before. This was going back yesterday. And if you look at where these stocks opened yesterday morning, like Boeing, for instance, Boeing opened way up. Actually, it would have gave you another shot. It didn't even open that much. But if you look at the first 20 minutes, it ran straight up from 174 to 181. So there was a good opportunity there just by using the Abbott Labs news to get ahead of that trade. So if you can identify these drivers and know how they impact individual stocks, there's an opportunity for you there as a day trader. Now, later in the day, they came back down, but I was already long gone. And the reopening trade was on to a certain extent even here this morning. We were talking about it on pre-market prep, where you saw the airlines and the cruise lines getting bid up again. But again, it seems like this reopening trade only lasts for a day or two, and then they start to pull the rug out from under it and fly back into the technology companies. And we are seeing that rotation already happen to an extreme level here this morning. If you would have came in at 7 o'clock in the morning, you would have saw the IWM trading significantly higher than the QQQ on a relative basis. The Qs were actually trading in the red for a little while, and you saw the IWM trading up about 0.5%. That trade is completely reversed here now. Here we are 2.5 hours later, where the NASDAQ is actually the leader, trading up 0.45%. And you've got the IWM starting to roll over, trading up, opened at the high tick today. And you have the reopening stocks rolling over here once again, too. So these themes change, and you've got to be able to identify those turns as well.
Let me hop in here.
For sure.
You're jumping ahead. You're covering a lot here. I just want to go back to, like the daily preparation, like, okay, COVID is something that we've been dealing with since February, right? So that's an emphasis, the plays. Okay. A lot of times though, and what I do is, the earnings calendar. There's certain times during earnings. Stocks have pre-earnings runs. They have reactions. Strong stocks usually run into earnings. And then depending on the earning portion, sell off after. Not as much as late as we've been talking about analyst ratings. And sometimes that could be, but right now, the market is being, dominated, by what's going on with COVID. Just the other thing, just for a theme and just going back to something that we talked about earlier in the week, was the hurricane trade, and that was a very interesting trade. So we have a list of stocks. So when I'm thinking hurricane landfall, I'm looking at Generac, I'm looking at Home Depot, I'm looking at Lowe's, I'm looking, different stocks that benefit. You're looking at reinsurers. So and sometimes there can be 2 or 3, 4 themes in a day, but you have to be flexible, to shift. Like sometimes, it just runs out. Like, the Tesla theme never runs out, but like the electric vehicles, right? And another theme right now is, everyone has to own TikTok. So I just wanted to interrupt you for that and let you know that you look at the theme, you pick the theme, there's more than one, then you go just from trading and being in the markets for so long, what stocks to go to. So Triple D.
I mean, that's the name of, my game anyways, is getting ahead of the day trade. So getting ahead of the Robinhood traders, where are they looking? A lot of them are looking at speculative stocks. I'm not so much into the speculative stock, but there's natural rotation that is happening always. And identifying where that rotation, if you can get a little bit ahead of it, and the Abbott Labs is just a great example, which is why I went into the long-winded example. It gives you that opportunity to get ahead of the trade and make some money. The hurricane trade was another one, Joel, and this has been predictable for a long time. So, and you can write these down. These are good tips for you, for the next hurricane, or maybe the next, maybe there's not going to be another big one.
You want to create competition, Triple D.
Well, yeah, we're trying to create competition for ourselves too. I mean, I'm giving you good opportunities here, and different ideas, but, the 3 main hurricane stocks are Home Depot, Lowe's, and Generac, generators, GNRC. And they typically show strength when you hear about a hurricane coming. And they're strong a couple days before the hurricane. Once the hurricane hits, once it makes landfall, that trade typically comes off very quickly. I actually tweeted that out yesterday morning after we had the hurricane make landfall. And if you look at my tweet, when I was tweeting that, Generac was trading in the green, and it went straight down. And why was that? Because it was a crowded trade. There was a lot of people in there speculating that, hey, Hurricane Laura is going to be nasty. And, maybe we're going to, see a real pop in Home Depot and Lowe's and GNRC. So it got crowded. So you got to be aware the trade will eventually get crowded too. So really the play is to buy ahead of landfall and sell after it makes landfall. And it worked like a charm this hurricane season. I was able to make some money on it. So nothing works 100% of the time. So maybe they're going to do something different next time with the next hurricane. Maybe it's going to be more damaging, and maybe you'll see some follow through. But once it makes landfall and the damage isn't as bad as expected, the trade almost always comes off quickly. And if you look yesterday, Home Depot, Lowe's, GNRC opened high and closed relatively weak.
And also following in, if you're looking for, the negative side of things, which is not always a good thing to do, it's like the insurers and their reinsurers.
Yes.
I can remember, what was that stock that it dropped 12 points? This was during what was the one that hit?
Was that
Houston?
Katrina? I don't know if it was one of the big ones. It was one of the big ones.
Yeah.
AHL used to be one that I used to trade. It's gone off the board now, but there was like 5 or 6 of these. A lot of them have merged. One that's still there is RE, Everest Re. What a reinsurer is it's the insurance company that insures the insurance companies. So in the case of natural disasters, usually the buck stops with them. So typically, if it's a major disaster, you will see these stocks very, very weak. Sometimes going into the hurricane, it's the exact opposite, where you'll see weakness in the insurance companies. Sometimes you'll see it straight out in an Allstate, a Travelers, and an AIG, but it's usually the reinsurers that are really going to get hit. And RE is an example of that. So often you'll see weakness ahead of the hurricane, and then if it's not that bad, strength after. Again, RE worked like a charm, popping up, popping up the day that we found out that the hurricane wasn't that bad. But if you look at 2 days before Laura hit, RE was open at 221.25 and dropped 6 points in those 2 days. Then yesterday, it gets the wicked rally. And why did it get the wicked rally? Because the damage wasn't as bad as expected. And you saw, a big strong rally in RE, and obviously people who were shorting that are then scrambling for cover as well. So, and you see it too in the insurance plays to a certain extent too yesterday. I know Allstate had a decent candle yesterday. Travelers Group opened weak and then actually had a strong candle as well. So you did see it in the regular insurance companies as well. So it's just to be aware, that there is these themes, and those are the drivers for those stocks. And that's opportunities for you as a day trader to, look at the hurricane. How can I make money with it? Well, we just identified 5 or 6 different stocks that can use on the hurricane trade next time we get a hurricane.
And just going back here, drilling down, we're kind of skipping around here. People that are looking for, tactical ways to approach the stocks. Mine is pretty simple. We could go into that at a later time. But just for something like Abbott Labs here, and I'm just going to give you an example. I look at the pre-market trading. That's one thing I do in my preparation is I like to see what the stocks did during pre-market trading, especially since a thick stock like Abbott Labs, it trades a lot of size. It's going to have some institutional order flow. Chances are, if there's a big boy out there at 4 a.m, and a stock like Abbott, there's a pretty good chance that they're going to be out there during the regular session. So, the Abbott news recirculated overnight, and you got that initial surge at the 4 o'clock open. You hit 115.30. So right there, that is like a super, if I was long that, or if I was looking at options of that, that's a target, man. That is a great target for me. Anything near 115, 30, 115 even. And then what I like to also do, and this is the more of the morning preparation, is say, okay, what did the stock do yesterday, right? You had the news yesterday, you had some price reaction. And since you get a lot more liquidity in the 930 market, I'll say, hey, what did this stock do yesterday? How high did it get yesterday? Well, yesterday happened to be its all-time high at 114. You made that yesterday, and you had your all-time closing high at 111.29. So I'm like, that's a nice round number. It stopped there because there was some big boys there with institutional size. So when I'm looking at that simple technical analysis, looking at that off the open, I want to see what happens at 114. You had a little tractor beam play there. They sucked people in over 114, went to 114.09. Then everyone that bought the breakout at 114 had to scramble, and now you're back under. So it's just look at the pre-market highs. It's something I do in the morning. How's in relation to daily highs? And, different stocks have different reactions, but I just wanted to bring it back for a second to like the preparation, the night preparation, the morning preparation, part of what we do for the show.
I mean, again, so if we take it, like I said, my pre-market routine actually starts the night before. But once, what do I do when I wake up in the morning? Some people like to know, how do you start your trading day? The first thing that I do always is check the S&P futures and see, what is the market doing overall. And then I like to look, what is, is there any deviation between the NASDAQ futures, Dow futures? Dow don't matter, but NASDAQ, S&P. And then I look what oil is doing, but oil's been kind of muted lately, so there hasn't been much action there. And then I always look, and one thing I always like to watch is the TLT. And I talk about this on the pre-market prep show as well. The TLT is a great indicator for, banks, for utility stocks. TLT is positively correlated with utility stocks. It is negatively correlated with the banks. Why is it negatively correlated with the banks? Well, TLT is obviously indicated on interest rates. And when interest rates are going higher, that's good for the banks. If interest rates are going lower, that's bad for the banks. So when you see TLT up slightly here, and it was down earlier in the pre-market, it's not surprising that some of the bank rally that we saw, well, actually the banks are holding up not bad. They started rolling over just a few minutes ago, but they're starting to catch a little more life here just in the last 10 minutes. But there's definitely, overall today, maybe not a great example here. But if you see the TLT trading red by $1, you will usually see the banks showing some life because of that. If you see the TLT ripping higher a couple dollars, the banks are going to be weak. So that can be another driver that I use on a daily basis. I mean, COVID, hurricanes, these aren't happening every day. COVID is going to be, forgotten. Obviously, COVID's been happening in the last few months, but it's not something you're going to take home with you and use this for years to come. TLT in the banks is something I've used for years, where you look at that and you think, the TLT starts to puke. That's going to be good for the banks. So, that's a good indicator, at least, when you're trading the banking stocks.
All right, and little different routine here for me, and I don't not necessarily, I wake up early every time, but off the 6 o'clock open, I will have orders out there. And I will have orders out there with stops. So sometimes, or a lot of times, I'll peek at my phone overnight to see if I get executed and adjust a trade, because I know where, based on the analysis that I do, your trading day for today, started at 6 o'clock last night, and the equities reflect that until 8 p.m. And then between 8 and 4, it's the wild, wild west where anything can happen. And then stocks bring things back into line. So that's what I do. I check to see if I need to move a stop, or if I got hit, or I need to adjust it, or change a target. So that's for for the futures, it's a little bit different. But Dennis, you're hedged when when you go to sleep at night. So you're not trading the futures, between the SPYs and your stock. I mean, depending on the market situation, but
Yeah.
that's a little bit different between, we have our discussions about the spiders versus the SPOOs. They're both very efficient instruments, worked fantastic during the financial crisis. But I just wanted to bring that in more into a routine kind of thing.
And you're just quickly mentioning about being hedged. I trade what is called market neutral. And there's not a lot of traders out there that are going to be trading market neutral. Why I do that is I try to reduce market risk. If the S&P futures tank 30 points overnight, if I was biased long, I'm going to get slammed. But if I've got a hedge on using the S&P or the Qs, I'm hopeful that my hedge will help to minimize the damage from the longs in my portfolio. What I'm trying to do on a nightly basis, overnight, pre-market, even during the regular day on my trades, is I'm trying to extract alpha from a theme, from an opinion, from something that's happening. Just like I'm biased to be long Home Depot and Lowe's ahead of a hurricane. Well, if the S&P futures got slammed 50 points, Home Depot and Lowe's are going to be down no matter what, and I would lose money on that trade. But if I hedge myself by shorting SPY against Home Depot, in that case, then if the S&P futures fall, say 20 points, well, and if Home Depot's flat, I'm actually still making money. So that's why, I'm trying to extract the alpha from my individual opinions and individual strategies. I don't want the overall market to impact to impact me in a negative way. So that's why I trade what is hedged. So if I'm long $500,000 worth of stocks, for whatever reason, I might be shorting $500,000 worth of SPY against it. That would be a dollar hedge. Trading dollar neutral. You can trade beta neutral. If you're long really high beta stocks, you might have to short more SPY than you're actually long.
I just wanted to, we're probably getting a little deep into the woods here. It would probably be good for another session, but knowing all your betas, and I'm not talking, knowing your betas by, I need to do this. I got to look up at the beta. Dennis knows all the beta for his stocks, and he knows what index he needs to go into in order, like AMD. Go into the Qs or something else. So if you're going to look
at go in the SMH for an AMD head.
It's a little bit thinner. But if you're going to look at that kind of strategy, and beta, it's an important thing if you're doing this kind of strategy. It's also a good thing to know, your stocks and whether or not they have a negative beta. But that's the fact that you look at, the beta, it's something that you have to use. You have to know like the back of your hand in order to trade that strategy successfully.
And obviously I'm not telling you all to become arbitrage traders. I'm not showing. I know the majority of our listeners here today, some of them may be newer traders, some of them may be, but what I'm trying to do is give you a glimpse into what professional trading looks like to a certain extent. We're Bright Trading, we're doing different things. I mean, what is Bright Trading? It's this is the firm I'm at. If you look, stocktrading.com is our company. What is Bright Trading? It's a proprietary trading firm. And what we do is we supply capital to traders. If you think about and I'll just do a quick pitch here for Bright Trading, but just because people might be like, what the hell is Bright Trading? What the hell is this, this hedged trading you're talking about? Most traders at Bright Trading are trading market neutral. And obviously we do that for the reasons I just cited. But the main advantage trading prop is the access to capital. So if you look and you got like $10,000 in your account or $20,000 in your account, think about, how hard it is to make a living on $20,000 if you're going to trade for a living. If you think, oh, okay, I'm going to try to make $50,000 a year using $20,000 in capital. Well, that means you got to make 200% plus on your money a year. You got to blow away every other money manager that's out there. So it's very difficult. Where Bright Trading, you come in, you put your deposit with the firm and they supply you with capital. There you can have access quickly, and obviously not quickly, but you can have access to a significant amount of money to be able to make it work. And that's what Bright Trading is. So that's what proprietary trading is. But we try to do, minimize risk. I mean, that's all trading is. If we just forget about, everything we just talked about, when you're into day trading, the whole name of the game is minimizing risk. Because the last 3-4 months, you haven't worried about minimizing risk because the market is going straight up. I mean, the S&Ps since March have went up 50%. The Qs since March went up like something like 70%. Everybody's making money when the market's going straight up. Everybody. So you got to ask yourself, are you a good trader, or are you just benefiting from a market that's been going straight up? And how are you going to perform when the market starts going down? And that's, going to be the difference. So because everybody, if you're long biased and you're only doing longs and not doing shorts, you're going to be making money when the market's going up. So are you really extracting alpha, or are you just benefiting from an up tape? We're going to have a down tape. Stocks don't go up forever. And there will be a market.
Yeah, they do.
Well, that's what Portnoy says, but they don't. So we've seen different types of tapes. And if you started trading in January and February, you would have had a much different story than if you started trading in March, because obviously the markets got crushed in March to the tune of 35%. So you think about that, if you're on 2-to-1 margin, there's a possibility you were in the wrong stocks. You blew out your account in March. So that can happen. So that's why, I'm just talking about the whole hedging strategies and how to minimize risk to a certain extent. And I'm not saying you need to do that, but you need to know where your risk is, because right now people aren't focused on risk. They're focused on return. And once again, risk will come into play. So you've got to be careful, just buying Tesla when it's up 100 points, because it can drop in a hurry as well. I mean, stocks don't always go up.
Okay. All right. Moving into information and how you get your information. Dennis, you've used a lot of different things over the years, and boy, oh boy, have things changed since I can't remember. What was that? What did we have in the Bright office? What the hell was that?
Well, we used First Alert that we had, which was a scanning software. So we had filters that were running, searching the market for certain criterion. We also had, obviously we had the Squawk Box to provide us quotes, about where the S&P futures are going, because the S&P futures seem to lead everything. And then other people had, different, styles of trading as well. So, charting is one thing, and people very much rely, you're going to these boot camps and you're going to different, everybody's talking charts. I will tell you, 90% of my trades, 90, not 9, 90% of my trades, I don't look at a chart for. So it gives you a feel for how much I really put. Swing trading, I kind of look at charts, but I don't need to look at the chart of NVIDIA to know what it looks like. It's straight up. I don't need to go and people want to use tick charts, and they want to use these short time frame charts. I mean, it's so hard to develop consistent strategy or consistent revenue using tick charts and using these small short term. You get caught up in the noise. All I want to know, and I teach my technical analysis to somebody in under 30 seconds. I'm going to teach it to you right now. It's support, resistance, and trends. That is the bulk of what my technical analysis is. That's it. There's no moving averages. I don't use any of that. I don't use, any of these funky indicators, none of this other stuff. If it works for you, by all means, continue to do it. It has never worked for me. I just need to know, is the stock in an uptrend? Is the stock in a downtrend? Is it at support, or is it at resistance? If it's in an uptrend, I'm buying dips. If it's in a downtrend, I'm selling the rips. That means I'm selling the pops. So because the strong get stronger and the weak get weaker. So when you get a pullback on NVIDIA, I'm biased to buy it. When you get an uptick on some of these, stocks that have really been, out of favor here for a long time, you could even say like a Kohl's or something, I'm biased to sell it. And, that's overall in my theme. And certain days, maybe I'm going to be long Kohl's. Maybe there's a reason. Maybe the reopening trade's on there. But other things being equal, I'm long strong stocks and short weak stocks.
Yeah, let me just take off on this a little bit because I did, I talked about, as far as like daily tops and daily bottoms and triple tops and triple bottoms. I think what people sometimes tend to ignore is consolidation periods. And
Very important.
if you look at, my numbers aren't perfect there, and this is a pretty big mover here, but over the last 4 or 5 days, this has been in a trading range, and it's only been like a 15, 16 point trading range. So that means, and if you're looking at the trend in this, the trend in this stock is up, has had a consolidation period. You have to assume, or you don't have to assume, but hey, this is just consolidating again to go higher. So you're patient. You look at the all-time high. I missed it by a little bit there. It's at 1650. And different kind of people are range traders. And they're like, maybe they recognize that this is a range for 4 or 5 days. If you would have picked up on this earlier, and maybe you're buying at 503, 504 and trying to sell at 512, 513, just because, you're not going to get the top of the range, and you're not going to get the bottom of the range. On the other hand, if you've been long this stock for a period of time and, you're like, man, it can't go up forever, then I look at the bottom of that trading range, nice round number, like 500. Your next daily low comes in at 487.81. So it's important to look at the tops and look at the bottoms, but the consolidation periods, are important too. We got a question coming in here. And this is a long one.
Okay.
How is one to identify that a stock price will increase momentum will continue the following day after news? Either buying using dollars versus, that's a long question.
So I'm just thinking the question to General, I believe they're just asking, how do you know the momentum's going to continue? You don't. You never know the momentum's going to continue, and things can turn. I would say once the trend is broken. So if you're in a stock, and the one chart that I use the most out of everything is the 90-day, and I think Joel, you kind of lean on the same thing, don't you?
Yeah.
To get an overall feel, am I in a strong stock or am I in a weak one? And if you look and the trend, and you take your, we always joke the Jeff Mackey purple crayon. I always love Jeff Mackey when he say that on CNBC. We draw that line, and you can clearly draw a line in NVIDIA. And until the line basically breaks, the trend, then I'm biased to be buying it there. And that's when, you see these turn, when, you get an ugly red candle, the shakeout candle, and then it's got some work to do to try to get that trend going up again. But, obviously you never know anything, and no strategy works 100% of the time, which is why you need to stay diversified in your trading strategies as well. I would never say put all my eggs in one basket. Let's put 200% of my money on this one stock. Because what if it gets halted? And what if it comes out with bad news? Or what if you're short a stock and gets taken over? You will still want to stay diversified in your portfolio. So nothing works 100% of the time. But, back to the original question, you ride the momentum. It's the type of market we're in. Sometimes we're in a contrarian market where it's just chop and you're selling rips and buying dips on both sides, and it's working. That was working back in May and June, really, on the S&Ps, because we had, this run. We had the big sell-off in March, then we had the big rally in April and May, and then we consolidated for a period of 2 months where we were just chopping around. Well, contrarian trading was kind of working then. We're back to momentum trading. The last month and a half has been all about momos. It's been all about, buying the winners. Look at Tesla. It's up every day. If you've been trying to short Tesla, you've been wrong again and again and again. You get a down day, and they just come back in the buyers once again. Eventually, that trend will break, and we will have the split trade on. Is the catalyst going to be on Monday? We know that the stocks tend to be strong ahead of splits, and week afterwards could have a down day on Monday. It's possible. We don't know that. Nothing works 100% of the time. Statistics show that prior to a split or prior to a stock going ex-dividend, it shows relative strength, and afterwards it shows relative weakness. That would think that Tesla could potentially top out on Monday morning. Will it happen? It doesn't have to happen by the book. But if I was playing the odds, I would say Tesla probably opens fairly strong on Monday because everybody's excited because it's a lower share price and they can jump in and buy. And I wouldn't be surprised if actually Tesla ends up closing red on Monday. So, long story short, momentum can continue for a long time unless there's a catalyst to take it away. In the case of a stock like Tesla, there is a catalyst. It's the split. And that's going to be a game changer. Whether that's going to break momentum or not is still to be determined, but it has the potential to break the momentum.
Yeah, and just addressing the first part of that question a little bit closer. One thing, we talk about is like a 2-day move. So, and just using CRM for an example here, it had the momentum. It got the good news about the Dow, and it had a very good trading day, right? Then it had great earnings, right? So there was another catalyst. So chances are, strong stock breaks out, has good news, has a potential catalyst. There's a couple other things going for you. And so a 1-day move could be a 2-day move, could be a 3-day move, etc. But a lot of it, a lot of times, and Dennis, you will play this a lot. If a stock breaks out, it's strong, and it's just kind of like, people that aren't following the markets all the time, they're like, wow, I got to own CRM. And they'll come in, they'll call their broker or they'll put an online order and you get the follow through the next day. I mean, the best indicator, though, is the previous day's high, the previous day's close. If you're not if you're not watching the markets intraday, then maybe keep an eye on the all-time closing price, the all-time closing high price, because that's what the institutions are looking at. Or you could just look at the dailies. Now, for CRM right here, it had a hell of a run. It's obvious someone's trying to work out of some stock here. They've had, we had 3 highs. Looks like 275 has been the number the last 2 a little bit higher than that. You got 3 highs in the same area, 275, 75, 78, 28, 77, 97. Someone's trying to work out of some stock here. So if it goes back to that area, which it doesn't look like it's going to go today, then you have, you're relying on your daily levels. The other thing was asking here about using dollars versus shares. I think that all depends on, your account, the size of the account you're trading, your margin limitations. So that's kind of a broad question.
There's another good question there, though. How do you time your entry without a chart? I think a lot of people, especially newer traders, that's their tool that they go to in their toolbox. So again, if I'm trading, breakouts and stuff, and I'm looking for swing trades, I probably am looking at a chart. But when I'm looking for day trades, when I'm looking for the short-term money flow, and a lot of people are interested in becoming day traders and short-term traders. I mean, I don't care what the chart looks like. When that Abbott news breaks, it's good for Boeing. It's good for American Airlines. I'm just going and buying offers. I'm just going and lifting offers after hours on that because this is going to probably drive those stocks up tomorrow. I don't care what the chart looks like. The chart is meaningless to American Airlines for overnight here because it's probably going to be up because this is potentially good for reopening. So just understanding how the news coming through your Benzinga Pro impacts stocks. There's trades off of that. I mean, you have people that, say this, you cannot trade off headlines. That could not be more incorrect. That could not be more wrong. I make my living trading on headlines, and understanding. Do I make my living, buying a stock that gets taken over, stock XYZ gets taken over for $50, trading at 45. Well, I'm not going to be able to buy it at 45.5, 46. The high frequency traders are all over that. It's on news interpretation. Stuff like Abbott Labs, the algos aren't programmed for that. They aren't programmed to go automatically go buy Boeing, American Airlines, and UAL unless they're very, very sophisticated.
They might be listening now.
They might be getting to that, but it takes a long time to program that stuff in to know. So there's that opportunity for you having a human mind to say, hey, Abbott Labs, 5-second test, this has got, or 5-minute test, this has got to be good for those reopening stocks. And there was a lot of money to be made there. And I made some money trading those themes off that. So that's one example of why, in that case, I don't care what the chart looks like. Those stocks are probably going to be up tomorrow. If the TLT is tanking and it's down $2, I don't care what the Bank of America chart looks like. It's probably going up. So I'm going to be buying that as the TLT just starts to puke. I'm going to turn around and start buying banks. So these themes in this rotation changes daily. And, if you're in and out and, maybe you don't want to be in and out, maybe you want to be a short-term trader, maybe you only want to make one trade a week. Well, then you can take your time and you can look at the chart and you can look at all these things. If I go and, I want to, all of a sudden, the TLT just for whatever reason, some economic data comes out or somebody says something, TLT falls $1 and you see it fall. If I take my time and go look at the Bank of America chart and Citigroup chart, I've missed the trade. I can't take my time and go look at it. I got to go buy those offers right now because I'm moving in this. You're trying to trade on that.
Too. From the words of, Bob Bright and Don Bright, rest in peace. When a stock's going up, they're not hitting bids. You got to lift offers.
Yes.
You got to be aggressive, and you got to, I mean, if this is the kind, if it's, a half bid at 75 and you really want to own the stock, maybe, depending on the news and the beta, you go 85 offer, you go a dime above the offer, you're going to sweep out the book. You're going to sweep out everybody until 85 and get your position. You go bid at 75 and there's news. If it's really moving, you're not going to get it. Conversely, if a stock's going down, you got to hit. If it's really going down, you hit the bid, man. If
you think it's going to go down, if you're on a headline trading is completely different. And we're not telling you all to become headline traders. You're competing with people like me who've been doing it for 20 years. So it's not that easy of a game. But you understanding, even if you're just a swing trader, if you understand these relationships to a certain extent, you might say, oh, I love this Bank of America setup. This chart's looking really good. I'm going to buy some of this today. And the TLT is ripping higher that day, you're going to be on the wrong side of the trade and you're going to lose money. So, I don't care what the chart looks like. If the TLT is up $2, Bank of America is likely, not 100% of the time, today, it's likely to show weakness. And look what's happened here. Just as we've been talking on the show, and, I said, the TLT, is showing some strength here. And I'm like, oh, that's interesting. This is one of those days that the banks are starting to show some strength too, which isn't normal. Look what's happened. The TLT starting to show some life. The banks have all rolled over. So here you are. Bank of America has went red. JP Morgan has went red. Goldman Sachs. This is just from when we were talking 10 minutes ago. So there was an opportunity there when you started to see the TLT show some life because it was down in the pre-market and starting to go green and showing some strength, that, these banks that are bid up on the day are likely not to hold because it's a whole interest rate factor involved. I mean, yes, you have the COVID play that's a certain extent that's affecting the banks because they have a lot of small businesses. But really what drives, is these banks are squeezed. With rates as low as they are, they're very, very squeezed right now. So that's why TLT is a good indicator for trading the banks. And, people say, well, I don't want to trade the banks. They're boring. Why do I want to trade boring? Boring pays the bills. I will tell you, I make my living trading boring, not exciting. And if you're out there, you want to be in the stock that's going up 200%.
Kodak.
I want to be
buy Kodak, Dennis.
Let's go.
We got to buy Kodak.
Well, you can get hot. You can make some money quick, but don't get caught with the hot potato, because when they pull the rug out from under it, that hot potato is going to burn you. And this is what's happened with Kodak. Look at it now. And you know what I said? The stock was $17 or whatever it was. And I'm like, I don't know where it's going. I don't know when the pony ride's going to stop here. But when we look at this thing 6 months from now, I think it's back to $2. Well, now it's $5. And I'm going to say today to all you listeners out there, I believe that Kodak within 4 or 5 months from here is going to be back to $2. So if you're coming here and buying Kodak at $5.75, I believe you are going to lose money, because I think this was all just the fluff of that. Obviously, this government contract, and now there's all kinds of issues there. So anyways, but that's a long-term, trade, and that's a long-term thesis. And it was a hard stock to short. We know Luke Jacoby was playing with through puts. Good job, Luke. But I mean, there's, a lot of different ways to make money in this market and a lot of different time frames to make money in this market. Today we're talking to you about short-term trading. Some of you might be interested in getting into that, and that's why we're focusing on, maybe in the next boot camp, we'll focus on long-term investing if you guys want to talk that as well. But today we're trying to talk about the little intraday themes and, and how to make the quick money, but making it, by trading maybe more predictable strategies.
One question here, not really in our wheelhouse, but I'll bring it up. Do leaps have an advantage or a middle ground between buying stocks and options? And man, it's good. It's good. And I think Jason's talked about this on the show. It's good going out long term, right? In the leaps,
get that time value erosion.
But man, you got Mr. Time, working against you, and the leverage is sexy and everything. But man, maybe a best strategy, if you like a stock and you think it's going up, buy a little of the stock. then you're going to be rewarded if it goes up. If you, want to have some longer term, plays on it, then, use some leaps too. I just want to bring up the S&Ps right here. We're kind of at an interesting level. The overnight low was right in the area of the close, and that was the old time closing price at 85 and a quarter. We just took 84.75. One of my other strategies besides the overnight strategies is really focusing on these overnight ranges and perhaps getting a breach of the overnight range. Obviously, the breach of the overnight range on the downside has not been productive, but a lot of times when you breach your overnight ranges, you get good follow through, and that's certainly something that worked in March and April. But just trimming the edges here, I think that it's here you are, you take the 84.75. So for me, for the Bulls, they gotta get back in control here and get this thing, back over or 30, 34.90, 34.91, or you just might have a little midday drift there. But just wanted to bring that in live action on the on that pre-market low.
So
All
taking
right,
us,
Dennis, where are we at now?
we can go
What is
wherever
your
you want.
contingency plan if your trade goes wrong, Dennis? And I know what that is. What
I
is
get
your
out. So every single trade that you enter, and this is about discipline. This is when you'll take, like I said, in the last 3-4 months, you haven't worried about contingency plan because if you're long bias, stocks going up, you're probably making money unless you're picking really bad stocks. But I mean, overall, if you want to look at trading, and maybe not as a career, but more as maybe a serious side thing to do. It's all about what you're risking is going to define you. It's going to be about how much you lose on your losing trades, not how much you win on your winning trades. If you are always letting your, cutting your winners and taking 10 cents off this, 10 cents off this, and then losing $1 on, your losers, or losing, or just holding on to your losers until they come back. And so many newer traders will not sell at a loss. Eventually, you are almost guaranteed to lose in trading. If you are not willing to cut your losers, eventually you will lose in trading, almost guaranteed. And that's a scary thought for a lot of people, but I've seen it time and time again. They'll have 90% win rate because those trades often do come back. But those 10% losers will be so big that eventually your portfolio will inevitably be full of losing positions. So, and why does that happen? Because you're always cutting your winners, and eventually you're going to get one wrong, and you're going to get one wrong that doesn't come back. And, and if you're adding that loser and then it's going down, and then that's taking your mental capacity, it's going to start eroding not only your trading capital, but your mental capacity as well. Your trading capital there is, obviously getting hit too. So eventually, if you're always cutting your winners and holding on to your losers until they come back, your portfolio will inevitably be full of losers, and eventually you will probably lose money overall.
Yeah, one thing, a little bit different between our styles and stuff is two points I like to make is I pretty much have hard stops, so if I'm in and sometimes, the relief of, hey, I'm wrong, boom. Sometimes it happens immediately. Sometimes it takes a while, but there, I'm executing. The other thing I don't think that people take advantage of in this market is initiating trades on stops. Now, Dennis, I know you don't do that, because you're right there clicking. But if I have a designated area, for a breakout or a breakdown, a lot of times, I will catch it. I will catch with a buy stop. I will catch the upward momentum instead of trying, okay, well, it went through my breakout point. Now I'm going to sit a bid there. Sometimes it never happens. So if you're going to be actively trading, I don't know. I know that execution that you get in the futures, not sure if it works perfectly in stocks, but stops are just not for losses or to protect gains. You can use them to initiate trades as well. And you'd be surprised how quickly you can get initiated into something and then it's going your way as to trying to, humanly, react to it.
What a great point that we've maybe never mentioned on the show is that you could use stops as an entry. I mean, that's a good point. You could do that actually. And, and obviously,
depends on your vehicle.
depends on your vehicle. On the S&P futures, it's so liquid and it's so, that you're not scared of when that stop order becomes a marketable order. But, it's an interesting idea. You can, if you've got this, a stock and like if it starts to break out over this, I want to buy it. You could put a stop buy on there at 20 and it would buy it. So, that's interesting as well. It doesn't always have to be to protect your capital. You could actually use stops as an entry. So interesting.
Make use of the, if you're trading a biotech stock and there's news
thin,
on it.
Yeah, you don't want to be using stops in that. But if you're trading something that's thicker, like an AMD or like you said, S&P futures or even the SPY, on a technical basis, maybe that's not a bad idea. And then you don't have to watch it and it'll automatically get you in there. If it goes up through your level. You can have alerts set, and you can have different platforms are capable of doing that internally as well. But it's interesting to think about that as stops as an entry and not an exit.
Before we get to some more questions here, Dennis, and you're usually far away from your desk by this point, and something we'll be touching on later. But from the turn, from the morning, a lot of times right now in stocks and really in futures, the bots got pretty good control of these markets. They know, they know where the orders are. Right. The big orders, they're out there sniffing the big institutional orders. So the people are picking up a lot of pennies here, and a lot of that picks up at like 2:45 or 3 o'clock. But anything you've seen, you mentioned that, the rollover in the TLT, just for me, one other thing, when, we got to unchanged there for a second, and it looked like we were going to breach the bottom of the pre-micro range. The only thing I need to do to discourage a short on that one was look at Apple, Microsoft, Amazon, Google, and Facebook.
The leaders.
Right there, 25% of the index. So am I going to get out to sharp scalpel now when, 25% of the actual index is trading in the green? Maybe I won't not necessarily buy it, but a lot of times I'll look at that and say, hey, what are the big boys doing? And right now, big boys are doing what they always do.
The big boys will lead sometimes. And, and even Tesla, looking at that, it often will lead. If you see Tesla all of a sudden start to roll over, you will inevitably usually see at this time, and Tesla is just your leader of leaders right now. So even if you don't trade Tesla, if you're trading tech stocks, keep Tesla on your screen, because if Tesla starts to show strength, you see it roll into Amazon and Apple and Netflix and Nvidia, and obviously not 100% of the time, but there is definitely a correlation there. Tesla all of a sudden gets slammed like it did to the tune on, when was it, like 3 days ago, that they pulled it out. They pulled 200 points out from under it. It's actually last week, so it was a little while ago. It's been a long time. If we go back to the 17th, but that day Tesla opened strong on July the 17th, if you show the chart, Joel, and it rolled over hard. Actually, no, I'm on the wrong day. Sorry. I'm looking 5 days ago. So August 24th. I was on the wrong month. August 24th, 21:26 it opened. And they pulled the rug out at 200 points. It fell in 10 minutes. And if you look at the other techs, they lagged a little bit. So there was an opportunity for you to short Amazon, for you to short, the Qs if you wanted to, for instance, shorting Apple. And they all started to roll over too. Tesla led the way. And then Tesla obviously caught a bid that day, and it's been straight up ever since. And if you look, and obviously the NASDAQ has turned around there too. But there's opportunities there just to use Tesla as an indicator right now for trading Apple, for trading Amazon, for trading Netflix, for trading Nvidia. Tesla has been leading the charge for a while, and it's going to be a big, important day for it on Monday. How does it trade post-split? Does Tesla continue the rally, or does it turn over like it has in the past, like how stocks do typically after a split, and start to roll over? Because if Tesla starts to roll over Monday, and Apple will probably follow suit, it's doing the post-split as well. They're both going post-split on the same day. You will likely see some of the other leaders roll over too. Not saying that's going to happen, but if it does, you want to be prepared, and there's opportunities there to take advantage of that lag.
All right, we have a kind of a market structure question here. I think pretty basic one. I'll give you my take on it, and then Dennis, is there a virtual queue where you can put a buy order for a stock? Now, things have changed, right, from GTC orders. It all really depends on your broker, but if you want to buy Walmart today at 138, no matter what, for the next month or so, you can put in an order good to canceled, right? And I would check it to see when it goes ex-dividend for the adjustments. But, for all your brokers, they must have that good till canceled option.
Yeah, you can leave that order on the books for a longer period of time. Usually they cancel out 3 months, depending on your broker. but you can ask your broker about that question. But I'm not sure if that's what the question was referring to, or
I
if he's
think
just talking
so.
about different exchanges. Like there is a queue, obviously. The one thing, and if you go back 20 years ago, 90% of stock trades occurred on the NYSE. So you had to wait in the queue. Now there's 13 different exchanges or 14 different exchanges, one still to come. Dark pools, all so many different places. So yes, there is a queue. I mean, if you bring up a stock like Ford, you can easily see the queue where there's 689 to 690. If you put an order to buy it at 689, which is on the bid, you've got to wait behind the other orders on that exchange that you went to. The way I try to hop the queue, if you're looking at hopping the queue to a certain extent, you can see on Ford, it's 689. There's 76,000 to bid on EdgeX. Well, I'm not going to go bid on EdgeX because I'm behind the other 70,000 there, but I can go bid on like NQBX, which is Boston. And it's an inverted exchange, and this is getting market structure-y, but it's probably going to fill me very quickly. So if I go bid 689, somebody's going to hit that stock right away because they don't pay what's called a take fee. They actually get paid to take on that exchange. And that's why, that's one way to get around the queue. But yes, the answer to your question is not a virtual queue, there's an actual queue on each different exchange. So when, Robinhood, you're sending an order in there, they're controlling the routing. You're not picking your destination. That's the disadvantage to being at some of these smaller brokers, is that you can't pick your destination. You just send it and they do all that for you. I can actually, and obviously at a lot of different, Interactive Brokers, for instance, you can control your routing. So, that's a question to ask when you sign up for your broker. Can I control the routing, or can I control the routing? Because I'll tell you, at Robinhood, they're going to put you behind the rest of the queue there, probably if you're sitting there at 688, because they get paid to take. So they want that extra take fee. Free trading is free trading for a reason, because they're trying to make money on your order indirectly by getting the exchange rebates that order generates. When you buy 1,000 shares of something and you sit it on the bid on Arca, your broker will actually make $3. They can make up to 30. It depends on their rate, but they can make up to 0.3 of a penny. So you sit your bid out there at 688 for Ford. Your broker will get paid $3 if that gets executed on the bid. If they put it on NQBX, they're going to actually pay $1 for that. So they're not going to do it that way. But I'm going to get a faster fill. So that's the disadvantage of obviously free trading, and that's some of the hidden costs.
All right, S&Ps did bounce off that close. I just one other thing here. We're coming near the end of the segment here, and this is just if you're looking at stocks, introducing yourself to day trading. For New York stocks, one thing that we've learned over the years is those opening prices could be pretty important, either for reversal or for a continuation of the trend. For example, in Walmart today, you had that new all-time high. You opened up at an institutional level, 141. If you bought that off the open, you felt good for about a nickel. Then it came back down to the open. Walmart has been in retreat here. So there's using the opening.
Sell the news trade.
Yep. So there's just one quick thing. And then we also talked about, what was that stock that had some super bad news on it and it was getting crushed? Earlier in the week, was it a retailer? Oh yeah, it was Children's Place.
Oh yeah.
Yeah. And we talked about it on that day. It opened lower and it just kept going lower. There was a trade when it came back up through the open where you could have got 50, 75 cents on it, but it wasn't it was much later in the day. When you're doing those kind of trades off the open, you want to see that,
This was a trade. I can just summarize it quickly in 20 seconds.
Sure. Go.
This is a trade Joel Kahn taught me 20 years ago. And when you're looking to buy, stocks open down 20%, I want to be a buyer here. You don't want to just buy it off the open because there might be follow through. What I often do is if I think there's a chance for a reversal, sometimes it doesn't happen on the opening tick. So let the stock open and I set up a trade. If the stock opens at $20 and goes down to 1950, if it comes back up through 20, then you can see that the strength is with you all of a sudden. And if it comes back up through that opening price, there's sometimes an opportunity there to strike as opposed to striking off the open. And in this case, it would have saved you money, because if you were saying, I think Children's Place is going to rebound, I said that, I never got executed because the stock opened and tanked and never really got back up through that opening price until hours and hours later. So the trade would have never really occurred.
You avoided a loser.
you know, I avoided the loser by, you know, that strategy. So sometimes, you know, a good trade is just avoiding a loser as well. So anyways, we are out of time though. So if you're more interested in this kind of stuff, listen to us on Benzinga's pre-market prep. You can go to benzinga.premarket.com, or you can just listen to us on YouTube Benzinga. We're live there every morning, 8 to 9.
Yep. And in the afternoon sometimes too, right?
And
Yep.
Joel, yes. Joel and Spencer are live at 3:30.
Yep. Spencer has a lot of good trading ideas, and as important as the open is, the close is very important too. Talking about imbalances, and then also if you're confused about us talking about technicals, or you don't understand, or you see charts with all these lines and everything, the closing price of any instrument you're trading is the most important thing. So just keep an eye on that, and also if it's red, working right against you, you're probably wrong. If it's green, you're probably right. So they're your two best indicators: your closing price and what your P&L is telling you. Neil, you want to wrap it up?
Yep, as simple as that. Thank you guys so much, Joel and Dennis. Catch them on Pre-Market Prep. Also catch them in that afternoon show. Very easy to get to them on YouTube, as they said. Also on Benzinga on the pre-market section. Guys, thank you so much for spending time with us today.
Thanks for having us, Neil. We appreciate it.
Great. All right. So you guys have a great weekend. We are on to our next guest from Schaefer's. We've got Matthew Tim Payne here to talk about stock pick analysis. This is a favorite that we've had at every boot camp so far. Matthew, do you hear me? Are you there?
Yes, I do.
Wonderful. All right, man. I will get out of your way and let you go on with your presentation.
All right. As usual, we have a bunch of charts to rip through. So we're doing something a little bit different this time than we typically do. We wanted to kind of look at a little bit more broader market perspective here as we're heading into the fall, where we can possibly expect some volatility, and with the fall elections as well. So quickly, we will just look here. And we're going to look at some sentiment and some seasonality, some macro and some intermarket analysis quickly, ratios, and we'll have a few bonus trade ideas in there as well. So we'll try to keep on topic as we're used to. So just quick chart here is the S&P 500 and the U.S. presidents. As you can kind of see, they both have had both bear markets and bull market runs, depending on the party. So we don't really believe as much in the, what party is controlling how the markets will be affected. So that's something we're not really exactly looking at, but it is a fun chart to have up here. We are still kind of perplexed, though, by the sentiment divergence. We think it's obviously due to all the new option market participants in the options market. As you know, total volume in the options market has skyrocketed with lower commissions, basically nothing. So it's become frictionless and nobody having anything to do. So, we're behavioral based type people. We are kind of always gravitate towards action. So without the sports, without events and activities, people have gravitated towards the markets for that action. But to share a little bit more sentiment, because we did share that one last time, we have the National Association of Active Investment Managers. The last time we've actually had 3 straight readings of above 100 occurred in September 2017 and October 2017. We just had that happen again. So what does this kind of tell us? Well, we are kind of likely due for a pullback or a correction here, probably within a month or so. But as you can see, kind of when you have these sentiment shifts that go from one extreme to another, like 2009, 11, that 15, 16 area, a lot of the times that's signaling that we're entering a new bull market cycle. So even if we get a pullback, we're still pretty constructive on the market, intermediate to longer term. One thing that we would be looking for on a short-term basis for that pullback is looking at this VIX 20-day buy to open call to put ratio. Now, buy to open is market participants buying to open these positions, and market makers are selling them this. This is proprietary or data that we use here, and we make this kind of indicator in our house here at Schaefer's. So what we've done is we've quantified when it goes above 5.0 is where we're kind of really looking at for a volatility surge. Somebody's coming into that market buying a lot of VIX calls at that point. They've been right a lot of the times. So above that level, you start getting sketchy a little bit about that, looking for a volatility surge. And it typically, though, the timing is tough. So you're looking at anywhere from like 2 weeks to maybe even 4 weeks when you're looking at this. So let's go on to seasonality. We showed this last time. This is why we were very constructive on August. We thought, August was still going to be very bullish. Last 10 years haven't looked good, but, presidential election years, August has been extremely bullish. So as we head into September, what is that telling us? Well, last 10 years, it's actually been very bullish. But as every strategist kind of says on Wall Street, it's the scariest month, one of the worst months of the year. It's down on average about 1%. But in presidential election years, not so bad, only down roughly 32 bips. So, what we're kind of thinking is going forward, what's going to happen. I kind of looked at it on a more granular level, and we kind of see the dips start happening in weeks 2 or 3 when it is a presidential election year. And they remain fairly bullish the first, week or 2. So we're still kind of constructive until about mid-month, and then we'll start kind of watching out. And here's another reason why we're kind of looking for this pullback. So as we've kind of discussed, we were looking for and getting very constructive on the S&P 500 to go back and test all-time highs. It's obviously broken that. We do think there is some upside possibly to about 3,600 still in the very near term. But, we did start having some doubts, that we are kind of long in the 2. So when in doubt, zoom out a little bit on the chart here. You can see we're in a big broadening formation. We are kind of getting close to that upper trend line there. So there's a chance to maybe pull back to that 3250 area. I did overlay that 200-week moving average on there just because how important it was back when we regained this. Since the 1930s, this 200-week moving average has called market bottoms, and in bear market rallies, it has called rally tops. So it was extremely important. This is just another reason why we're still pretty much constructive longer term here on the markets. One thing that will be of a concern is, this has really been led by a lot of large caps, top heavy indexes. I'm sure people have talked about this. You can see this here in the S&P 100 divided by the S&P 500, the ratio here. We were kind of in this low range. It never really got oversold, and now we've broken out. So that is very constructive. We would like to see breadth continue to follow through though. And as you'll see here, the equal weight index versus the S&P 500 has been definitely not as bullish, and we would like to see that strengthen, hopefully maybe here off this bottom. The Russell 2000 is also another ratio divided by the S&P 500 has kind of broken down. So that's a concern here in the near term that we think, you could get this pullback, and microcaps look kind of similar as well. One thing that does keep us pretty constructive though longer term is transports versus utilities. It's broken out of that downtrend. It does probably have some resistance coming up here ahead, but it is looking good, and you could probably see some industrials fall through as well on a cyclical trade. Here's a bonus idea. We do like Greenbrier Companies, GBX. It's got high short interest. The open interest ratio is also 1.53. So there is some pent up frustration there with put buyers in it. And, other names that we've liked in this area that we've been playing is XPO, CHRW, UPS. So transports have been working well when you're looking at more of the shipping side of the industry. The dollar was a chart we showed up last time. Just how important this 80-month is. It's a huge pivot point we were discussing. It is now broken below, as we discussed, could potentially happen. And that kind of leads us into our next trade idea. Gold, we're still very constructive on it. We think it's coming back in. When you look at a relative chart to the S&P 500, it's kind of coming back into support here. And you see on a regular chart, you have this falling wedge. IVs were a little bit high for options, so you could sell some premium or buy some deeper in the money calls. But you have this rising 80-day. You still have this nice solid support down here. So we do think that you'll still see some upside in metals and continue on silver as well. It's kind of in a pennant formation. I think it could be breaking out today as we speak. So that's another area that we like. Kind of goes along with the Fed, keeping interest rates low as well. You're going to see, I think, precious metals, gold higher, stocks higher in the long run. Stocks that we like, we think that software, obviously had a huge run there, but you've seen some big pullbacks in a lot of software names, and you've recently started seeing some of them run again. So we think this is a bullish sector you could keep an eye on. Healthcare is something you're going to want to start being selective on as we approach the election. Obviously, there is issues with insurers and prescription drugs if Democrats get in office. But if you do need exposure to the healthcare sector for your portfolio, we think you should lean towards maybe medical devices, hospitals, and possibly biotech. You'll see here, pharmaceuticals definitely don't look good. This has actually kept me out of the Pfizer trade. Pfizer has looked really good. It was kind of bull flagging and breaking out, but it failed and has been down the last 6 days in a row. So thanks to that chart, I've stayed out of that trade. Also, medical devices, like I said, this is an area you want to look at. As you can see, very constructive on a relative basis. You got to think Viva Systems here, Medtronic, Abbott Labs type companies. And then a bonus idea here is the hospital, THC, Tenet Healthcare Corp. It's got high short interest. It's had a rough few years. Analysts absolutely hate this, but our proprietary volatility scorecard indicator is showing a 93. It is bull flagging. It's above all major moving averages. This thing could start ripping higher. Finally, we're still not fully sold on the financials or the energy sector for that matter. Everybody's been kind of talking about the rotation into it. We're just not there yet. With financials still below its 2009 relative lows, we can't really be buyers of it. If you do need to be in the financial sector, we're a lot more constructive on financial services like Goldman Sachs or Morgan Stanley. We would probably still stay away from the banks. Those are areas that we're looking to short. So the final bonus area, if you do need to be kind of long in the financial area of your portfolio, Morgan Stanley looks pretty good here. It was flagging inside that ascending wedge or ascending triangle. It's above the 20-day, the 40-day moving averages. It's looking to break out above this pandemic gap lower that it had on 221. Hopefully it should catapult to all-time highs there. It looks like it's going to break above year-to-date break even on its third attempt here. Analysts, there's still definitely room for upgrades when you look at the analysts upgrade buys, sells, and holds. And the options were fairly cheap the other day in the 10th percentile, and our proprietary volatility scorecard was a 97. So that's all we have for you today. We'd love to talk to you about your options trading anytime. Come over to schaefersresearch.com or find us on Twitter.
I'm muted. Thank you so much, Matthew. Guys, once again, if you didn't get the impression from Matthew's presentation, this is some of the best chart analysis and research done for you that you're going to get. So do make sure you visit the website, check them out. I would say at the very least, just dip your toes in and see if it's something that works for you. I have a good feeling that it probably will. I'm always impressed by Matthew's presentations here. So Matthew, thank you so much for spending the time with us today.
Yeah, thank you for having me back on, Neil.
Wonderful. All right. Have a great weekend, man.
You too. Bye.
All right, boot campers. The plan is simple. We have a 10-minute break. You guys can get up and go get your snacks, have a cocktail. I don't know what you guys are doing. But in the meantime, Hot Stocks Luke and I are going to play a little game.
Wait, do I get to tell another joke?
It's kind of up to Chad. I thought you got voted down.
No, so at least one person said they like the jokes.
All right, do it for, okay. That one person's about to get what they want. Go ahead.
All right, Neil. How does Winnie the Pooh eat honey? With his bare hands. Get it? Because he's a bear.
All right. All the dads are laughing in the chat. All right. So what I want to share with folks, let me get the right screen here. All right, guys, you guys should see my screen. Do you guys, Luke, let me know if I have the right screen up. What do you see?
I see it's looks like a very technologically advanced place. It's a chat room. It says, welcome to #school boot-camp exclamation.
That is right, guys. That is the chat room yet to be populated by our boot campers. If you are signing up for our mentorship program, you will gain access to that chat room. That's something we want to keep going indefinitely. So we want you guys to share your lessons, your experiences, and learn from each other. So make sure you get that bootcamp bundle. You should see the button on the bottom right of your page in order to gain access to that chat. We're going to get you all into that chat. We're going to keep you up to date on the 3-week intensive education. And then that's also where.
Can I do a shameless plug for a moment?
I would never stop you from doing a shameless plug.
Okay, guys. All right. Here's the deal. Neil and I have to make some money and eat. You guys need to continue the educational trading experience. So I'm going to encourage everybody to click the purchase replays button at the top of Hey Summit. Maybe Shelby would be so gracious to drop that link directly in the chat as well. But if you go ahead and you click on that link, you scroll all the way to the bottom, you're going to see what's called the Bootcamp Bundle. And that's going to come with a handful of things. First, you get all of the recordings of today's session. So if you're trying to watch my jokes again, or if you need to go back and study and continually learn and improve your trading from all the education that we have going on today, maybe it was too fast for you, you will get that. You get to participate in our live trading competition. So everybody who's here today, and only the people who are here today, are invited to participate in a trading competition for the next month where you can put your skills to the test. There's also a ton of prizes to win. And then most importantly, we're going to be having a 3-week mentorship program. Over the course of those 3 weeks, we're going to be doing a deep dive on 3 topics a week. So we're doing 9 sessions throughout the following 3 weeks. So it's not just like a one-day burst of learning, but you're getting education constantly. So we're going to do trading setup, how to use options to generate income, how to time breakouts in stocks. We're going to be doing an introduction on futures, on small caps. We're going to be doing advanced option strategies. We're going to be doing how to invest with ETFs. So again, it's you get all of the content from today. You get 3 weeks of ongoing education. You get the participation in the trading competition. You can also email me, and I will send you a joke at least once a week. So that's an added bonus that Neil didn't know about. I just threw that into the package.
Yeah, it didn't give me a chance to veto it. All right, great. So guys, round of applause for that pitch. Really, really good from Luke.
I hate pitching stuff, but you know, it's got to be done. So it's out there.
It's got to be done. Guys, it really is worth it. You know, you're not going to find a better price for this type of thing, especially with the community aspect. You guys are going to be students together. We are going to have that intensive mentorship. So definitely do it so we can get you into this chat. We do have 3 minutes, and just to kill time before our next presenter, Luke, I want to play a little game.
Okay.
Called the Bootcamp Wheel of Destiny. Everyone should be able to see it on their screen. The Bootcamp Wheel of Destiny will help us decide whether Luke will do a TikTok dance to a silly song, of course, that we'll post on the official Benzinga TikTok.
Which I would enjoy. So fingers crossed.
All right. Or we gift 5 Benzinga stock pick subscriptions. So that's Matt Maley, who you heard from earlier. We'll be giving out 5 Benzinga stock pick subscriptions to boot campers. We'll also have the opportunity to give away 5 Benzinga option subscriptions from Nick Shaheen, who you'll hear from in a little bit, giving you options trade ideas. And then Benzinga breakout subscriptions, which will be coming from Gianni DePoce, who will be a mentor at the 3-week intensive. And finally, Neil does a TikTok dance that will be posting to TikTok. That's not something I want to do, so that's a bad thing. But without further ado, I'm going to spin the Bootcamp Wheel of Destiny. Oh, fuck.
Yes. Soundboard ready.
Okay.
All right.
Okay. So looks like I'll be doing a funny gift TikTok dance. But guys, don't you want us to gift you some subscriptions for participating?
Roll it again, Neil. Roll it again.
Well, no, I got a tiebreaker.
Oh, okay.
We're almost out of time. The tiebreaker is going to be a match of tic-tac-toe that we will be playing later. And we're really going to work on digging me out of this TikTok hole and getting you guys into some gifted subscriptions. But we're at about 1 minute here. I want to talk a little bit about Options AI, our next guest. Luke, I know that you've checked out their platform a little bit. Can you tell us anything about it?
Yeah, Options AI is really neat. And we touched on this in our Picking a Brokerage segment. And so basically what they do is they'll take you on the journey from being able to have a thesis on a stock to making an educated options trade on a stock. So if you say I'm generally bullish on Apple, but I don't know like a low risk way to obtain that upside using options, right? This stuff is complex. Neil still struggles with it. Even the options AI platform actually helps you pick out and set up those trades. It's really, really neat. I've had the chance to check it out several times. So it's definitely worth taking a look at if you are interested in options at all, or getting more advanced with the options trading that you're doing.
Yep. And I think we have CC Lagator here. CC, how are you doing, man?
Good. Great to see you guys again.
Great to see you as well. Welcome back to the boot camp. We've actually talked about options AI a couple times today. One thing that I find particularly great about options AI, there's a lot of things that it makes easy for me, but the visualizations I think are very unique. I think right away that's one of the most striking things. But really, in essence, what I think is great about options AI is that it gets folks into the world of option spreads. And I was hoping that you could tell us a little bit about your background, a little bit about options AI, and then give us an idea of what are option spreads valuable for, and how can you use options AI to be successful?
Yeah, so my background is I was an options market maker, and we started. And since I was an options market maker, I've been an options educator and written online and seen through the eyes of the retail trader, which is sort of interesting because, when you come from the options market maker side of things, you're generally delta neutral, you're vol trading, things like that. But when somebody wants to go express a view in Apple or Tesla, that's not really the way they're thinking. And I think what trips up a lot of retail traders when they get into options is, they put on a trade that they think is expressing that view that they want to express. But because they're sort of overwhelmed, with the options chains, with Greeks, with things like that, they oftentimes, there's the horror stories in options are always, I was right. I was right on direction or something, and I still didn't make money, or I didn't make enough money, or, what happened to this trade? And so that was really the inspiration when we set out to build options AI, is we wanted to, simplify that process, present things in the way that equity traders looked at the world, right? And so then when you go, I think you guys described it perfectly before I came on, when you go to make that trade, you should see a couple of trades and really decide between those trades, which best expresses your view. And we sort of have that motto, like, turn great ideas into smarter trades. And that's what it's about. It's a smarter trade isn't, necessarily going to make you money. I mean, you still need to, it's just like equity trading and all, but you should know that when you put on that trade, exactly what it represents and exactly how it's going to express your view. And then for the spreads thing, a lot of people's entry into the options market and options trading is, I think, this $100 stock is going to go higher. I think it could go to $120. And what they tend to do is they go out and they buy like a 120 call or something like that, right? And that's sort of like the classic scenario. It's like the stock goes up to 120 and they don't make any money. And they're like, all right, well, that was what was that all about? And so that's sort of, with the spreads and things you're talking about, is oftentimes you can buy a 100 call, let's say, sell that 120 call, get that move to 120, and have been sort of perfectly positioned for that move rather than just sort of guessing on a strike. So strike selection is a key component of it.
Mm-hmm. Yep. So I can say I've definitely been in that situation. With
everybody has.
Yeah. So guys, and if you guys do have questions about the terminology that's being used around options, let us know. Because that's really what CC here is trying to solve, is to pull out a lot of the ambiguity and make things straightforward. So you can actually make a trade that's based on your real intent, which is often difficult to do with options. So CC, I was wondering if you could show us a little bit of Options AI.
Yeah, and I did actually a little presentation that can lead into that. Let me share screen if I can.
Mm-hmm.
All right, do you all see me?
Yep, we're up.
Okay, cool. So what I wanted to start with is that, and this sort of goes into that conversation, is there's some, when people dive into this world of options, they often, it's a bit overwhelming, like options, chains, Greeks, things like that. But there's some core concepts I think I've always found that are like sort of those light bulb moments when people are, getting into the world of options. And the first, a couple of things that I wanted to talk about. The first thing is the intrinsic extrinsic value of options. And I think this is a great place to start for people when they're getting into trading. And then the next thing I want to talk about is break evens, which we kind of touched on a little bit there with that like 120 call example versus like a 100, 120 call spread example. Then I wanted to talk about the expected move, which is, sort of at the core of Options AI. And that's basically taking all of this information and visualizing it as a chart so that in the same way that, your mind thinks in equity trades. And then ultimately, why these are smarter trades in quotes, because they, like what we've said, they're actually expressing your view. So the first thing I have here is a very simple view of some calls. And the assumption here is the stock is $100 and you have a 95 strike, a 100 strike, and a 105 strike. And what I have labeled here is in the dark blue is intrinsic value. And in the light blue is extrinsic value. Now that extrinsic value is basically everything about options trading. That light blue includes time to expiration, it includes volatility, it includes all those Greeks you hear about like theta and all of those things. And essentially what that light blue is doing is all of the uncertainty and all of the assumptions being made by when people are placing options trades are contained in that light blue. So in this example, you have buying a 95 call. Remember the stock is 100. That call costs $6. $5 of that is intrinsic. It's the difference between 95 and where the stock is trading. That extra dollar is the extrinsic premium, right? And that is the uncertainty of what this stock is going to do until the time of this call expires. Now the 100 call, if you went to go buy that, let's say it costs $3. The stock is 100. That $3 is entirely extrinsic premium. That entire option, it has no inherent intrinsic value. It is completely premium. And finally, the 105, the out of the money call, is less because it's farther away. You need the stock to go up to 106 for this to break even. And that is also completely extrinsic premium, but it's cheaper, obviously, because it's farther out of the money. Now, when you go and you flip this into looking at puts, buying a put, 105 put, 100 put, 95 put, it's the same thing. It's $6. And in this case, the 105 put is in the money. And so it's $5 of intrinsic value, $1 of extrinsic value, and the same thing. And now what you've noticed here is the $1 of extra on the 95 put, the out of the money put, is the $1 of extrinsic premium in the money 95 call. And that's how options work. Puts and calls are inverses of each other. And the premium you see on one side in the out of the money option is represented as the extra amount in the money option on the other side of that strike, right? So that's sort of like a great place to start, is trying to understand like what is making that $1 expand or contract? What is making that $3 expand or contract? And basically what's changing is uncertainty, right? And, if you went out a month in expiration past these calls, that would be an extra $2 on the 95 call. It would be $6 on the 100 call, and it would be $2 on the 105 call. So the next thing I wanted to talk about real quickly is break evens, right? And so using those same calls and puts, that $6 call has a break even. That means if you buy that call and the stock is trading 100, you need the stock to go up $1 before you break even on that call. On the 100 call, you paid $3 for it. It's in completely extrinsic premium. You need it to go up to 103 before you make money at expiration on that option. And then finally, the cheapest call on this board, the out of the money call, the 105 call, you pay $1. You need the stock to go to 106 to make money at expiration on that call. And then going back to the puts, it's the same exact thing, just in the other direction. So you need it to go to 99 on the 105 put, you need it to go to 97 in the 100 put, and you need it to go to 94 in the 95 put. So that takes me to, let's see, okay. So we talked about the expected move, and this is sort of the first glimpse of options AI. And what that $3, if we go back to that $3 real quick from this extrinsic premium. So this is the at the money put and the at the money call. That $3 put and that $3 call is basically all of the uncertainty for this time frame in this stock. And that can be visually represented. And that's what we've done here at Options AI. And every trade on Options AI starts with this view. And what you have here is Snap stock. And what we've done is we've taken the historical chart, and then we've taken the options market in the future, and we've taken the chain, and we've shown you where bullish and bearish consensus is out in time. And as you can see, you can scroll out to the right. These are expirations showing that, out into the end of September, it's about a 10% expected move in Snap. If you go, like near term, it's, let's see, it's starting all up again. But you can see all these different time frames of, where this stock is expected. And this is pulling that directly from what we just talked about. It's all of that premium in the options market. And what this is doing is, even if you don't even intend to trade options, you should be looking at the options market for this type of insight. If a stock that you are about to buy or sell, you can actually see in the options market expectations from all of that money placed into the options market out into the future. And before doing any trade, we feel like you should be able to see that. Now, if I go to the next slide, so now what Options AI does, and let me just pause, is once you've seen that chart and you've selected a time frame, I want to trade Snap, I'm bullish, I'm neutral, I'm bearish, or you can set like a very specific price target out into the future, but you're doing it in the context of what the options market has priced into the future. And what we do is we then take that information, and in this case, it's a September expiration, and you set a price target, and it creates trades for you. And what these are is these can then be compared to each other. Buying a call spread, selling a put spread can be compared directly, and you can decide, all right, well, I can see exactly what this stock or what this trade makes, for this intention. And the next slide, I wanted to show, so if you think back to those other charts where I was showing you the calls versus the call spreads and things like that, is what we do is we overlay it on this expected move on the future chart. So this is that first selection of buying a call. And you can see what your risk and what your gains can be, and then your probability of profit. And that probability of profit is based on that break even, where this stock needs to go before this trade breaks even. Next, you can see a call spread, which is taking that call and then selling an upside call. This is very similar to that example we went over, where you're buying an at the money call and selling an upside call and creating a call spread. You're creating, in this case, a $1.50 wide spread where you make money above your break even, and then your profits are, you have a max gain at the upper strike. And this easy to see comparison, and in this case, it's selling a put spread. And this is also a bullish play where you're selling premium. you're basically selling to the bears because you think Snap is going to go higher. And finally, this is sort of selling a put spread and selling a call spread. You're basically taking a neutral standpoint, and this is selling an iron condor. So I know that's a lot in a very short amount of time, but I know we didn't have a ton of time, Neil. But I mean, I don't know if anybody, or if there are questions coming in, I can.
So I think, where can folks get in contact? You guys have a Twitter handle or something like that where folks can ask some questions about the product?
Yeah, so I write at OptionsEye, EYE. And you can do at OptionsEye on Twitter and optionseye.com. And I write usually something once a day, highlighting upcoming earnings, highlighting a stock. And so people can hit me on Twitter. And then, of course, optionsai.com if people want to check out more on the product.
What I will say to folks is that this is a web-based application. So you're just going to the URL when you sign up, and it will open up on whatever device you are using and adjust to your screen size. It's not, and correct me if I'm wrong, CC, it's not like an app that you get. It's more versatile in that you're simply going to the URL. And yeah, if you have questions about this kind of stuff, definitely check out OptionsEye. The key here is that we're taking pretty complex stuff that takes like a lot of learning and a lot of knowledge to really be able to construct successfully, and simplifying it down so that you can both see it on a visual level and then actually be able to execute it. So anyways, thank you so much, CC. I wish we had more time, but we'll definitely have you back again soon so we can talk about your awesome platform. Thanks, man.
Definitely. Thanks.
All right. Have a great weekend, man.
You too.
All right. Next up, folks, ladies and gentlemen, Gianni DePoce, good friend of Benzinga, an excellent trader. The man is a chart guru, a chart genius. He's also, I'm gonna talk. Okay, yeah, I'm gonna keep going on him. He's also an urban farming extraordinaire. The man is growing crops and growing profits in the markets with breakout trade strategies. So who better to have here today to talk about chart patterns and how you can read the technical side of the stock market to turn it into breakout profits. Gianni, welcome. How are you doing, man?
Good, Neil. Thanks for having me. Glad to be here.
My pleasure. I love that background. There's something familiar about it. It just looks so smooth.
Yeah, very creative man made it for me.
An artist.
Yeah.
All right, man. So without further ado, I gave you quite the intro. We're here to talk about patterns, how folks can look at, and again, so just for folks that aren't aware, you're hearing terms get tossed around a lot. We talk about fundamentals, we talk about technicals. Really what that comes down to is if I say I'm a technical trader or a technical investor even, that means I look at charts. Technical means I'm looking at the price activity up and down of the stock on a chart. The fundamentals means I'm looking at the business. I'm looking at its balance sheets. I'm looking at its PE ratio. So that's about, what's actually going on the balance sheet there. So both in conjunction are wonderful together, but charts on their own or technical analysis on its own is an extremely powerful skill set to have. So Gianni, I'll get out of your way and let you get on with the presentation.
Okay, very good. I'm going to share my screen here and I will get started. Okay, can you see my screen?
Yep.
Okay. Very good. So just to give you a little bit of background of who I am and where I come from, I was a financial advisor for almost 6 years. So I was in the inside of the financial world. But during that time, I was the lead trader for a $250 million portfolio. And during that time, I was exposed to various institutions and other market entities call them the market movers, if you will. So I learned how to trade through trial and error, and basically from the insiders themselves. You know, we would have the portfolio managers come in and say, hey, look, this is how our portfolio manager, you know, picks stocks. And so I took their strategies and combined them with my own. And I discovered that, you know, it can pretty much be applied to any market. So today we're going to look at chart patterns. As Neil explained, this is the foundation of technical analysis, and we're going to observe how they apply for stocks. And we're going to talk about some cryptocurrencies as well, because I know that's a very popular and growing sector. So without further ado, let's get started. So why technical analysis? Okay. Well, the number one thing that we have to do with technical analysis is manage risk. Okay. Because you have to look at trading like a business and your capital as your inventory. If you run out of capital, you're out of business. Okay. And we have to become comfortable taking losses, view them as a business expense. Okay. You have to deal with paper cuts, or else you're going to have a really deep wound. So technical analysis helps us gauge risk and measure our risk. And we look to find, you know, favorable risk reward opportunities, you know, risking $1 to make 3 or 4. And technical analysis helps us do that. But it also helps us spot opportunities ahead of time, because we look at chart patterns, and the best predictor of the future is the past. So these chart patterns have been around for hundreds of years, believe it or not. There are many books written on the subject going back to the early 20th century. And I'll talk about a couple of those examples at the end. But it is a very well-documented study. And another thing that's important with respect to technical analysis is the notion that sentiment follows price, not the other way around, okay? So tops, market tops, are formed in euphoric environments, and bottoms are formed in capitulation, when, you know, everyone is panicking. And even look at the Corona crash that we had back in March. I mean, it seemed like the world was going to end for a lot of people, but that's when the market bottomed, and we've ripped higher ever since. And another aspect with technical analysis is the idea that there is a natural order to our world. You know, Neil mentioned I'm an urban farmer, and the interconnectivity of capital markets and financial markets is similar to the interconnectivity of nature. And, you know, there are no coincidences in nature, and there are no coincidences in financial markets either. It is all many times very organized. Obviously, there are black swan events, but you know, you can't account for everything. So let's go ahead and talk about some chart patterns. And there are different types of chart patterns, okay? And the type of chart pattern that we are going to observe depends on our strategy. And these chart patterns are great because they work across all markets, whether it be stocks, Forex, cryptocurrencies, future markets. And the three main categories that I classified these chart patterns into are reversal patterns, continuation patterns, and momentum patterns. So we're going to look at some examples of all of these three categories, and we'll, you know, use some standard images, and then we will look at some live examples that we've published through the Benzinga breakout series, and then we'll look at the cryptocurrencies because I know that is a very popular market right now. So the main reversal patterns that we look at, okay, are the head and shoulders, the falling and rising wedges, rounding tops and rounding bottoms, and double and triple tops and bottoms, okay? A lot of these are similar, just inverted. So let me see if I can get my laser pointer here. I think you can see that. Great. It's going to help when we're looking at the charts more specifically. So let's start with the head and shoulders, okay? So a head and shoulders pattern. So in this case, we have the left shoulder, the head, and the right shoulder. I know it's kind of obvious like this, but you know, once you watch charts for long enough, you'll learn to spot these in live time too. But when we look at head and shoulder tops, this image doesn't reflect it, but the reversal is actually more powerful when the right shoulder is beneath the left shoulder. So in this case, it's not, but regardless, a head and shoulders top okay, a top formation pattern is only confirmed after a close is achieved below the neckline, because sometimes a head and shoulders pattern can actually resolve as a continuation. So we can look at this and see the head and shoulder pattern, but until we see it close below this neckline, it might not confirm as a reversal pattern. So that's very key to understand. And remember, closing prices are what matter the most. Until we actually close below it. So even this image is a good example of showing that. We can see here that this C Networks stock traded below the neckline, but closed back above it. So the pattern was not confirmed until we actually closed below it right here. So the inverted head and shoulders is basically the same thing upside down. And same story. We want to see the right shoulder usually be above the left shoulder. It's not in this case either, but in real life, in real time, it is indicative of a more powerful reversal pattern if the right shoulder is above the left shoulder. So same thing here. We need to see a close above the neckline of the pattern in order to confirm it. Otherwise, it could resolve as a continuation pattern. So again, it's very important to make sure that we are acting based off of closing prices and not the intraday data, which I like to call noise many of the times. So here we have the rising wedge pattern, okay? And the wedge patterns are pretty cool because it's indicative of a compression in volatility. So volatility can be to the upside and to the downside. And what happens in markets and kind of in nature as well is that periods of low volatility will precede periods of high volatility. So when a stock or cryptocurrency or futures contract is forming a rising wedge pattern, it is indicative of a compression of volatility because the trading range is actually compressing during that time. And we also notice during this rising wedge pattern that volume decreases as volatility compresses. And then when we see a resolution from said pattern, we usually see volume expand in conjunction with volatility. So think about it as compression, expansion, increasing, decreasing. It's an ebb and flow. It's not linear, it's cyclical. And the falling wedge is basically the rising wedge just flipped upside down. So a falling wedge is when a market is declining into a trough, a bottom, and we see volatility compress. The short sellers are becoming lazy, if you will, and or the sellers are basically, becoming less aggressive in their selling. And eventually there's a capitulation at the bottom. We see the volume decreasing. And then when we break above this upper trend line of this falling wedge, it usually unfolds in the form of a short squeeze, which is when the short sellers have to cover their positions, which means buy their shares back that they initially borrowed to sell short. So when the short squeeze happens, we see the expansion of trading volume in conjunction with price. Volatility will spike to the upside, and we have a short squeeze and a nice rally in the stock. And similar to the head and shoulders patterns that we just talked about, we need to see it close above the upper trend line. And until it closes above there, we could see, volatility continue to compress. So let's take a look at another reversal pattern, the rounding top. Now the rounding top, sometimes it can look like a head and shoulders, but the principle is more or less the same. It's not as visually appealing as a head and shoulders, but regardless, it's a big base that's formed. And there are a couple sayings that I want you to remember this. So if you want to take a note, I encourage you to do so. When it's a reversal from a rally, there's a quote that goes, "The bigger the top, the bigger the drop." And when it's breaking out, we'll get to this in a little bit, the bigger the base, the higher the space. So a rounding top, the bigger price base that we see in a rounding top, okay, the more likely or the more severe, the higher likelihood of a severe breakdown may unfold. So again, we need to see it close below the level of support. And similar to the previous patterns, we usually see volume decrease as, you know, buyers become complacent, as, you know, everything's fine and dandy, everything's great as the market is rising. So similar to the previous two examples, we have the rounding bottom, which is the same thing. You know, short sellers and, you know, other sellers for that matter will become complacent. And then this pattern is confirmed once we see a close above resistance in this case. And another key takeaway I want you to remember here today is that whenever a market breaks above resistance, okay, so in this case, if this stock breaks above this level right here, which would be resistance, it then becomes a level of support. And conversely, when a market breaks below support, that level will become resistance. So that pretty much takes care of the major reversal patterns. There are a couple other ones, but these are the major ones. You know, we mentioned, you know, double tops and double bottoms, but you can see here, I mean, we tested, you know, the level of support right here basically 3 times. So, you know, this looks like a rounding bottom, and it is, but you could also make a case that this is a triple bottom as well. So technical analysis is an art just as much as it is a science, but it's important to let closing prices dictate our actions, which in this case, you know, we closed above here and, you know, we retested the former level of resistance that became support and saw an upside resolution.
Gianni, what time frames do you mostly look at on charts?
So I usually start at the weekly level, and the reason behind that is because those will be more important for determining the intermediate term trends. So the intermediate term trends, a lot of times you'll get moves, you know, in like the 20 to 40% price, you know, range. And then if I see a weekly chart I like, I usually go down to the daily time frame when it comes to actually initiating and triggering the trade.
Got it. All right. Thanks, man.
Yep. So next, let's talk about continuation patterns. We have the triangle patterns, which are comprised of the ascending, descending, and symmetrical triangles. We have the rectangle price pattern and the ascending and descending price channels. So we have the triangle patterns summarized very nicely right here on one slide. So the symmetrical triangle is basically, it looks like a less than sign, or a greater than sign rather. And we see here that volatility compresses in the pattern until it becomes so compressed that it explodes higher. Now we talk about continuation patterns because any of these 3 patterns can happen in either an uptrend or a downtrend. An uptrend is characterized by a series of higher highs and higher lows. So in this example, we see we have a high, a higher low, and then a higher high. And then this low is a little bit lower than this one, but we see the next one here is higher than this one. So that's why I look at the weekly charts, as Neil asked, because you get a broader perspective of what the longer term trend is. And remember, the longer term trends will usually override the shorter term trends. And so that's why it's important to trade with the trend, and the trend is your friend. So keep that in mind as well. The ascending triangle price pattern also is characterized by compressed volatility, but in this case, we have a level of resistance where the sellers are coming in and rejecting the buyers each time it hits this level. But even so, we see that higher lows are subsequently formed. Now, in real life, in real trading, you know, it's not as clean cut as this. You might see some intraday highs that exceed this level of resistance, which speaks volumes to the what I said earlier, that closing prices matter most, because the ascending triangle is not confirmed until we actually close above the upper horizontal trend line of the price pattern, which in this case represents resistance. And then the next example is the descending triangle price pattern. And these are more common in downtrends, but they can unfold in uptrends as well. And again, we see, you know, the lower lows and lower highs, and it's not confirmed until we see a close beneath support. And, you know, we see here that, you know, this, you know, market is making lower lows, so, or lower highs rather, and it's usually indicative of a downtrend. Remember, I'm going to keep repeating it. The trend is your friend. So next we have the rectangle. This can also be a momentum pattern, but momentum and continuation kind of go hand in hand. But we see here that we have levels of resistance and levels of support, both in the bearish and bullish rectangles. And again, we have to look at the broader, more intermediate term or even secular term trend. Remember, the bigger the base, the higher the space, the bigger the top, the higher the drop. So, we need to see a close above this level of resistance. And a lot of times, like I mentioned before, we'll see that level of resistance retested as a resistance turn support. And similar in the bearish one, we want to see it close beneath the lower horizontal trend line in order for the price pattern to be confirmed.
Really quick, Gianni.
Sure.
Back to triangles. What is the difference between a wedge and a triangle?
So a wedge, do you want me to go back to the wedges?
Yeah, that might be helpful.
Let's see. So you can see the wedge is not as symmetrical, and usually the wedge will go on a little bit longer. The apex of the wedge pattern, like when I say the apex, it's like this part in the case of a falling wedge, and in this part in the case of a rising wedge. It's usually a little wider than a triangle. So if I go back to the triangles, you see how the triangle, the apex is a little tighter compared to the wedge. Now, again, I mentioned how technical analysis is an art. So, it's going to take looking at, thousands of chart patterns and thousands of graphs to, learn to make the difference. But the main thing is that a wedge, whether it's rising or falling, is a reversal pattern, whereas a triangle is a continuation pattern.
Yeah, that's a very good distinction.
Yes.
Okay, and then in terms of, you did touch on volume. We're getting a couple of questions about volume, but just keep that in mind as you go into the next patterns to kind of touch on how volume plays into it.
Oh, sure. So usually when even in the triangle patterns, volume usually tapers off as volatility compresses, because these patterns are usually indicative of indecision between buyers and sellers. And during that time, like for example, the large portfolio managers, the large institutions, they're not buying on the breakout until we see a close above the upper trend line of this ascending triangle price pattern. You know what I mean? So volume, when you see volume spike, it usually is indicative of institutional action, because, unless you're moving hundreds of millions or billions of dollars in the market, you're not really going to be, noticeable in the ticker tape. So, if you're buying, Apple or Tesla, I mean, Tesla's what, like over $2,000 a share. I mean, unless you're moving $200 million in that stock, I mean, you're just a blip you're hardly a blip on the radar. So volume as a rule tapers off when volatility is compressing, when a stock or a future or a cryptocurrency is compressing into a price pattern.
Mm-hmm. Yeah, and I've also heard that put like it's a battle between the buyers and
Absolutely.
the sellers.
Absolutely.
And eventually one's going to win.
100%, which again speaks volume to the idea that we have to act on closing prices, because until we actually close above this level of resistance, well, the sellers still have time during the day to come in and push the stock below that level.
Mm-hmm.
So if the institutions are saying, oh, we need to buy when Apple is above, when it's 2 standard deviations above its 20-day simple moving average, well, they need to trade toward the end of the day, because if it's 2 p.m. and it's above that mark, and then sellers come in and push it below that mark, then they can't buy. So that's why you usually see a spike in trading activity at the opening of the day, and then a spike at the close. There's a saying that goes, rookies trade the open and pros trade the close. And, everyone that's here today wants to be in the latter category. We all want to be trading with the market movers. It's different when you're exiting a trade, but it's more important when you're initiating. We want to make sure we are on the same side as the heavy lifters.
Mm-hmm.
So the rectangles, we touched on that. The price channels, basically, it's kind of like the wedges, except you don't see the the compression. It's wider, and these are usually bullish. I mean, low volatility rising, a bull market climbs a wall of worry, and when the bearish channels, it's same thing, lower lows and lower highs, and the bullish ones higher highs and higher lows. The horizontal channels, I'm not going to spend that much time on because that's kind of like the rectangles. But same thing, we have to look at the broader trends and act based off of the closing prices once we move above a level of support or resistance. All right, time for our bread and butter, the momentum patterns. This is what the Benzinga breakout series is all about. And we're going to talk about the saucer pattern, the broadening wedge, the cup and handle, the bull flags, and then I mentioned how the rectangle can be a momentum one too. If we have time, we'll cover that, but if not, we'll reserve it for the more important ones. So we're actually going to show live examples of stocks that we picked in the Benzinga breakout series. And so let's start with iRhythms Technology. So here we have a saucer pattern. We can see here how there is a level of resistance, and then we have some it's like a U shape at the bottom, and this is a weekly chart. So this again shows how the intermediate term trend is important. So here we bought on the break above resistance, we closed above it, and we rallied very sharply for a few days, which was great. And then we actually got stopped out here. I like to raise my stop loss. One of the worst things that can happen to a trader psychologically is for a big gain to turn to a loss. So we ended up, I think, with like a 10 to 12% gain on here. But as you can see, we broke out to a new high, formed a higher low, and then surged higher. So unfortunately, we missed this big price move here, but we did catch the initial breakout, and unfortunately, we got stopped out. But like I said, in this business, you have to be comfortable taking losses. In this case, it wasn't a loss, but you have to let price dictate your actions. And when your stop loss is triggered, you just have to, remove the emotion from it. Emotions can never be eliminated totally. Okay, we don't want to turn into zombies and, drone-like individuals, but they must be controlled and mitigated. Similar to the ego with respect to trading, you can never, totally eliminate the ego, but it must be managed and provided framework. So this is an example of the saucer pattern, again, characterized by a horizontal trend line representing resistance, and then a U-shaped parabolic curve, if you will, at the bottom. And so we have another example. This is GoDaddy. So here's an actual trade idea for you right now. GoDaddy is not broken out. All of these stocks that I'm sharing with you are current as of yesterday's close, Thursday's close. And here we have a beautiful saucer pattern. Now, we did break below the U, back in, February, March during the Corona crash. But here, again, if we get it close above this upper horizontal trend line, I mean, this stock could really break out. I mean, we could see this, surge above $100 a share. So keep an eye on here. Let's say we can get long around above the $85 mark. If we close above $85, I like to keep stop losses within a 7 to 8% threshold, because risk management is of utmost importance. We are professional risk managers as technicians, or we should be. Not all are, but I think we all should. And here again, we want to see it close above the upper horizontal trend line to confirm the pattern. And I'm very constructive on GoDaddy as a stock. And from a fundamental, like real world perspective as well, I mean, the internet's booming. We've seen a lot of pundits say, the coronavirus basically, sped up the, digitalization of commerce. What was supposed to happen in 10 years happened in 3 months because people had to shop online for basic necessities. So, GoDaddy is a domain registry, and we could see how they would do well in a environment like we are in right now. So let's talk about Chegg and broadening wedges. This is one of my favorite patterns, and it's not covered very often by a lot of other technicians, and maybe that's why it works so well for us. So let's just keep it as our little secret here. But a broadening wedge, we have the upper horizontal trend line again, and then we have a downward sloping trend line, and we see here how we're testing this trend line multiple times. And I talked about how it's important to zoom out on some stocks and look at the longer term trend, because if you can see here on Chegg, for example, we made a high here, and then we made a low, and this low's lower than the previous low here. And then this next high was lower than this previous high. But if we zoom out and look at Chegg going back to 2017, all right, it's in a clear uptrend. But for 2019 and even spilling over into early 2020, you could say it was in a short-term downtrend. So that's why I mentioned the longer-term trends will override the short-term trends in the long run. And here we funny story what happened here. We wanted to get long. I remember this clear as day. And I think Chegg missed our buy point by like 18 cents. And they reported earnings and just absolutely smoked it. We can see the spike in volume here. So a bunch of buyers rushed into the picture, and our buy didn't trigger. And sometimes you just have to let things go in the market. It's better to not chase and disrupt your risk reward ratio. Remember, we are professional risk reward ratios. If I can risk $1 to make 3 or 4, that's an odd I'm gonna take. I like those odds. But if the market gets away from us, chasing it's skewing the risks against our favor. So what happened was we let Chegg rally for a few weeks like it did, and then we raised our buy point, and we actually snagged a few shares in the $55 to $56 range on the retracement. I think we did like it was like a 38.2% Fibonacci retracement from the low here to the high right here. We snagged Chegg on the retracement and rode it higher for the subsequent weeks. Got out with like a 40% plus gain. It was a really nice trade, and Chegg made a little bit higher high, so we didn't exactly sell the top, but we don't need to buy the bottoms and sell the tops. As you can see, 40% gain in not even 2 months. I like that, and there's a lot of meat in between the high and the low that we can still make money on. So great example of a broadening wedge here on Chegg, and like I said, these charts are updated from yesterday, and if we sold here, we haven't really missed out on. And so you have to think about opportunity cost too. If your money is tied up in a trade that's not performing, that's money that you don't have at your disposal to trade other stocks. So we missed an additional 5% rally, but I'm not going to lose sleep over that. And here we are a month later, and Chegg is basically at the same level that we exited at. Marvell Technology, this is a semiconductor stock, which has been a really hot sector as of late. And here again, we have the upper horizontal trend line representative of resistance. We saw it tested a couple of times. In this case, we made it higher highs. So that's what I mean by it's an art. It's not a science. The market's never going to conform to your exact desires. The market is greater than all of us. It is the sum of all market participants' actions and behaviors. But you can see here that the low made during the Corona crash was lower than the previous low in early 2019. So, but if we zoom out and look at the intermediate term trend going back to 2017, we can see that Marvell Technology is clearly in an uptrend. So this one, fortunately, didn't get away from us, rather, like the previous example in Chegg. We were able to buy here, and we rode the wave higher. We didn't exactly sell here. There was some price congestion, but we got out in a reasonable area, and Marvell rallied a little bit higher, but it's pretty much at the same area that we exited at almost 2 months later. But this actually, here's another trade idea. This kind of looks like a bull flag, and we'll talk about that in just a few slides here. I would call this the flagpole, and then we've been flagging. So if Marvell closes above its, when would that be? It's high from like May. I'd get long that again too. And again,
I'm adding it to my watch list right now.
Yeah, Marvell. Yeah, I like this one very much. And it's actually, it made a new all-time high going back from like 20 years, if I remember correctly. The stock's been around quite a bit, and all-time highs are bullish. I know everyone wants to make the most epic, market call and say, oh, we're going to crash 50% from this high, but higher highs and higher lows are, characteristics of uptrends, and new all-time highs, especially all-time closing highs, are bullish. They're not bearish. So I really like this name too. So let's go on to cup and handles and Advanced Micro Devices. We had another home run on this one too. So the cup and handle was made famous by renowned market analyst and founder of Investors Business Daily, William J. O'Neill. I highly recommend that you read his books that he authored. I classify that into the must-read category for any aspiring trader. But a cup and handle, we have an upper horizontal trend line, and then we have a U, and then another U. And so the U that goes lower, the one that is bigger in terms of depth, is the cup, and then here we have the handle. So I tried to get a little sneaky, and I usually don't do this, but we got long here, and we almost got stopped out. But that's why I say closing prices matter the most, because Advanced Micro Devices actually traded below our stop loss on this day. This is a daily chart. The previous examples were weekly charts. We traded below our stop loss during the day, but we closed above it. And most of your actions should be taken in the last 5 to 15 minutes of the day. So we had a nice rally that saved us from being stopped out. And that's why I put here, this would have been an even better entry. So we closed above the upper horizontal trend line of the price pattern, and AMD just like ripped higher in like a week or two. And we had again, a 40% plus gain in not even 2 weeks. We sold in the middle of this trading day right here. Again, we didn't sell the top, but I don't care because we got a nice gain in the meantime. And then here we are about a month later, and AMD is about where it was when we sold. So again, we don't need to sell the top and buy the bottom to make money. There's plenty of meat in between. But this is another semiconductor stock that's looking promising. I mean, you can make a case that this is a bull flag. I would call this an ascending triangle price pattern right here. We have the upper horizontal trend line, and then a upward sloping trend line characterizing the lower part of the price pattern. So if AMD closes above, let's see, the $87, $88 mark, then might be time to get long again. So that's another stock that was very rewarding to us. So let's take another look. Another example of a cup and handle. This one is called Amedisys. I think I said that right. This is a biotech stock, I believe. Well, it doesn't matter. The chart patterns are still the same, regardless of the market. So here we have the upper horizontal trend line, representative of resistance, and then we have the U-shaped cup, and then the U-shaped handle. And then we bought this one very cleanly. We learned the lesson from the Advanced Micro Devices trade, and yeah, it's been rewarding as well. We rode this wave higher, and pretty much the same thing as the last one. So let's talk about some bull flags, because I mentioned that just a couple slides ago. So a bull flag, this is a very important pattern, probably the most powerful momentum pattern in all of technical analysis. And this provides you an opportunity to make a lot of money in a very short period of time. So this is Spotify, and we made over 40%. And this one was like not even 2 weeks. It was like 8 days, I think. But either way, we have the flagpole right here. And we had a level of resistance. I didn't draw the line here, but you can see how Spotify was pushing up against resistance for quite a few times. And another good rule that I want you to take away from today is that the more often a market tests a level of resistance, the higher the probability that it's going to break that level of resistance. And on the flip side, the more that a market tests a level of support, the more likely that it is going to break that level of support. So in this case, we tested, it was like the $155 to $160 price range. Quite a few times we broke through it. We formed a flagpole, and then The second part of the pattern is what's known as the flagging portion of the pattern. So this is the flagpole and this is the flag. Okay, and then the buy point on the bull flag pattern is when the stock closes above the upper horizontal trend line of the flag. So let's see, I got a little, which book did I mention? Neil asked. Well, the one I mentioned was, it was authored by William J. O'Neill. It's How to Make Money in Stocks. That's a very good one too. There's a couple other books I'll drop at the end of this presentation that I think all aspiring traders and market technicians should read. But the one I mentioned, authored by William J. O'Neill, that's How to Make Money in Stocks. So back to Spotify. We bought here on the close above the upper horizontal trend line of the flag, and we just ripped higher. And we made over like 40% in like 6 or 7 days or something. And once again, we sold before the peak, but that's okay, and then here we are, 2 months later, and Spotify is pretty much at the same place where we sold it. So again, opportunity cost. We can't get greedy. It helps to have an exit point planned ahead of time. And if the market achieves that price objective, just sell it. It's okay. You made a nice gain. Take what the market gives you. The other option is to keep raising your stop loss. So there's, you either sell once a market reaches your price objective, or let the market stop you out. That kind of speaks to, the William J. O'Neill strategy of letting your winners run and cutting your losses short. So if a stock rallies 20%, raise your stop loss up to, break even, or at least, have you lock in a 7 to 8% gain. So you're getting paid for your time as well, because it's not just about money, it's about time too. There are two axes to a technical chart or a stock chart. There's the price axis and then the time axis. We have to look at price and time. Both are equally as important. Okay, another example of a bull flag. eXp World Holdings. Okay, this is actually a real estate company, I believe. So that's been a pretty hot market too. And this one's actually characterized by a couple of bull flags. This one I would actually say is a pennant formation. So here we had the bull flag formation, the flagpole formation. And this is kind of like a descending triangle price pattern. Sometimes you'll see the flag portions of these bull flags form in the case of a ascending triangle, a descending triangle. When it makes like a symmetrical triangle shape, like it is here, we call these pennants. Okay, but the rule is still the same. We buy on a close above the upper trend line. So here for EXPI or eXp World Holdings, we bought right here, and we sold a little earlier than I would have liked, but quite frankly, I thought the market was going to correct, in early August. But just because I had an opinion doesn't mean I took a position. But sometimes you sell too early, but a man never went broke taking a profit. Man or woman never went broke taking a profit. So sometimes you just got to take what the market gives you. And so sometimes less is more. So we're not going to complain about a 30% gain or so in a weaker time. But we sold this one a little early, but it's okay. So that actually takes care of my stock chart examples. Let's talk about crypto. So aside from being very bullish on blockchain technology, I'm actually pretty bullish on crypto as an asset class because of the technical aspects of it. So full disclosure, I don't really care about the cryptocurrencies or the coins themselves, because we have to be realistic and acknowledge that these are going to try and compete with the the sovereign currencies of the world. And I have a background in economics and macro as well. And I think the governments around the world are kind of letting the cryptocurrencies have their time as the Wild West, just to see how the innovation unfolds. But I don't think that they're gonna allow this to turn into a space that competes with the US dollar or the euro, for example, because at the end of the day, they could just pass legislation or by executive fiat just saying, oh, if you own any cryptocurrencies, you're a felon. And I own crypto. So, that's a risk we have to acknowledge, but I just treat it like any other asset class. When crypto had its big bull run back in 2017, we had a sell signal here and, it went down. And when it was running this high back in 2017, people were calling for crypto or Bitcoin specifically going to $100,000 per share. That's the kind of statements you see when a market is in a euphoric environment, which, as I mentioned earlier, tops are formed in euphoria and bottoms are formed in panic. So when we zoom out and look at the intermediate long-term trend of crypto, we see a symmetrical triangle price pattern, and these are known as continuation patterns. Okay, so I saved this little detail about price patterns for these cryptocurrencies because I wanted to make it a little entertaining. So when we see a price pattern like the symmetrical triangle, a way to do a price projection or to produce a price target is to measure from the widest parts of the price pattern. So in this case, let's see, this is around, let's see, I think that's around like $2,000 a share right here. And then all the way up here, we have $18,000. So we take that difference, let's just say $16,000, and then we project it onto the upper trend line of the pattern. So we would just say right here and add $16,000, 16,000 to, let's say, 10,000, give or take. Okay, so we already broke out from this pattern. So that would actually produce a price target on Bitcoin for around $26,000. So let's just say $26,000 to $30,000. I know that sounds crazy now, but that's actually good because remember, a bull market climbs a wall of worry, and not a lot of people are calling for, aside from the perma bulls, and I'm not a perma bull under any asset class. There are going to be gyrations and fluctuations in cryptocurrency and Bitcoin and the other two that we're going to talk about, Ethereum and Litecoin, just like any other market. But long term, it might take a couple of years to get there. Don't be surprised if we see Bitcoin rally to 26,000 to 30,000. So this is the symmetrical triangle price pattern, and it's a bullish pattern because it's continuation, and the long to intermediate term trend in Bitcoin has undoubtedly been up, and this is characterized by a series of higher highs and higher lows. And what actually made me turn really bullish on Bitcoin was the fact that the Corona crash low back in February and March was higher than the low formed in late 2018. Now we haven't exceeded the high from late 2017 and early 2018, but once we do, this is going to turn into it could be another crypto mania. So keep an eye on Bitcoin and crypto as a sector. So let's pivot over to Ethereum. Let's see, Ethereum. So Ethereum here, we have another I just put triangle, okay, because there's a little bit of a discrepancy. If we wanted to be rigid in our analysis, we could say, oh, this is a descending triangle. I could have very easily have put this lower trend line as a horizontal line and say, oh, look, it's a descending triangle as characterized by the downward sloping upward trend line of the pattern, and then a horizontal level of support. But I just figured let's just try it like this, draw it like that. So this is either a symmetrical triangle or a descending triangle. Regardless, it's a continuation pattern. And just like Bitcoin, we have a series of higher highs and higher lows. Again, zoom out and look at the bigger picture. The secular trends are the strongest. These are, when I say secular, these are trends going back, years, 5 years or more, okay? Or long-term trends, secular, long-term, same thing. Intermediate term trend, I'd say, is in the last, less than 2.5, 3 years. 3 years is kind of pushing it. Short-term trend within, the last 6 months. And then, if you're a day trader, it's different. But again, the longer-term trend is always going to overpower the shorter-term trend. because these are what the portfolio managers, the long-term investors are looking at. And I know because they told me. I was on the inside for about 6 years, you know. In order to entice our business when I was working in the financial services industry, you know, we had these guys coming in telling us how they pick stocks, and the rules apply to all markets, regardless if it's stocks, crypto, or bonds or futures contracts. It doesn't matter. So anyways, I digress. We closed above the upper downward sloping trend line. Whether this is a symmetrical triangle or a descending triangle pattern does not matter. Either way, we take the difference between the widest parts of the pattern. So let's say this is, this point right here is around $500. Down here, we're around 100, difference of 400. Project that onto the breakout zone of Ethereum. Let's say this breakout from this triangle pattern projects prices into the $700 range. And I do think Ethereum is going to go higher than that in the long term. But a breakout from this pattern is suggesting prices as high as $700. And, when the day comes, if we ever close above this mark here, I mean, this could turn into a big rounding bottom saucer pattern. And at that point, we could see Ethereum flirting with the $3,000 range or so. That might sound crazy now, but that's good. So that's what I want. I want my bullish forecast to sound crazy, because that means it's not a consensus opinion. And then here we have Litecoin, the descending triangle price pattern, or excuse me, the descending channel price pattern. And here we are just starting to break out above the upper declining trend line, descending trend line. And I'd say out of the three cryptocurrencies that I just shared, Ethereum probably looks the most bullish. And that's due to ratio analysis, which I'll touch on in the future at some point. But yeah, Litecoin has some catching up to do. So if you had a choice between the three, I would go with Ethereum. So let's see, go to the next slide here. Okay, so we talked about chart patterns today, but chart patterns are not all we use. In the Benzinga breakout series, it's 3 levels to it. The breakout opportunity letter, which is a monthly stock pick, the breakout trade alert, which is a weekly stock pick. We talk about our 3 delta factors. And, so it's not just price patterns that we are using to initiate trades. We're looking at other factors, relative strength, volume, various momentum indicators and other stuff too. And the Breakout Elite, which is a publication that's issued 3 times a week, provide 1 to 3 stock picks per publication, published Sunday, Tuesdays, and Thursdays. We use our 5 alpha factors, which explains our rationale to, as to why we're publishing that stock. And, in each of these, we provide a rationale and education, to why we're picking the stock, and as well as actionable trade ideas. We're telling you what the buy point is. Remember, we act off of closing prices, so we want you to focus on the last 5 to 15 minutes of the trading day, as well as stop losses, so that we're always keeping risk management in point. Like I said, you have to approach trading as a business and view losses as a business expense. In any business, you're going to have business expenses, and if you're not comfortable taking losses, like I said, you cannot eliminate the ego. You must learn to manage it and control it. It has to be automatic, and just, if the stock goes against me 7 to 8%, I'm out. And that's it. And sometimes it bottoms right then and there. But you know what? The market takes no prisoners. The market doesn't care who you are or where you're from. I mean, how often do you see these big hedge fund managers get absolutely slaughtered? And sometimes they come back because they know how to manage risk. You're not going to be making money all the time, but if you can be right 1 out of 4 times and still make money, which we can, according to the method that we are using, I like those odds. So continuing education, I could talk for hours, but, we have time constraints, obviously. There are multiple free online resources. Benzinga.com is always putting out great info. I like stockcharts.com, marketsmith.com, Investors Business Daily. The Benzinga breakout series, like I said, we provide actionable trade ideas, trading rationale. And the biggest thing is we like to earn while you learn. I mean, that's a win-win. I mean, usually when you go to school, you're paying for tuition, but in this case, we can make some money too while learning. And then books, I mentioned a few books, some great books that greatly influenced me. I mentioned the How to Make Money in Stocks by William J. O'Neill, Technical Analysis of Chart Patterns by Edwards and McGee. I would classify that as like a Bible of technical analysis that was written, gosh, I think over 100 years ago now. In the book, they're actually providing examples from like pre-Great Depression, like stock market crashes. It's fascinating how the price patterns have never changed. And the idea behind this is that human behavior has never changed. It's been the same for thousands of years, and it's not going to change, regardless of whether the algorithms are, 70% plus of trading volume on, the New York Stock Exchange. And then Technical Analysis of Price Patterns by John Murphy, Intermarket Analysis by John Murphy. Those are some great books that have influenced me tremendously. Remember, capital is like matter. It's never created or destroyed. It merely transfers from one asset class to another. So, there's always an opportunity somewhere. There's always a bull market somewhere. Don't be discouraged by the events of the world. The markets aren't going to go away. Financial markets have been around for hundreds of years. Futures markets have been around since the Babylonian times. Farmers would say, hey, I'm going to harvest this crop in October. I want you to guarantee me this price. We're coming to this contract right now in June, but I want you to guarantee me this price for grains or corn in October when I harvested it. So it's been around for thousands of years, and it's not going to go anywhere. So just wanted to say thank you for watching our presentation, and I hope to see you on the Benzinga breakout series, and I'll be in some Discord chats in the next couple weeks or so. And that's all I have for today.
Wonderful. Thanks, Gianni. As always, I personally learn a lot. I love listening to your sessions because I take them right back to the charts immediately afterward and start looking for breakouts. And again, guys, that's Benzinga breakout where you can get his picks. So one person asked, how do you find these patterns? Well, you look at a lot of charts, and that's what's great about Benzinga breakout is Gianni is doing all of that for you, and he's pointing out what he's found. So go ahead and check that out and earn while you learn. So thanks, Gianni. Thank you very much. Have a good weekend, man. Watch out for this crazy weather.
Yeah, sure thing. I was stuck inside with the rain this morning, so it was okay.
Exactly. All right. Thanks, Gianni.
All right,
next. Yeah, thanks. Next up, ladies and gentlemen, we're going to talk about market structure. And not just market structure, but how to gain an edge by understanding it and analyzing it with elevated levels of information. Brought to you by Tim Kwask. Tim, are you there? You're muted.
There we are. How are you, Neil? Nice to see you.
I'm doing great. It's great to see you. You look good. And I got to say, your backdrop might be better than mine. What are we looking at?
So that's a local artist here in Denver called Stefan Geisbuehler. And we have his work in our offices here in Denver. And they're great. Yeah, people say, is that a Picasso? Well, maybe if you're successful using Market Structure Edge, you could have a Picasso. But we have Stefan Geisbuehler.
Well put. So Tim, I figured it would be good. So we want to get to the point where we're driving Lamborghinis and buying Picassos. Actually, just handing out Picassos to our friends at parties. Could you give us an idea of what your background is and what exactly you're doing over at Market Structure Edge?
Sure. So I have spent 25 years in the capital markets. So it tells you can tell by my face that it's been hard on me. So I started in what is called the investor relations profession. So investor relations is the liaison to Wall Street between big public companies. And our core business is modern IR, which I started in 2005, and it's the largest provider of quantitative equity market analytics to US listed companies. So those companies use our analytics to understand what kind of money is driving shareholder value, what part of it's controllable, what's not. It's used in event-driven situations. Disney, 21st Century Fox, we supported 21st Century Fox through that battle. Qualcomm, Broadcom, our analytics are used to help companies understand what's occurring. And so then we translated that a number of years ago to testing whether we could build a product that would work for investors. And the reason it took us so many years to do so in the first place is that the data that we originally studied was not public. I started looking at the data as an IR guy myself for a mini Verizon in 2001. And I realized that the exchanges provided tremendous data on the kinds of activity behind price and volume. And so that data, though, was not publicly available. Over the last number of years, the exchanges, which are really in the data vending business, they sell all kinds of data feeds. And in 2017, we started looking at some of these. We consume them, we buy them, feeds that are used to help brokers determine if they're meeting the rules. And we found 94% correlation between a couple of those data sets and what we were doing. And now that's what's behind Market Structure Edge. It is the whole idea of market structure, the way that the laboratory called the stock market works, and can you use that to increase your probability of being successful in entering and exiting positions. That's the background. And I'm one of the, believe it or not, I don't know much, Neil, but market structure I do know, and we have become nationally recognized experts. I've testified before Congress, written form. If you're really cool, you do it in person. If you look like me, they ask you to submit it in writing. That was in 2017, but I'm routinely on CNBC. We're quoted routinely in the Wall Street Journal, New York Times, et cetera, about market matters. And that's the thing that we do. We understand market structure.
Fantastic. All right. So, this is a visual thing. So we're really happy to have we think you're a handsome man with a lot of knowledge. So we want you here in person. I'm hoping that you can explain it, because market structure, folks, in chat, it is a term that you may have heard come up. It's not something as common as like support, resistance, those types of things, but it is essential to understanding what is happening in the market, whether you're doing something long-term like an investor or you're doing something shorter term like a trader. So that's why I did get a little bit of a preview. I'll be transparent to Tim's presentation here. And Tim, you don't know this, but I was screen capping things because you have some graphics that were very eye-opening and helped me understand concepts that I've been sort of thinking about for a long time. And you just kind of directly gave me the answer. So I'm personally really looking forward to this presentation, and I will get out of your way and let you do your thing.
Thank you. And we'll keep this snappy so that you don't have to think that I'm going to drone on too long. I'm going to cover just a handful of slides as background to market structure, which, by the way, you can think of market structure to mean the behavior of money behind price and volume. And why would that matter? Well, because it doesn't all have the same purpose and time horizon. And I want to carefully couch this. One of the challenges with looking at companies from a fundamental perspective is that those only count if the motivation of the money that is driving price and volume our motive is fundamental. Is it looking to buy companies that are superior to other companies? Well, 85% of the trading volume in the market isn't. Same with technicals. The challenge with technicals is it assumes all prices are equal. Well, the prices set by high-speed firms are different from the prices set by large indexes rebalancing. And the good news is all of that is measurable. So that is what we call market structure. And Market Structure Edge is meant to take all of this experience. There are a set of rules for the marketplace, just like there's an IRS code. And we hire tax attorneys to help us navigate it because they're experts in it and we don't have to be. And the same principle applies here. There is an IRS code for how the stock market works. We're experts in that, so you don't have to be. And we've created a very simple approach, but it begins with understanding that the stock market is the Death Star This seems like a very complex image, and it is in some sense. The market is a complicated beast in some ways, but it also has very simple mathematical constructs to it. And the thing to take away from this is that on the screen left is a buyer, and on screen right is a seller. And what lies between them every time a trade occurs, every single time. And the market trades many millions of times per day. The FANGs alone trade millions, about 5 million times a day. Then you add in all the other stocks, and this is what's occurring. For a buyer like you to find a seller on the other side of the trade, the process is this complicated. The trade will have to navigate most of the time on an algorithm because that's the law. If you want a trade to match at the best available price, it must be automated. And we'll get to that in the last slide. This won't take long. And what you see here, all those little circles that say DP, those are broker operated marketplaces called alternative trading systems, dark pools. The first place money is going to go is those, so they don't have to pay exchange fees. Exchange fees get subtracted from the trade. The little blue circles is the stock market. And it's not on the corner of Broad and Wall in New York City. It's all in New Jersey. The NYSE servers are in Mahwah. The NASDAQs are in Carteret. The rest of them from CBOE and IEX and others are in Secaucus, and they all interact, and it's like asteroids. Our orders are flying back and forth, and this is the laboratory of the market today, the stock market. And the problem with that is it's going to have an effect on behavior. If you went back to when I started in this profession in 1995, about 80% of trading volume in the market was fundamental, active stock picking. People following the Warren Buffett, Benjamin Graham model of looking for good companies that are going to outperform because they have superior products, financial performance, management strategy, barriers to competition, and so on. There was only one ETF. And the smatterings of other things. In fact, we called other index funds. There were hardly any of them. Step forward to 2020. Look at how the behaviors have changed. Stock picking now is a minority. 86% statistically is something other than active investment. And this explains why so often the market does not behave rationally. Well, you can turn this to your advantage by knowing what behavior is leading. Which direction is it going? It can be a very important tool for traders, and I consider it medium frequency trading that we're sort of focused on. Now, why does the Death Star exist? Well, this complexity is a product not of human choice, but of the rules. Regulation National Market System, everybody should know what that term is. You don't have to know the 524 pages of it, but you should understand that it causes certain outcomes. Reg NMS regulates quotes, prices, data, and access to all three. And so quotes, prices, and data become an end unto themselves. Can you make money just furnishing a quote to the exchanges? Yes. Can you make money changing the prices of the same things by trading them at one exchange versus another? Yes, that's called statistical arbitrage. Can you make money selling data? The exchanges make billions of dollars taking the data that derives from quotes and trades and selling it back to the brokers who must by law buy it in case they're asked by their customers if they are meeting best execution standards, another rule. So let's now understand the effect of that. That's really what Market Structure Edge is all about. And I'll pause there, Neil, in case you have a question before I go on to the next item.
No, I think right now we're in, we're just shocked and awed, and continue, let us process it, and then we'll come back with the questions.
Okay. So Neil, tell me, can you see that dashboard? I'm not sure I have to share a different window. Is it up there?
Yeah, I think you do. Yeah, we have PowerPoint right now.
Okay, let me change the screen. Bear with me. Okay. All right.
Yeah, and guys, chat, just a reminder, I'm here as a conduit for your questions. So drop your questions in the chat. No such thing as a stupid question.
That's right. And by the way, you can go to marketstructureedge.com and sign up free and follow along if you like. It's a very simple platform to use. So I'm going to, and I have a few examples to give. And it would always be interesting to take the items that Johnny talked about and look at those through a market structure lens, because it will tell you the behaviors that are responsible for flagpoles, If a stock bases, what's responsible for that? Is it shorting? Is it fast trading? What's happening to sentiment? And all of that is measurable. So I'm going to click here and we'll just look at one thing. Let's go over and let's just pick Pfizer, for example, which just got booted from the Dow Jones Industrial Average. And we'll just use this as an example of what I'm talking about. Here's market structure sentiment. Here's short volume. I'll explain both of those. I'm going to close this for a second because I want to point out that for Pfizer, the key behavior here is active investment, and the price has come down. It clearly tells us that closet indexers who follow what index money does believe that the booting of Pfizer from the Dow Jones Industrial Average won't be helpful. But it's actually not heavily short. So let me explain market structure sentiment and short volume. They're 90% of what you need to know. The good news here too for day traders is you don't have to watch stocks all day. Look at them before the market opens once, and you're going to use sentiment to help you know when to come and go. And you look at the stocks that you like or that you hold, and if they've reached your sentiment point where you're supposed to leave, then you leave when the market opens. You look at ones that are reaching the point where you're supposed to enter, and you buy those, and then you can go away. And then you'll watch the data to see when you return to those points. So market structure sentiment is not mass psychology. It's not analyst ratings. It's not whether there are more people buying it than selling it. It's not relative strength. It is purely a measure of those four key behaviors. Active investment is stock picking. Passive investment is the exact opposite. It is money that, rather than looking for outliers, wants to track the benchmark. How do we get to the benchmark, and what is that? It's the average price. Well, guess what Reg MS requires of all trades? That they meet between the best bid to buy and offer to sell. Well, what lies there? The average price. It may be time weighted, TWAP, might be volume weighted, a VWAP, could be pegged, could be floating. But the more money that focuses on indexes and exchange traded funds, the more the market is going to have a propensity to mean revert, to return to 5, just like Pfizer does. Pfizer continually returns to 5. So when it dips below 5, you would want to sell it. And when it crosses back above 5, we call this the 5-5 rule. That's when you would want to buy it. And it's purely using market structure to understand how to do that. And the market structure sentiment algorithm is really a measure of how behaviors affect prices and in turn consume all of the supply in the market, at which point stocks are 10 out of 10 overbought and unlikely to rise. Or when they reach 1 out of 10 and there isn't any excess supply, so buying is likely to push the price up. And it is very statistically measurably true. Short volume is not short interest. Short interest is a 1975 measure created by the Fed. It is almost useless for an electronic market because it was created before an electronic market. In 2010, after Dodd-Frank, regulators at the SEC circulated some guidance on how to report shorting. And then the FINRA, which regulates brokers, took that and turned it into several rules that brokers have to follow. A broker who executes a trade has to report 86 data points to FINRA within 10 seconds of a trade. One of those is, are the shares involved in this trade owned by you or your customer, or are they borrowed? And it's all volume is going to be long or short. Those are the rules. So we measure how stocks move from heavily short to covered. When stocks are heavily short, if buying stops, there will be excess supply and the price will go down. If there isn't any borrowing and buying comes along, the price will rise. And why is there so much shorting? Because Dodd-Frank limited the capacity of large banks like Morgan Stanley and JP Morgan to carry shares as inventory. And so they've been replaced by high-speed traders who rent shares at the beginning of the day, trade them all day long, cover them and return them. And they're simply trying to rent an asset and produce a return on it throughout the day. It doesn't matter whether they cover higher or lower. That's not the point. The point is, do I make more with that rented asset than it cost me to rent it? And that kind of behavior is pervasive. So it's probably helpful if we look at a couple of examples, right, Neil? Let me do that. Okay.
Let's do it.
So, for example, let's look at Big Lots. So Big Lots reported today, And they had, and we don't really, look, we don't pay attention to headlines, news, anything, because ultimately sentiment trumps everything. Doesn't mean there can't be distortions and anomalies and so on. But as a general rule, sentiment is going to trump all of it. So here's Big Lots. And I would have said this regardless of how Big Lots was performing. I was preparing this last night and reviewing it and saying, okay, so here's Big Lots. It was a great stock back here in May. And here was a great point to leave it. And then you come back when it ticks up and you exit when it ticks down. That wasn't such a good trade, but generally that will worked well here. Tick above 5, ticks below 5, sell it. That would have been profitable. Same thing here. But notice it is 58% short ahead of results. More than half of its volume is coming from borrowed stock. It hit 10 out of 10, 2 or 3 days before results. Well, why would you hold that? This is just asking for trouble. You might as well be happy with the gains you've got and leave, because if everything stops so that people can look at what Big Lots says, the fact that it's 58% short is going to pull the price down. It's that simple. And look at it, it's down 9% today. And it has nothing to do with fundamentals. They had a very good quarter. So that's an example. I want to show you something else. If we look at, I'm going to go to a different portfolio here. And by the way, this is how you do this. If you know, at the dashboard, you can create as many portfolios as you want. I've got all kinds of them. I've got airlines and cruise ships. I've got cloud computing, all the sectors. There are 11 of them. COVID-19 plays, the FANGs, very important. But the example I want to go came from a user. So I'm going to go to this. So he mentioned Owens Corning. He said, can you explain to me how one would approach Owens Corning, which has been a great stock. So between, let's go do the whole range here. Let's go out 3 months. So from May to present, it's up about 50 some percent, 53%, let's call it. Well, if you use market structure to just the 5-5 rule, buy when it ticks above 5, sell when it returns to 5. And why does that matter? Because the whole market mean reverts. It keeps returning to 5. So you can consider it this way. There's a plane called 5. And when you swing out above it, at some point it's going to mean revert. As that mean reversion begins to happen, you want to leave. If it goes below 5, then wait till it comes back toward 5, and then you can catch the wave again. It will not, no system works every time. Statistically, we have 15 years of data science. This will work 83% of the time. It will also mean that you have minimal losses. But if you traded this just from about May, right there, 5.4, buy it May 20th, May 21st, and you leave when it dips below 5, here it is, sorry, went past that. That is it's a crazy return. It's a 22% return in a very short period of time. And the best news is if you bought and held this, your money would be in the market for 83 days to get a 53% return. Well, if you can make 22% in 32 days, go do something else with it. You could go look at Zoom, for instance, which reports Monday. So let's go look at Zoom and see how it looks relative to market structure ahead of results. But the point is, you want to use a very consistent plan to come and go. And sentiment gives you a very simple measure. You don't have to even look at a chart. You just look at sentiment and see what it tells you. So if we look at Zoom.
So really quick, Chad, guys, what you're seeing is a very unique way of looking at what's going on with stocks and timing trades. This is very unique. I know a lot of folks are new, so maybe a lot of the stuff that we're seeing seems unique to you, but I've not seen anything like this, especially presented so simply elsewhere. And the 5-5 rule that Tim is talking about that's like stupidly simple. And in that ratio of what did you say? You've back tested data, and it's 83% of the time it tends to hold true.
Right. Yep.
So this is really unique. I've never seen this product before we started planning for this boot camp. So do yourselves a favor and get a trial and check it out and follow along with what he's saying, because this is not something that shows up everywhere else.
And
I just want to emphasize that. And then, guys, if you have questions, we did get a question about whether or not crypto shows up on here. I said that it probably doesn't because there's not an exchange that needs to report on crypto. Is that correct, Tim?
it is. So the reason this works is because of the regulatory structure. So for cryptocurrencies, there isn't a Reg NMS. There isn't a uniform regulatory structure that combines all of the exchanges and forces them to share prices and customers like Reg NMS does to US equities. I think it's somewhat unfortunate, but it is what enables us to do this mathematically, and at this point, not possible to do with cryptocurrencies.
Okay, that's great. So now we're starting to get questions too, just so you know, Tim. But let me know when you're ready for questions, okay?
Okay, and I'll wrap with this. That we'll make this our last example and just take questions. And by the way, I use it. So I trade in an Interactive Brokers account. I pay a commission because I want to see where my trades go. It doesn't cost and I'm not recommending Interactive Brokers over somebody else. I think the interface isn't great, but my point simply is this: it doesn't work every time. I traded BAM, Brookfield Asset Management, a couple of weeks ago based on sentiment, and I had to take a small loss. It returned to my sentiment target, and I sold it, lost $150 on about 200 shares. But at the same time, I was trading Microsoft, and I made thousands of dollars on Microsoft between 210 and 216 using the same principles. So the point simply is, I don't want you to conclude that you will make money every single time, but it will help you control losses. You can see that. If sentiment here drops below 5, it's 4.4 there, leave. Now, sure, you would miss this little bump here, maybe, but it's what Johnny said. You have to be comfortable with your method. Have a method, and this is very simple and very consistent and mathematically defensible for doing what you do. So let's look at Zoom right ahead of results. I mean, it's let's check short volume, 51%. It's a 10. You know, it could run. It was a 10 a whole long time through here. Here's your entry point right here. And you would not leave until here. And that's a 67% return in 43 trading days. Well, that's tremendous. Be happy with that. And then you might want to move on because the likelihood of duplicating a 67% return in the same stock is statistically highly improbable. So find something else. And if I were looking at this, I would say, no doubt Zoom will have great numbers because they are a pure pandemic play, but I would leave based on the fact that it's a 10 and it's 50% short. Let's go find something else. Okay, questions?
Okay, so one is, I think the probably the most foundational here that we should get out of the way. Can you sum up that 5 rule again?
Yes, and there are 3, but the 5-5 rule says sentiment ranges from 1 to 10 and everything mean reverts. The whole market does this, and we measure it for the whole market. So you can see what it's 4.9 right now in the broad market. So the 5-5 rule says as stocks move above and below 5, those are opportunities. As they rise above 5, it's telling you predictively, it's presaging the gains because money is returning and beginning to improve sentiment. When it peaks, then you know that the supply-demand equation has hit equilibrium and it begins to come down. That too will be predictive. By the time it returns to 5, leave. And then the effect of that reversion will manifest. That's what the 5-5 rule says. For stocks that bounce continually from 1 to 10, trade that. You can look at a chart, see the graphics are over here on the left. You can go look, and if it moves from 1 to 10, trade 1 to 10. Buy it when it's a 1, sell it when it's a 10. And the third approach is to buy the uptick, sell the downtick, regardless of if it's orientation to 5. Those 3 things will accomplish 95% of situations. And it doesn't matter what a company does, whether it's declined. You could trade ExxonMobil. It's down 72% this year. You could go make 15% using the uptick downtick approach on ExxonMobil. It doesn't matter what stocks are doing, what industry they're in. It all comes back to mean reversion.
Okay, and then so we're getting kind of, this is a very specific one around a rather notorious company, Herbalife. Herbalife today went down from 50 to 42 after being charged by the US government. Then price went up to 48 due to volume. Is it related to sentiment, or how you explain, or how would you, Tim, I suppose, explain this sudden price change?
Let's go look. So I'm just going to create whoops, it's herbal.
Okay.
HLF.
While you're doing that, really quick, Marie, brokerage website says they don't allow day trading. What's the best day trading broker? As long as you have $25,000 in cash in your account, you're able to day trade while avoiding what is called the pattern day trading rule. But you need to have at least that much money in your account, and most brokerages will allow you to buy and sell the same asset within a 24-hour period.
And the good news here is that's rarely the case. The cycles that we're following tend to run about 10 days. And so I call it, again, medium frequency trading. You're not sitting watching screens all day. You're making a decision once a day and saying it's probably going to take a week for that to hit my target. And that works pretty well. Okay, so let's look at Herbalife. Notice 7 out of 10, 47% short. That's net long. That's actually not bad. Passive money is the lead behavior. How about that? Why is that occurring? Because we're in month-end window dressing. Monday is the most important trading day of the entire month for passive money. There's a big futures contract that the CBOE created in 2014 in response to the explosion of passive money to help passive money true up its tracking relative to a benchmark. So, because it's very difficult to buy smatterings of hundreds of stocks. So what will happen is BlackRock will pay Goldman Sachs or whomever for a futures contract, and then Goldman Sachs has to true the portfolio up on the last trading day of every month. So let's go look at the patterns here. And here's what we see. So how about that? So even though you have terrible news, what is happening? Here was your entry point. So sentiment is rising, shorting is falling. That will overpower news. Doesn't mean it's going to hold, but that's the reason the stock is up. Passive money is a buyer of the stock into month-end window dressing, sentiment's rising, shorting is falling, and that's why you get that contradictory occurrence, Neil.
Great. All right, on to the next one. I think, guys, if you have particular stocks you want to look at, I think that's a good idea. Drop some tickers in here. So another one that we want to see is Barrick Gold. Are you able to look at that?
Absolutely. Okay. Let's back. I like to always do about 3 months because you want to have enough time, 6 months, 3 to 6 months. Okay, so this has been a great momentum stock until here. And it's losing those characteristics. It would protect you. So here's your entry point. When it ticks above 5, keep holding it. Hasn't dipped below 5, hasn't dipped below 5, stays right there. Oh, yeah, now you're out. You would come back here, but clearly the trade isn't as good. So the returns that you would have gotten here, this is probably going to be a lost trade. Won't be much. You might lose 2-3%. But the fact that sentiment did not return to 10 tells us that the momentum characteristics that have typified Barrick have broken down. So it's probably a good time to go find something else.
All right, there you go. Next up, we have NSYS. I love it. Yeah, once you mention trade ideas, the comments really start rolling in. Keep them coming, guys.
We know Ansys well. This is one of our corporate clients, actually.
Okay.
Yeah. Okay, so once again, let's look at wow, that's real. It's a tremendous. That's a tremendous operation. This has been a great stock to own. It keeps reverting to 5. Here's your 5-5 rule. Buy there, leave here. And that's a decent game.
And then, folks, so we got asked again about the 5-5 rule. So he's mentioned we were at that mean of 5. That's that entry point, and then the sentiment's going up, and then we're coming back down to 5, and that's an exit. Is that a pretty good summary there, Tim?
That's exactly right. Let me drop the price out so you can really see this. So that's the sentiment. So every time it's below the 5, see that? That's going to be your entry. That's going to be entry exit. Enter, exit, and then come back. And as long as it stays above 5, keep holding. See, it's still a hold. And look at this collapse in shorting. Looks to me like this is you don't see them very often. You will hear the media talk about, oh, it's a short squeeze. Well, it's only true if this happens. We see all the time people say short squeezes, and it's not a short squeeze. It is a derivatives event, risk management. But this indeed is. And so with short volume imploding like that, even though it's a 10, hang around. That's a tremendous, that's likely to continue to rise.
Mm-hmm.
Yep.
And guys, if you have questions about specific stuff like short squeezes, how they work, what they are, what they mean, save that for the 3-week intensive. We can dive into more detail on that. We got some more tickets here, or tickers rather. Let's look at Salesforce. We got CRM.
And Salesforce benefits from the fact that it's in the S&P 500. It's added to the Dow Jones Industrial Average. I think it's also in the QQQ, and it has an immense amount of demand as a result. So let's go look at this. Again, I look at that and say it's a great 5-5 rule stock. So here, and you would enter here and you wouldn't leave till here. And it's been flat. So you can go find something else that does better, then come back here, leave here, and return here. And now you're watching. So it's a hit of 10, and you've had very good gains, low short volume. In situations like this, boy, I tell you, even though it's a 10 and you don't have to leave until it returns to a 5, prudence may suggest that you might want to just pocket your gains in that. But look, it's not a problem yet by any stretch. Look at the downtrend in shorting. And high shorting will constrain price. Lower shorting takes that weight of excess supply off of a stock so that it can rise. And there's no question these things look pretty good, but again, it's hitting 10.
All right, next up on the list, our growing list, NAK, which I don't know.
I don't know that either. We don't have that. So I should mention, we concentrate on the 3,000 largest stocks in the market because they're 99.9% of market cap. Here's a little, cocktail party trick for you. You can walk up to somebody and say, how many stocks are in the Wilshire 5000? And you would think, well, 5,000. No, 2,495. The number of public companies continues to shrink. So behind the scenes, we can add that in 10 minutes, it will be in the system. So I'll make a note for our engineers, but we don't have that one in that 3,000 group. There can be reasons, like there are certain characteristics that cause it to be excluded from that group, easy for us to add.
Fair enough. All right, let's look at, okay, we got DKNG.
DraftKings. Boy, talk about a moment in the spotlight, right? DraftKings, it's really, really fascinating. And here you go. Well, I mean, it's just been tremendous. Notice what has caused this price to soar. Number one, here's your entry point. You can buy this at a 1. This might be a great 10-1 because when it's a 1, it rises. When it's 10, take your profits, come back at a 1, hold till a 10. Look at shorting. It went from 47% to 31, collapse. So that again is a short squeeze, or that people don't want to loan their securities out. Well, most shorting is automated. So machines will swing around and simply take a basket of them. If suddenly the cost goes up, they don't put it in the basket and you see a collapse in shorting. So that's very bullish, but again, be watching that. When this ticks up, when short volume begins to tick up, that's a good time to leave.
All right, and then I'm just grabbing one kind of at random here. You know, everyone's going to keep asking about it because it's come up a couple times. Can we look at Tesla?
Of course, yes.
It's kind of a given, I guess.
One of the, I mean, it has now become the #1 most active traded equity on the planet. SPY has long held that crown, the largest ETF and the oldest, created in 1992. And now Tesla trades more than that. We track that. They trade close to $30 billion of stock every day. It's extraordinary. It's just, it's one of the greatest phenomena we have ever seen in market history. And again, it would be a perfect 5-5 rule. You buy when it ticks above 5, and you would have held all the way to here, and you would have skipped the little rough part and then come back when it's up above 5. And right now, watch short volume, it's ticking up. So it's at 54%. So you start looking at that. There's no question that Tesla moves higher when shorts cover, and it's constrained when shorting is higher. So you're getting close. I would say you got 3-4 days, and you probably want to take your money and run for the moment, just for the moment.
Yep. Interesting to see the shorts returning to Tesla. Tim, I'm going to, now that we've got about 2 minutes remaining,
Okay.
I got a great question here in chat that I think would be a great closer here.
Okay.
The question is, what software is he using?
So this is all proprietary. We built this platform. It runs on for you data geeks. We run in Microsoft Azure. Our whole architecture for 15 years has been .NET, Microsoft Azure, Windows servers, but we can write in anything. It's mostly architected in C++. I'm getting into the weeds, but this is a SaaS platform. It's a super fast, super stable, super secure.
Tim, I don't think they're asking what it was built on. I think they're asking what the product is.
The product. Okay, so the product is called Market Structure Edge, and go to marketstructureedge.com, and you can sign up for 2 weeks for free. We encourage you to reach out. We have awesome support. We'll be right on it. We'll help you at any time. I myself did 3 different web meetings yesterday, helping customers use the data. And we'll help you use it, and we encourage you to try it. You know, we should expect you to, the cost, by the way, after the 2 weeks, $99 a month, $8.99 for the year. And we hope that you, as I did, I made 2.5 times the annual fee on my Microsoft trade alone. And I probably trade 10 times a week, thereabouts. So that's what if we don't do that for you, fire us.
Yeah. So will this work on a Mac? I mean, it's web-based, right? This will work on any.
Doesn't make any difference. Mobile, Mac, Windows, Android, doesn't make any difference.
Great. And then some questions about pricing after the trial.
Right. $99 for a month, $8.99 for you save a bunch on the annual, but we always say, try it for a month and test to see if what we're explaining works. And it's very consistently true. It's a great way to give it a go.
Wonderful. All right, Tim, thanks so much for taking us through all of those stocks, explaining market structure, and overall just regaling us with some really interesting technology, Tim.
Happy to do it. Thanks for having us, Neil. Appreciate it.
All right. Have a great weekend, my man.
You too. Bye-bye.
All right. So who do we got? We got, is Hot Stocks Luke Jacoby around? I thought I heard hard to see video is not clear. Yadi, that's probably just you. You're the first person to mention that. Try refreshing. All right, Hot Stocks Luke Jacoby looking like a villain from a Batman movie. Not sure what's up with that, with the lighting, with the sound effects. All right, Hot Stocks Luke. You had something interesting you wanted to tell me about. What was it?
I've got another joke for you, Neil. This is a good one. All right, ready?
Yeah.
What is a marsupial's favorite cocktail? A pina koala. that one's pretty good.
Yeah,
maybe better than the Winnie the Pooh one. But more importantly for you, Neil, I've got a hot stock pick. You ready for it?
Let's go.
All right. Well, let me ask you some questions first. Okay.
Good.
Do you want exposure to market upside?
Yeah, I do.
Do you want a stock that might actually do better if there's volatility / a downturn in the market?
Yes.
All right. My pick is Virtu Financial. Ticker Victor India Romeo Tango, VIRT. They are a market maker. They provide trading and liquidity services into the market. They have been hot this year. The stock is up 40% year to date versus 20% for the S&P 500. I myself am getting a little bit nervous with markets toppy at all-time highs while we are still battling this coronavirus. So I loaded into the stock this morning. It was down on a block trade pricing a little bit below the close yesterday. So I'm loading into it. Virtu Financial, that is my pick. If the market has a spike in volatility, a spike in trading activity, which would correlate with a downturn, this company will do better.
All right, very good. And on that awesome stock pick, that awesome pitch coming from Luke, that's VIRT. I dropped it in the chat. Next up, we are going to have some technical and fundamental analysis coming from our options expert, Nick Shaheen. I do want to remind folks, more stock picks. We're going to be giving stock picks. We're going to be giving ongoing mentorship. We're going to put you guys into a chat where you can share your questions, share your learnings with each other in the 3-week intensive portion of the bootcamp. So make sure that you purchase that bootcamp bundle by scrolling up on your Hey Summit screen and then going to the Buy Now bar. So Luke, is there anything else that you want to share with us? Any dad jokes or anything else before you take off?
The only last thing I'll say is that I got a message from Corey saying that she's going to be joining us for the 3-week mentorship program. So I hope to see all the rest of you there. I get very excited about this stuff. So
yep, a joke a day from Luke. He'll be there.
There you go.
As
That's
well.
a bonus.
No,
That's a
no,
bonus.
no.
All right, Nick's here. All right, finally.
All right, peace out, guys.
Where can I unsubscribe from a joke a day from Luke?
just reply by text. Unsubscribe. All right, thanks, Luke. Hey, what's going on, Nick?
All right, it's Friday. I'm happy about that.
Yeah. Yes, me too. The weather is crazy where I am. We got a little hurricane action. What about you?
We've had a heat wave here in Southern California, and it's starting to break.
All right. Well, that's nice.
Yep.
So I entered you as our options expert. Nick is the editor of Benzinga Options, where we talk about everything from single leg options trades up to option spreads, like you would have seen with Options AI. He's someone that what he says is what he does. There's no BS here. I would refer to him as the no BS educator. So definitely pay attention here. If you just want just the brass tacks, damn it. How do I make money using options? This is your guy for the job. And just a reminder, guys, no more jokes, LOL. We'll see about that. In chat, use chat for your questions. I'll be your conduit to make sure that Nick answers those. Yep. But without further ado, Nick, I'll hand it off to you.
Sure. So you correct me a little bit. I thought we were going to do fundamental basics today, unless you want me to skew it a little bit.
No, I would say let's stick to the fundamentals.
Okay.
And
so I'll try to keep it interesting, and I'll try to tie everything else. In fact, I want to start with tying something. I was listening to Tim before me, the presenter. So he mentioned HLF, right? And his tool looks fantastic. I want to poke him for that to look at it myself. So I want to start by saying there isn't one tool that's a magic bullet. If you're looking for a magic bullet, even though his software looks like a magic bullet, it's just going to be one piece of your puzzle. It's going to be a tool in your tool belt. I'll give you an idea. They say, why did it stop where it stopped? The +5, -5, whatever, it could have told them that. But I could have said the same thing just by looking at the chart. In fact, where my mouse is right here, if you just look left and see when past times this occurred, and it's almost to the penny. So if you look back here, this was a major turnaround place, and it matches exactly. And here and this is not a coincidence. So don't look for a magic bullet. It's all part of little tools. So technical analysis is a tool. His tool is a tool. Your brain, your eyeballs, everything is a tool, and you put it all together and you develop a system that works for you. So you don't, first of all, don't make mistakes. All right. That aside, let's just jump in. So the disclaimer, I'm pretty sure you've gone over that. I am not a trader by schooling or anything. I'm an engineer, and then I did an MBA, and then jumped out of the corporate world, did the .com thing in the beginning, and then now I just do this. And you can find me on social media at RacerNick, okay? And what I'd like to say that I'm Main Street rather than Wall Street because I didn't grow up with them. I don't believe what they believe. And I think it's somewhat of a rigged game to the point where you have to assume that there's a big bad person out there that wants to hurt everybody at all times. So if you come out with that mentality, then you're down to earth, humble with your expectations, and that causes you to poke your own thesis over and over to make sure that it's bulletproof before you jump right into it. So I have two goals today. The first sounds stupid, but I think it is so important and people skim over it to define risk. And I bet you you do not know how to define risk properly in a way, or at least to explain it to somebody. You probably believe it or understand it, but you can't explain it. But if you explain it to yourself almost every time, then you're less likely to make a mistake, or you will better manage your risk.
your trades, your positions. And then we're going to do a fundamental analysis introduction, the mnemonics, you know, the way I look at them, which dumbs it down to where like it's plain simple English, like you and I talk every day. We don't talk fancy stuff and Greeks and all of that. So I'll try to bring it down to that level. All right, so let's go. So what is risk? I'm going to give you a minute to see if you can explain it to yourself in your head. What is risk? And I bet you're going to say something like, it's how much money I can lose or things like that. And it's all correct. I'm just looking for one particular, like not one answer, but the whole thing. So first of all, everybody gets this right. Risk size. What am I risking? What's at stake? If I'm jumping a motorcycle ramp, is it big enough to kill me, break my arm, twist a wrist? That makes me decide whether I want to take it or not, right? Risk size. So it has to be appropriate. It cannot be anything that's gonna, if I wake up and I'm thinking about it and I'm nauseous, it's too big. Okay, that's probably the easiest way. If I can't get it out of my head, it's too big for my portfolio. So proper risk sizing makes you have better conviction in your positions, right? So how much can I lose? How much can I lose? It's really important to know. The other one is the risk position. This is what people don't realize. So the position of the risk is like, where do I take it? In options terms, it's a little more complicated and I have so many more options. Whereas if I'm buying and selling equities, just stocks or ETFs, it's more like, is it time to get in or get out? Like that 5-5 rule you guys were looking at and gals. So that's important, but that is really, what are the odds of me losing, right? Or winning, whichever way you look at it. So what are the chances? So first of all, how much? And what are my odds? What are my chances? Those are really important. So as soon as I decide to take the trade, this decision is set aside. I don't worry about it anymore. I accepted the risk, I took it. This is the part I manage. So when they say, how do you manage risk? They always refer to much, how much, how much. Whereas they should be mentioning this. What are my odds? Because the odds change as things change on the charts and the environment and the stock and the headlines. Like today, Wynn Resorts is flying off. And I read another headline that MGM is laying off, I don't know, 10,000, 18,000 people. So it's like trying to consolidate those two facts, you know, that doesn't make sense. So what are the odds? So risk management speaks to managing this part right here. And of course, there should be no hopium. What do I mean by hopium? If I don't have a reason anymore to be in that position, then I shouldn't stay in it or, quote, manage the risk. I lost or something has changed and my thesis is broken. That happened yesterday. I had a discussion with somebody who had a Facebook trade that was going against him expiring today. So they took a bet at a level, I think it was 285, and they lost. They were long and short, but they were losing money from being short the short part at 285. And he said, how do I manage this? And I first asked him, do you still believe it's going to fall below 285? He goes, no, my assumption was wrong. I was like, why are you managing it? You took a bet and you lost. So why throw more money at it? So I said, if I want to manage it, I would make sure to not increase my level of risk. So if you want to move it anywhere, make sure you're not adding to your problem. So this is really important. No hopium. If you don't know why you're still in it and you're just hoping for the best, then this is not the proper way of successfully managing a portfolio for a long period of time. It may work out for a little bit, but then you wouldn't last in the game for a long time. So basically, you want to know what to trade, the thing pops up, what to trade, where to trade it, and when to trade it, and how to manage it. If you get all of these right and put them into a system, if you're not looking at all of these into a system, like going systemically, every time you consider a trade, then you're not doing it like a pro would. And I'm not saying that you're an amateur and amateur is bad, but the difference between somebody who's doing it willy-nilly and somebody who's doing for a living, the success is where somebody has a method. They have reasons to get in and get out and do this and do that. And it's easy to get those. Just do the right thing often enough and they become mechanical. Until then, just write it down on a piece of paper. So this is just the really important step, the definition of risk. And I've done this in rooms where I've had like 1,000 people, and I did not get one person that got it right. But I bet you most of them know it. They just don't know how to verbalize it to where they can actually use it. So when you dumb it down to like, how much can I lose? And you put that aside, and now you can concentrate on managing what matters, which is the odds. And you have to manage that every day. I go through my portfolio and through my watch list. What are the odds of this happening? And should I still be in this? I did it myself today to the dollar. I have a trade in the dollar. So this is how you have to do it every day. All right. So investing in the stock market, it's really easy. You buy and hold, or you sell short if you're just not using options. And you have to time it, and you're not going to be perfect in timing it. The point of the slide is, this looks perfect. It's never perfect. In fact, doing the right thing is almost never the perfect thing in hindsight, but you have to do it every time. What's the right thing? It all depends. Staying in the trade might be the right thing. Booking a loss might be the right thing. Like, I should have, last week I had a trade that would have won, but it was hitting my limit to where I needed to get out and book partial profit. I did. I left a lot of money on the table, but that was the right thing to do. And in hindsight, I didn't cry over it because I did the right thing. So that's the point of this. So it's not nice and neat, and you have to do it over and over to where you practice doing the right thing. Like if you book early and leave money on the table, you do it often enough, then it becomes easier to do, and it wouldn't be so much of a struggle. So that's why I want to talk to Tim later to see. I have excellent charting skills and timing entry, but I usually leave early. So maybe I use his tool to help me understand that, hey, I could ride the trade a little bit longer. So you see how I mean that you need more tools in your tool belt, and you don't need 1,000 of them. You don't need all kinds of technical analysis. You need the tools that work for you, and that's different for every person. All right, so the fundamental analysis, this is the tricky part, okay? You hear it on CNBC, you hear it in, okay, last year, if there was anything I heard on CNBC all year was, you can't touch Amazon, this is an investment year. I bet you if you watch CNBC, you've heard, what's his name, the guy with the Bitcoin. Anyway, he kept on saying, oh, it's not for me. He told you, Bezos told you he's going to be spending. And I'm thinking to myself, this is the time you invest in him, because every time he spends, he comes up with gems. He reaps the rewards at the other end. So I was saying, hey, buy what this guy is selling, Beakers, whatever his name is. So you buy that concept. Him and Grasso was saying it all the time. So you buy that concept. And look what happened. I think the stock was in the, 1,400, maybe 1,500. So needless to say, you would have made money. So the analysis is not, they use the same ruler for everything. So here's how I approach it. If you tell me, hey, what about this company? Yesterday, I wrote about 3M. Okay, so first of all, I look at the macro. What does the world look like around 3M? Okay, so I have to say we're in a pandemic still. Everybody's freaked out about COVID. The behavior is going to be like this. It's not going to be long, blah, blah, blah. So you have to look at how the world looks like right now. Is it growing? The world is definitely not growing. We had negative GDP here in the US, and we're like the best of them. So you have to consider the macro. So there's no like explosive growth coming. So there's no reason to like completely buy into it. So I consider the economy, the industry it's in. If you can pinpoint sub-industries, like tech is not an industry really, you have to look at what's inside tech. And then you look at the micro, which is what the company is like. So then you look at, you read about what the CEO is saying, and you see if there are any intrinsic factors built into the company to it, like, do they have a dividend? Is it in danger? You look at their cash flow and all of this. So you try to, and if you don't know how to do this, read about it. Tons of people write about it, and you can just read and educate that one. So how does it look within that world itself, the micro? So you look at the PE, and the nuance there is great. And I'll tell you in a second. You look at the PE, you look at the price per sales, and this one is a big beef with me, big. I'll show you in a little bit. And then you develop your thesis. Okay, so when you develop the thesis, this is where the problems start. That person I was speaking to yesterday about Facebook that was asking me for help did not have a thesis. He was just trading the range. That was it. So if you don't have a thesis, how do you know when to get out? Because then if you're wrong, you have to get out, right? Either with a profit if you're lucky or with a loss. So you have to, this is where the problems start. If you don't have a thesis, then you don't know what's the milestone that would cause you to change. So you need a reason to be in that trade. And then you need to set the goals. What are they? The goals as to when do I get out and when for a profit, and when do I get out, stop myself for a loss. So when I enter, I'll say, all right, if I'm wrong, I should be wrong and the price should be there, then I'm out, then I'm wrong. Or if I'm really right, then the price should be there and I'm out. Then they can ride. Like last night, I took a trade for Disney long. I shared it with the people. And then this morning, I booked it early, as usual, but I made my money. It was 40 cents on a base of $1. So that was a good percentage gain. And I didn't want to risk it. I could have squeezed another 15 cents out of it had I waited later in the day, but I didn't. But I'm not crying over spilled milk. I had my goal. I got it. I'm out. So you have to set a goal. And then you put these together, and then you become suddenly more educated as you would be a better, with more conviction into your trade. So you keep it simple, you keep it repetitive, and there's not one magic wand. I added this last minute. As soon as I heard Tim say that and show his tool, I was like, wait a minute, that's a great tool. I want to add it to my toolbox after I try it out. And then, but it's not the magic wand. I'm not going to ditch everything else I know. All right, so let's go back and look into some of these, because this is where a lot of mistakes happen right here. So they talk, people get upset at Amazon. Oh, I remember when I really got upset with the CNBC comments on Amazon last year. They reported one earnings report, I can't remember which one, and they missed on earnings and the stock fell. I was like, you're reacting to the wrong line, all right? So you have to first define the company you're looking at. So if I'm looking at Amazon, I am not looking at profits, because we all know it's a company that loves to spend money, but returns it. It's profitable, it's very profitable. But let me show you a little trick here. So people look at price to earnings. I hope you can see that. So price to earnings ratio, 130. Oh my gosh. And then the earnings report comes out and they missed on earnings, price to earnings. They missed price to, I don't even listen to the price to earnings number that they talk about. All I care about, did they miss on their sales number? They never miss on their sales number. And they are crushing it. They're growing their sales top line 28% over 5 to 10 years. Who does that? Not a mega cap this big. So that's why when I'm evaluating if it's a good time to get long Amazon, is I look at the sales performance, not the bottom line performance. So first of all, when you're looking at a company, you would look at what kind of a company is it? Is it in its growth phase? Then I would judge it based on the top line stuff. Like, this is really important, price to sales. So this is the stock price to its full year sales. It's only 6 times. So in plain simple English, it means I walk up to a pizza shop and I say, hey, I love your store. I want to buy it from you, the whole business. I will pay you 6 years worth of your sales. Would you sell it to me? That sounds pretty cheap for Amazon, in my opinion. Okay, so I will show you one that will blow your mind. The Tim before me mentioned Zoom, right? He said, take your money and run. I would tell you to take your money and run for different reasons. Okay, you remember that 6 number? Look at the number in Zoom. So this is how much, quote, hopium there is in the stock. I walk up to the same pizza shop and I say, hey, I love your store. Let me pay you 120 years worth of your sales. Would you sell it to me? He would, he wouldn't even pack his store. He'll give me the keys and walk away. 120 years worth of sales is built into its current stock price. To me, that is, I don't mind the 1700 PE. I promise you that. The fact that it has an E is outstanding. So it's not losing money. But like Shopify doesn't even have a PE, but it's like 70 years. That's still expensive, but I can swallow 70. So you're telling me that this stock is 20 times more expensive than Amazon, which is expensive by anybody's guess, right? So this is where okay, this is a growth stock. I get it, but there's a lot of hope built into the sale. So this is where I say, okay, I want to buy Zoom. I love it, but maybe at a lower price. Even if I have to miss on the upside, here's the easy way to say it. This is not an obvious time to get long. That's really the easiest way to say it. So back to the point, PE, price to sales, whatever metric you're using, make sure it fits the company. So if I'm looking at Chevron or Exxon, which by the way, they would both make a good bet right now, because Exxon just got booted out. Everybody's spitting at it. It yields like 9%, which is kind of scary. But the CEO promised he would defend the dividend at all costs by cutting spending, and he promised that he has more spending to cut. I prefer the Chevron stock, not the company. I really don't know the difference between the two, but the stock behaves better. But in a world where there's no interest or dividend yield anywhere, in fact, in Europe, you have to pay money when you buy a bond, which is insanity. But anyway, so you can't get anything from the bank. You have to go into stuff like this. This will deliver you 5 to 9% between those two stocks, 6 to 9% in yield. So even though they're not exciting, they're not growth stocks, they're just mature dividend plays. So I don't judge it by growth. I don't look at price to sales in this case. All right. So I would look at the PE relative to itself too. So they say Apple is expensive. Well, its PE is like 36, is not that expensive. But just 6 months ago, it used to be 18. So relative to itself is expensive, but they say it's changing profile now from a product to services. So I'll give it a go on that one, a pass. So this is all to say, make sure to match the metric to the type of companies you're looking at. So if you're looking at momentum stocks, I call them MOMOs, then you have to judge them on growth. Are they delivering? If one of these MOMOs misses on sales forecasts, that's a reason to sell it and sell it hard. Punish it, I should say, from the stock price perspective, because that's their job, not profitability. Zoom's job is to grow its sales, not just user metrics, which it grew because of the pandemic. Now show me the money. Is the user metric translating into profits? So maybe you should call up your teacher friends and say, are you all using Zoom? And you know if the school is paying for it. Because if it's not, I think the sales number is going to disappoint. Because none of my friends are paying for Zoom. Neither am I. So make sure you match up the company type with the type of metrics you're looking at. PE, everybody knows it. It's one that they use most often, but it's not appropriate for growth stocks. Price to sales is more appropriate for growth stocks. You can look at cash flow from all kinds of stuff. So I'll give you an idea. I used to be bearish Tesla as a company. I'm not shorting Tesla, but bearish from a perspective of you tell me it's not a car company, but yet 98% of your income is from cars and every headline is about cars. But guess what? It's changing now. And the most impressive part is that he somehow, I don't know how he did it, he grew cash from operations, right? The free cash from operations, it went from like negative not too long ago to like 2 billion, 2.5 billion last time I checked. That's pretty freaking impressive. Well, when you see a growth company be able to deliver something like that, you have to respect it. So I changed my mindset on Tesla, and now I eat my words. And it's showing some. It's not a place to buy it, but for me, but they legitimized some of their financials. So make sure to look for the right metrics that you understand, and you can keep it simple as just these two and a couple of other things. Maybe look at debt. Everybody thinks Apple is great. I don't. I think Tim Cook is killing Apple, And in 10 years, if he doesn't come up with the quote next big thing, it's going to be irrelevant. And here's the point. It's not growing. Price to sales, PE, all that is not growing. And they are going to, they're switching to services, but it's all tied to one thing, the iPhone. What if Amazon comes out with a ring that you can wear around your finger and you can talk to your ring? Then the phone is obsolete. What's got Apple? Then Apple is playing catch up. So, and then its entire income is dependent on that. So know to which metric works and just use your imagination with all the other offshoots that may come up with it. But don't get too wonky. I mean, the balance sheet is huge. Another thing, Apple, when Tim Cook took it, had zero debt. Zero, absolutely none, not one penny. And now it has almost 100 billion in debt. Not that it's like highly leveraged because they have a ton of cash, but they have a ton of debt too. So that's not cool. If he took that to buy TikTok, I'd get it. But he took that to pay dividends and buy back shares. Not the greatest thing to do. So put that company in Bezos or the guy from CRM, Benioff, what would Apple be? Wow. All right. So this is just the basics, really. It's as simple as this. There's no need to delve into every line item on the P&L unless you know something specific about it. But if you didn't know anything, I would look at price to earnings for fundamentally mature companies. If like Apple, now earnings are important. I want to know price to earnings. Price to sales doesn't really matter, and it's about 10, so that's really high. Price to sales is twice as Amazon almost. Let's say 30% more than Amazon or 40% more than Amazon, and it doesn't even grow. Amazon grew 42% this year. You say it's lucky from the pandemic. They made their own luck, don't you think? Yeah. So this is where a little bit of logic works. All right, so little recap, macro. I saw the Tim's header said sentiment, right? So this is where I'm going to give you a tool for the macro. The markets need three things to rally. They need liquidity, which is what the Fed provides, and we've got way too much of it right now. And we need market structure, which we have already. Everything is there and operating fine, and all the investment products and instruments are there. The only variable is this guy, sentiment. And that one, are there any youngsters here? That one's a bitch because it bites and it flips on a dime. 2018 December, we were falling into an abyss. If you remember, it was depressing. Everything was great, but the sentiment was violently negative. And it flipped on a dime when Powell said, oh, we didn't mean we're raising rates on automatic. We meant we were taking the rates to zero. And then that was it. Sentiment flipped, rallied. That's all they needed. That's one of the three ingredients that changed. And right now, this is not changing. He told us he's committed, pedal to the metal. This is not changing. Everything's working fine. This is what's changing. So as soon as sentiment flips, it's going to be a violent ride down. And the higher we go without a mini correction, the more violent it's going to be on the way down. And to make sure that this is global, whatever I'm looking at on the macro, because we're not so much US centric as we used to be. It's kind of a tiny world these days. All right, so the micro is basically the type. We already talked that. I don't want to talk over it again. It's the same stuff. And the thesis is really important. Why am I long? I don't go in all at once. How cocky am I to go in all at once? Sometimes I take a trade, not an investment, trade, okay. But if it's an investment and I think, okay, the US dollar is falling, I want to catch a falling knife. I did it today, by the way. I know it's near a bottom. I think it has maybe just a little bit to go. So I took a position out in September, starter. I will double on it if it falls down to my level where I think it's going to bottom. So I don't take it all at once. And I have the right to change my mind. Like with Tesla. I read, I changed my mind. And then here's the test. Would I put my mother's money in it? So if I come up with a trade idea, like yesterday I came up with Disney. I wanted to share it with friends in my chat room, which, by the way, I forgot to turn it off. I'm sorry about that. And the last test would be, would I call up my mom and say, hey, do you have $1,000 I can borrow to put in a trade for you? If I have the guts to do that, then I'm pretty sure pretty solid. I've done my homework and I'm confident. And then the goals, I said you set the entry and exit, but you got to stick to them, man, because this is where we fail a lot. Help, get help. I'm going to call Tim for help because I am really good at finding breakouts, but I am really bad at writing them as long as I should, okay? And with his tool, I know I'll be better. So get help when you need it, right? So help can come from all different kinds of angles. So let's go into an applied learning situation here. And Costco, for example, I'm trying to wrap everything we just said around this. And the macroeconomic conditions for Costco, what does the word look like? We are still in pandemic here. The economy is artificially propped, but it's not going to affect Costco right now. The industry's struggling, right? Retail is in the dumps, but this is where subsections of retail, like two winners are in there, Walmart and Costco. Before the pandemic, they were the only two that were successfully coexisting with Amazon. The rest were just dead money. Maybe Target. And so Costco is winning. Toilet paper or not, it's winning. The micro, 40 PE. So the PE is 40, and I put TTM, that other number I showed you earlier, it's TTM. It's trailing 12 months. So this is important because most times on TV, when they blurt out PEs and price to sales, they're talking forward. So that includes a lot of estimates. This is actual last 12 months. So there's no mojo in here. This is actual facts, 40 PE. It's not compellingly cheap. I'm not going to buy it with both hands. Plus, anything that looks like this is never an obvious entry point. Plus, technically, I could argue that this is the target of the breakout from here. So many reasons for me to say, maybe I want to buy it on the pullback. So this is just the daily chart here. So price to earnings is 40. Price to sales is under 1. So it's not bloated. There's not a lot of hope in its sales. It can crank the sales, and in fact, it does turn good comps. Comps are in retail. Comps are comparables. Is what it did this time to last time. This time last year. So when you're talking on restaurants, you have to make sure to understand that this only includes the restaurants that were open all year and are mature enough. So this is in retail, comps are really important. Just ask Chipotle. That's the reason why Chipotle is priced like a tech stock as far as valuation is concerned, because they just incredible comps, incredible. All right, so the thesis for me for Costco would be to wait for a dip. I have no reason to chase it right here. I would rather wait for 332 based on the charts, but this is a different conversation if we want to talk technicals, and we can after here if we have time, or 320 for a better entry point. And then I would set my goals thereafter. Technically, if the market's correct, it's going to come to here, if not here. And if it comes to here, I'll buy it with both hands. So maybe I'll start here and I'll double here. So if I wanted to get long now, another tool I can add is doing options. I can get long now with options. How I could sell the puts for October and collect almost $3 and not have to buy it until it hits 305. What? Yeah. Options would let you to create income out of nowhere if you are willing to buy the stock. If you're willing and able to buy the stock, then you can preemptively sell the line where you want to buy it. So that's pretty cool. So you don't even need a rally. In fact, the stock can fall like 10, 11% and wouldn't start losing money. So keep it simple and repetitive. This is just one company. I look down at the macro, look down at its micro, I develop some sort of a thesis, and that's how I would approach Costco. So we can put me to the test in a little bit. So start putting tickers to see if we can go through one of those processes here with you, and hopefully it's a ticker I don't know. So this is an example of tools that we have. This is Amazon. This is a free tool from Yahoo Finance. I think it's finance.yahoo.com, but Google Yahoo Finance, you'll come up to it. So let's look at it. This is an income statement yearly, so I didn't mess it up. We've got 2016 through now, trailing 12 months. So we have 136, 188, 233, 280, 320. So clearly a cranker. It's growing its sales. That's what I care about, revenue. All right, so net income from operations, that's pretty important. 2.4, 3, 10, 11, 13. That's a ton of growth. All right, and per share, 5, 6, 20, 23. That's a winning company. So who cares if they're profitable or not? They're spending money to make money. And without losing, they're still profitable. So that is pretty outstanding. There are other tools within that same page. Let's say I'm looking at the XLE. Somebody said, hey, you got to buy energy. Well, before you go and buy the XLE, let's look what's inside of it. Right there, you can click and find out the fact that the XLE is 44% two companies, Exxon and Chevron. What did I say? I'd rather own one of these two companies because they're going to pay me a ton of dividend, and I don't want any of this junk. They tell me there are a lot of walking zombies in these. I don't want any of them. So I wouldn't buy the XLE. I would choose one of these two or split it between these two. My point.
Nick, really quick, how do you use fundamentals to time entry?
Okay. Well, it's part of it. It's not the entire decision. So I would give me a ticker. Throw a ticker at me.
RKT.
Rocket Mortgage. Okay, yep. So it's a new company. Fair enough. That's a tough enough test. Let's see. So this is Rocket Mortgage, a 1 hour chart. All right. So it's a little tricky because it's so new. Just last night, I was at the gym getting a black eye, and I was.
What type of martial arts do you do, really quick? So
I do Muay Thai. So it's basically full contact kickboxing with elbows and knees. So I took a toe to the eyeball. I blocked the kick, but the guy's foot was freakishly long and wrapped around and hit me in the face anyway. So, but I was talking to that same guy, by the way, who is a mortgage broker. So he made fun of this company. He was boasting how much money he made last month, I'm sorry. And he works for a competitor. I forget who, but the old cash call guys, that's who he works for now. But anyway, so let's look at Rocket Mortgage. He told me that this is not as solid because it's part of, what is it, Intuit or Quicken? Mm-hmm. Okay, so let's look at financials. This is too new to have any financials. So fundamentally, this is more of a bet on it. Its price to sales is 0.5, 0.6, which is really low, but I don't know how accurate that is. So in this case, I would have to go more on faith that they're doing the right thing. And I can tell you from the technicals here that there are a few lines that matter. So this would be part of my assessment, but it's not going to be totally fundamental. I would have to look at what's mortgages going to look like. And I have a problem with mortgages right now but more from the real estate problem. Mm-hmm. Because we have 7 or 8% of all mortgages in the US, according to CNBC, are in forbearance, which means that we might have a problem. Forbearance just delays you paying your mortgage, but you have to pay it in 3 months. So you either pay it lump sum or payments, or if you have excellent credit, you have the option to just defer to the end of the loan, which would be ideal. But if you don't, then you have to rework your mortgage loan modification, which basically you default on one and you set up another one. Not a good idea. So I don't know how that's going to affect Rocket Mortgage.
So okay, so let's go look at a ticker that's got a little more history behind it. Okay. So we can really look at the fundamentals really quick. Just Jen in chat. The program is TradingView. This is TradingView, right?
Oh yes.
Yep. Which is just charting. It's not a brokerage. All right.
They do have a tie-in. You could tie your brokerage into it, but that's extra.
Yep. Let's take a look at Amazon then.
Okay. So kind of a cheater one for me because I have a lot of lines on here. I can take them off, but okay, let's take them off for now because that's part of the tools. So I love Amazon. I remember saying buy the dip every time it falls on earnings, even at like 800. Buy the dip down to 805. It's like, what? You're crazy. It's like buy the dip, buy the dip, buy the dip. This is a cranking company. However, it's too high up here. So let's look at its fundamentals. So I just showed you its P&L. We already know that it's trailing 12 months as far as price to earnings ratio. The price to its earnings is 130, 131. Not cheap, but that's not a deal breaker for me. I would not even look at this for Amazon. The price to sales is what really matters to it. It's 6. There's only 6 years worth of sales built into a price. I say only because this is the lowest, this is the cheapest mega cap there is. Can you say that? Can you wrap your around? Facebook, Apple, Tesla, all of them are at least 30 to, if not double it, as far as price to sales. So for comparison, you have to look at its competitors. So Google is one of its competitors, and it's 7, but it's like doesn't grow as much, and it's cheap too. So Google is a good comparable as far as cheapness. It's somewhat of a growth company, but I think they're not doing anything exciting. Apple is definitely not a growth company. So let's see here. Shopify, maybe. That's the best compare. It's not mature, but it's a same place. They don't have a PE because they still lose money, and that's okay. It's a startup, but it's 75 times its sales. They have 75 years worth of sales built into the current price. So if you buy a share, you're agreeing to front the company 75 years worth of its current full year sales. So Amazon is cheap. If I go to Facebook and I compare it to Facebook, it's 12. So Facebook is 2 times as expensive. You say, but its PE is $100 lower. Who cares? Are you looking for an earnings situation, or are you looking what the company can do? Growth. If that was the case, nobody would have bought Tesla because it was losing money. If that's the case, you would never buy a growth company. If PE is what you're looking at, then you shouldn't invest in growth companies, because what are you deciding? Growth companies should not have a PE. They should be losing money. They should be spending every penny they have into growing. Amazon is a cash cow that it can afford to feed all of its growth with just slim margins. They know how to play the slim margins, but boy, can they do it. So having said that, fundamentally, I love it. I hate the fact that the stock market is so high, and I hate the fact that it is so high relative to itself. So if you tell me, is it a good time to buy Amazon? I just shared with you all the reasons why you should, because it's cheap. But it doesn't mean I'm going to. There is no way I'm putting my mother's money into Amazon at these levels. I would bet my life that I can get into it at least 10% cheaper, at least in the next 6 months, at least. So that would be my decision making. If I'm trading Amazon, these comments don't apply. Then I should be looking at 30-minute charts and then making the decisions. And even then, I can tell you if it loses this level right here, in fact, I'm going to do it right now, it's going to be in danger of erasing these 2 candles right there and come back to this one. And this would be the first place I would buy the dip. Now we're talking trading, not investing. Okay, so this would be trading. Back to investing, 240 maybe. Okay, 1 day. Whoops, not 1 second. All right, so back to investing. This is not a time to get long Amazon, even though the fundamentals tell me I should. Here's another visual to that concept. You say, what do you mean by that? Okay, so this is lows. What? Okay, so this is lows. You'd think that, my gosh, it must be super expensive. It's not. It's like a 22 PE, right? And I think, before I put my foot in my mouth, 22 PE. And under 2 times its sales. So it's dirt cheap. No way am I going to buy it, because this is not a visual place I can, what am I expecting if I'm buying from here? What else am I expecting? How big of a rally is this? So it's not always cut, almost 180% plus.
Really quick on Amazon, what's your line of thinking around the 10% lower entry point?
Okay, so it has no actual support that actually I can count support. So if
So
the
this is
market
the technical
so-
thing. This is the chart, not the
right
fundamental.
now we're talking technicals. Okay, I told you there's not one tool. There's no magic bullet. We discussed the fundamentals, and it's cheap. It's a fact. It doesn't mean I buy it. Okay, so if my investment thesis is for 40 years, 10 years, 15 years down the line, maybe I could buy it. But why would I want to buy it now when it's not going to crash up from here, right? We're rallying okay, but the markets are. Remember the macro part. Remember the first step, macro, right? That's the biggest no-no for me. I'll tell you, I'm going to be gross a little bit. Macro, we have a giant gaping wound from COVID, right? So let me show you what wound I'm talking about. I'm going to take all, okay. So take all the lines. This is visual noise. Go to the SPX. I don't have as many. Okay, so right here, February, we had growth, GDP. We're talking macro now. Forget Amazon. GDP was positive. Full employment, maximum. We had never had more employment than we did. Then we decided on a dime to close the freaking world. We just decided, we scheduled it like a dentist appointment. Yep, we're going to shut this whole thing down and break it. We come down to here. Now, we rally back with the stock market. We have a V recovery, and they want more. But if you think about it, let's look here. What do we have here? We have maximum unemployment. Last week, we had 15 million people still filing weekly unemployment. So we've never had that before for this long. Maximum unemployment. We have negative GDP. What was the number? Minus 32 or whatever percent. So we have negative GDP. We're shrinking globally. We're shrinking. And you want to be better than where you were with the best economic conditions of all time versus the worst economic conditions of all time. It makes no sense to ask for more. So the QQQ is doubled from its February. And okay, you want to sell me on the fact that this crisis helps the Qs make money. I can ignore that for now. Okay, I'll give them that. I think they're wrong because there's going to be detrimental offset within the QQQ, but right now it's only about 4 stocks in there, 6 stocks. That
the Qs being tech stocks.
Yeah, tech stocks, the NASDAQ. That's the ETF for the NASDAQ. So that's what scares me on Amazon. This stock market should not be anywhere near this level because we also still have COVID, which we haven't solved. So we have everything going against the stock market, yet it's making new highs. So there's no reason for me to get caught in the chase because Robinhood, the Robinhood mentality is being propagated by the media. So they first tell us they laughed at them. Remember when Robinhood started? These are the guys with the $500 accounts and they have no experience trading. They took the check with $1,200 from the government and now they're trading with it, right? And now they have special segments on how to trade like them. So Kramer has a special on how to buy into stocks that are going to split. I've seen everything. I mean, this is a guy who made fun of, moreover, he made fun of pajama traders for how long? If you've watched CNBC, you've heard him say these words, these moron pajama traders, right? He calls them moron pajama traders. And now he had a segment this week, how to make the trade early before the market opens, because by the time the market opens, it's done. What is going on, right? So there's clearly dislocations. Plus there's dislocations with the VIX and the VXX within the day. This week, I saw something I've never seen before. Yesterday.
And really quick for folks, what is the VIX in a sense?
So the VIX is the mathematical calculation of how nervous the options are. So a high VIX indicates the market expects violent moves. The mathematical average is about 16. And right now we're way above 16. And this is the VIX over time. If you want to see it.
VIX is how anxious everyone is. Anxiety.
Right. So the crash of 2008. Now, so if you want to go 3 months, you can probably see the .com bubble too. So, which is so cute. The .com bubble is down here.
Wow.
And so 2008 and recently. So back to the daily chart. So the VIX is a mathematical representation of how nervous markets are. So if you have a VIX of 30, then you should expect plus or minus 2% moves every day in the market. Right now, we should expect plus or minus 1% moves every day. That's the normal because it's priced from so much above 16, which is its mathematical average. So when a VIX is high, I should be worried. Yet nobody's afraid. Markets that are afraid don't buy junk stocks. They don't buy froth. They don't buy 120 price to sales stocks, yet they're buying them like blindly, right? So you have to pay attention. This is another tool in the belt. So this is where the technicals come in. So I'm going to put my line right there, and I want you to look left. So this is where it bottomed. Look left and look what kind of a role this level played before, right there. And then it came up to here, and this happened. I don't want to be caught. 2 days ago, before the market closed, 2 days ago, something happened within the day. I don't want to get wonky with it, but I'm going to say it in plain, simple English. I watched a derivative of the VIX intraday. It's called the VXX. Think about it as the VIX, but intraday, or the VIX futures, okay? During the day, I've watched it for I don't know, 7-8 years. It always moves opposite the S&P. Tick for tick. One moves up, one moves down. It's a fact. Every once in a while, it moves together for like a minute or 30 seconds, but never more. And then 2 days ago, they both broke out into a rally on Wednesday, like you wouldn't believe. They both rallied all day together. I have never seen that happen before. Never. So I went to my friends and I said, I'm seeing something that I've never seen before. I'm going to buy VIX calls because I don't know what's going on. And if the markets fall, the VIX is going to rise. I make money. If the markets rise, the VIX is rising anyway. I'm not going to lose money. And sure enough, the next day, both rose. The VIX popped, made some money, and the VIX just popped again. So 2 days in a row, we have green VIX, green market, green bonds, green gold, green yen. What's falling? This is unusual. So I have a lot of question marks. When I have a lot of question marks, I'm not going to risk money. When you're missing a piece of the puzzle, and I am missing a piece of the puzzle, if you know what's going on, that'd be great. But I'm not going to deploy risk in a big way. There's no way. So I'm not here to create fear. I'm just sharing why Amazon is not a buy at this point, even though Amazon fundamentals are great. But the first step is macro. My macro, I have a giant question around it. Maybe they'll prove me wrong. Maybe they'll find COVID, they'll solve it, and everybody will go back to work. But today, MGM firing 18,000 people. Yesterday, I think one of the airlines furloughing 10,000. How much of that is going on over the world? So is everybody going to be able to get a job when the money stops? Which, by the way, there may not be a second stimulus package because after November, both of them will be disincentivized to spend any money, both of them being Dems and Republicans. So this might be it. So if the money stops, 70%, 68% of the US economy is people spending, of the GDP is people spending. So if we stop spending because we don't have money in the bank because the $400 check stopped, what's going to happen to that GDP number? If it drops to 5, are people going to poop their pants? I think they would. So anyway, within that confine, I don't feel comfortable going along a good value stock like this one, a good value, like a good deal. It's not expensive, but it's not a reason to buy it because the macro doesn't work for me. And because I can't tell my mom, put your money there.
So what about penny stocks? Do you ever put your mom's money in penny stocks?
Well, penny stocks, if I'm trading penny stocks, unless I know the insides of that company and the industry and I have some sort of an insider, an edge, let me introduce you to a word I should have. Shame on me. Edge. Okay, so this is competition. This is going to blow your mind, and it's so simple. It's a competition. You have an opponent. Do you not know that? You have an opponent. They say on TV, they're buying the blah, blah, blah. It's like, okay, so there's no seller. Why don't you say they're buying and selling? There's one buyer and one seller for every transaction in the market. So when you buy a share, there's somebody that thinks you're stupid because they're selling you that share. So you have to have a reason to look them in the face and say, you're stupid. And here's why. So penny stocks is the same decision. You have to know your edge. Give me a name. I don't know. I don't know any penny stocks.
Chad, drop a penny stock in here that you want to hear about. Mina, I see your question. I will ask about that in a second. But Chad, come on, let's get some penny stocks.
I'll use one in proxy. ACV. This is Aurora Cannabis. It's not penny stock, but it is actually because it reverse split like 20-1, so it is a penny stock. So this is today somebody asked me about it. Somebody said, would you go along before the earnings? I said, first of all, the earnings, by the way, I'll do you a favor. Don't overthink the earnings. Take a coin, flip it, and make the trade. Because not even the CEO of the company can tell you how the stock is going to move, and it has nothing to do with the quality of the report itself. So
wait, hold on. We got a couple picks from chat. Do you mind looking at some of the picks that they want?
Yep.
Let's do this one came up twice. Let's do ALYI, which I don't know. I don't know what that is.
Holy cow, that's deep in the weeds.
We're deep diving.
Oh my gosh, what is this? Okay, man.
Holy smokes.
Okay,
Two people asked for this.
So this is a daily chart. Clearly does me no good. So I'm going to drill down to an hourly chart, maybe 2 hours. I'm trying to find a chart that shows me some leg here. Oh my God. I doubt that there's any fundamental data in here. Oh my gosh. Okay. So 15 times sales, whatever it is. So engages in development and commercialization of lithium. Oh, battery stuff. Okay. Mm-hmm. All right. So the concept is cool. The economy doesn't really matter for this one because Tesla is, making everybody make electric cars. So if this is what this is for, I'm going to guess, then I'm okay with the macro. It doesn't really play an issue. This is where I do homework and I see if their technology has an edge and I educate myself on that part. Since we don't have time to do that, maybe they can tell us while we're here. But I assume that somebody did and I say, you know what, this is great. Right now it's challenging. This is now the technicals come in. The technicals come in is that it's challenging this failure right there. This is the problem that the bulls have right now. They're hitting it. As soon as they take that over, they're going to spike and invite more buyers. This is where momentum traders like to buy high and sell higher. I'm trying to find because the daily was too.
So I just want to double down on that for chat. So that's a very core technical concept.
There we go.
For some of you, this might be
okay.
Not a surprise, but this is resistance and support. When you break,
let me walk you through it. Yeah, let me walk you through it. So, all right, a concept I forgot to mention. You have to, when you're talking. Well, I didn't forget it. It's not part of the conversation. Technical analysis. It matters now. You cannot be a successful investor and trader without. You definitely cannot be a successful trader unless you're lucky SOB. Is that you need to know charts or get help. There are tons of chart help out there. And here's the thing. They say, I can't verify the number, let's just say it's high. 80% of all trading is done by machines. Machines never trade without a reason. So they have code, they follow the code, and part of the code is to look left because they use history, right? This is their history. They say, last time I was here, I failed. So they don't buy it with gumption until they get above it. So they hit it, they fail another time. So they do this, and then they try at it again, right? So now what do we have? We have an inverse head and shoulder that's bullish. And as soon as they go above it and verify it's good footing, then boom, they go, right? But in this case, I also have look further left because there's this giant gap right here. What the heck happened here? Look, this is an accident scene. So it's not going to be so easy. I'd be surprised if they go like this. Because this is a prior accident scenes that the machines know about, has been confirmed twice, and now they're falling. But look, higher lows, that's good news. So they keep going like this, higher lows, until they become so tight, and then the energy builds, and they go. And even then, this is where they'll stop next. That would be their target. So they'll break out, drop a little bit, repeat the process here, higher lows, higher lows, and then they break out. So you have to look left and see what happened. And in this case, you have to look left a long time because the accident scene happened here in June and probably right after. What is this? 2 earnings back to back here. Something happened here. So 2 earnings. That's weird. Yeah. So maybe they pre-announced and announced. I don't know. So make sure there's no funky reason where they had to restate earnings or whatever. I don't normally see that, but I'd be surprised to see them do this. They're going to fail and try again with higher lows. Okay, so this is where the technicals actually matter. And probably when it's penny stocks, I would not trade penny stocks without technicals. The fundamentals are easy. You would do your homework. If I don't need fundamental to trade a stock. I really don't give a crap what the stock is. If I have a good chart and I can read it, then I can trade the chart itself. This is not great as far as the chart is concerned because of that, whatever, but it is tradable. And with pennies, I don't know how much it costs to trade these days, but they're probably going to do a lot of them at the same time. And we're like literally talking penny stock. But a chart is a chart is a chart. This could be $1 million stock. It will act the same way.
All right, Nick, we are 1 minute away from closing time for this session. I just wanted to take a moment to mention, guys, Nick is, again, the options guru. So all the stuff that we're talking about with fundamentals and technical analysis, and then understanding macro trends at large are things that you've really got to have if you're going to use the leverage that is available to you when you are using options. So you can see that Nick has pulled open E-Trade, which is it's not a brokerage we talked about earlier, but it is a brokerage with a lot of really good built-in options trading tools. I'm
not recommending it, by the way. So I'm just showing.
Yeah, we're not recommending any brokerages here. We're not affiliated with anyone. But what I want to say is that all of Nick's research is available. If you subscribe to Benzinga Options, you should see a link to that on the bottom right, where you can get his research delivered to you and insight into the options trades that he is making, so that you can make high probability options trades based on really good research. Will there be an option boot camp? Yes, options will be covered in the 3-week intensive following this. So make sure you scroll up to the top and click buy now, so that you can get into the 3-week intensive. We'll cover options there. Nick, I'm going to step away for just 1 second. I'm going to let you have the final word.
Okay, homework and get prepared. Every morning I do this for myself and I share it with friends. I forecast the day. This was today's forecast, and I drew it before the day started, and look how well they ping pong inside of it. And then one of these sides is going to break, and then it's going to go. Like here yesterday, broke. So get prepared. Homework is preparation. You do homework, you put alerts like we did, you do the homework off hours, and then you're ready to trade during the day. So, but make sure you're investing or trading. Define your trade. And join me and Benzinga. And if you know how to sell iron condors, the RUT is really well behaved. Small caps, IWM too, these days. Am I still on? Is this thing on? Tick, tick, tick.
Yes, you're still on.
Oh, okay. Thank you.
For a sec.
So options are really cool. I know people tell you they're scary. They're not, I promise. You just have to learn them properly and apply them properly. It's just another tool, and it's a really good tool, especially for smaller accounts or for somebody with large accounts and they want to protect it, or just create income out of nothing.
Yep. Absolutely. I love options. Nick, thank you so much for spending all of this time with us. It's been a great session. It's great to hear you talk about fundamentals. Everyone, make sure you check out Nick's subscription, Benzinga Options. There's great stuff there.
There's chat room
Nick,
open all day too for some.
Yep. All right, Nick, thanks so much, man.
All right.
All right, you have a good weekend. And up next, we have crowd favorite Anne-Marie Band. Is Anne-Marie? Anne-Marie, are you there?
I am. How are you?
I'm doing well. How are you doing today?
I'm doing well. Looks a little bit dark in here. Let's turn the light on. Don't want to be in a cave. There we go.
There we go.
All right.
Okay. So, Anne-Marie,
Yeah.
could you do us all a favor and tell us a little bit about your background and what you will be showing folks today?
All right. So I am a mathematician by education, but I was a neuroscience researcher a long time ago. And after I had been doing that for a while, I went into a recruiting business, recruiting technical folks. And after that, my iteration of careers, I decided that I wanted to look at the stock market because I thought it was a good blend of behavioral analysis and how the world works from a numbers perspective. And it really has been that and a ton more. I cannot believe that that's almost 2 decades ago that I started trading. It's just, the time has flown. The time really has flown. And so this morning here, whoa, that's great for the hair. This morning on Benzinga, or this afternoon on Benzinga, I'm going to talk to you a little bit about how the best way to start up a space and think about trading might be. And because I've been trading for almost 20 years, I really see a lot in terms of where introductory folks make mistakes. And so I've actually been listening to Nick for his session, which is very entertaining. He's a very entertaining guy, a lot of fun. But that is a good thing. A lot of good things he talks about that I totally agree with. The look to the left scenarios and those sorts of things. And what that brings us to is a space where we really want to talk about, how do I put these wheels in motion? I'm hearing a lot about analysis. I'm learning a lot about options. And the biggest thing that we need to focus on is risk. And so today, when we come into the space thinking about how do we monetize our accounts, how do we turn them into cash machines, what we can do is simply begin by looking at a chart and remembering the following. Slow is fast, and that makes no sense except the market. Slow is fast, and what that means is the longer you take setting up what you want to do, the better you'll be prepared for when the time is to do it. So when you have a trade setup, right? So I'll call that the anatomy of a trade, but really it would be the anatomy of portfolio building. And when you look at something and you think about, okay, do I want to day trade? Do I want to swing trade? Remember this about day trading. Day trading, one, is very difficult because of the number of times you generally will expose yourself to risk. So let's say a swing trader looks at a position and he takes a look, or she takes a look at her account at the end of the week and it says, all right, this is very bullish. I'm going to pull back and put a limit order in for my support zone, and that's going to give me what I want to see. That's perfectly fine. If we are an intraday trader or a day trader, we might look at support 3-4 times and buy every single time. And we either get stopped out or we get moved into the position where we can take some profit. So remembering that the more times you engage makes for the possibility of the more times you can lose, think about engaging and getting money quickly out. And so those sorts of things will work in all kinds of spaces, but you want to make sure the background is squared away. And so that's what I want to talk to us about. And so I'm going to share my screen, if that's all right. Screen
Absolutely.
number 1, and we'll move my mug out of the way. And what we are going to see here first, I want to show you 3 kinds of stocks or instruments just off the bat so you can see what is trending and what is not. All right. So this, of course, is the Qs. Nick was talking about that. We have a lot of things that are looming above us in terms of what the world might do. And indeed, because people haven't been buying a lot of puts until about 3 days ago, where they've started to buy them again, we see things that are telling us, hey, I have a few warning lights. So a warning light that comes up on a very big motion like this, it's very, very bullish, right? This is simple. I can draw a trend line and say, okay, that's moving up. If you're thinking about swing trading, this is easily the easiest type of account that you can look at. All right. So here's a weekly chart. And now here is, I'm going to put this on a daily chart.
And we always get this question. I'm going to nip it in the
Yes.
bud before it even comes up.
Sure.
Which brokerage platform are you using?
This is Thinkorswim,
Okay.
right? This is Thinkorswim. Very, very straightforward platform after you've been using it for about a dozen years. So it's got a learning curve. It does have a learning curve attached to it. I'm not going to lie to you. But a lot of things that have technical analysis like this, you know, they will have learning curves attached to them. So here is your thought. Your thought is, I want to trade to make money in the market. The market is currently going up. This is a 5 simple moving average. Okay. Market is currently going up. And so in order to make money with the market, I will buy at my support zones. That's when my chart breaks out and then pulls back. I will buy at my support zones, or I will buy at a tight moving average, and I will estimate a level of risk. Now, these are the big things to think about. If you have a small account, I get this all the time. How much money do I need to make money? And actually, Neil and I were talking about this a couple of weeks ago. The fact is true that the more money that you have, the easier it is to make money. We know this. And the reason is because our cushions can be deeper. We can, if you know anything about the background of the market, Ackman, he was short Herbalife for many years and lost about $1 billion. Most of us can't do that. We just can't say, hey, I'm going to run this short for 3 years and we'll see what happens. And so what we have to realize is what we listen to as far as pundits on television, not going to give us the ideal information in terms of where we want to buy, except for the fact that you know something good is happening. If you hit a weekly low, again, this is a weekly chart, and it stops heading lower. That's a really simple event. So number one, if you're looking for something bullish, watch for it to close a week higher than its prior week, and then it stays above each prior week. And anytime it doesn't, it holds 2 weeks before. So really, it's can I look at my 3 candles to the left and say, can I work with that? So if we're all the way up here, we're up at 291, we can see that it's 20 points below where my real risk might lie. So the question is the following. Do you want to chase it and say, no, I'm just going to have a 2% stop or a 1% stop or whatever, get stopped out and then move with the market, or say, hey, I've got a 1% stop, and the moment that I break higher, I take my money and I leave. That is a really good way to get yourself quick money out of the market. So again, what you do is, if you buy a high like this, right, does it mean that you have to stay in there for 20 points to the south? The question is giving you an answer here, and that answer is no. The answer could be as simple as, hey, I'm going to go to my daily chart and I'm going to use 288 as my support zone. So if you buy an option, give it time to move, right? You need time. So if you buy a 290 call, you know that if it gets to 288 and it doesn't bounce, that you know it's likely to drift into the lower levels. Here's why this becomes difficult for us as traders. Because when it gets into 288, we say to ourselves, what if it bounces? Well, if it does bounce and you get stopped out, you can re-enter. Here is the thing. Every time you step into the market, there is a possibility that you can lose. And so you've got to become comfortable with the fact that you can lose. And if you lose, you want it to be the least amount you can possibly lose. Now, this flies right in the face of, oh my gosh, what if I miss the trade? And so there's a ton of psychology associated with really anchoring your first trades in the business. And so I'm starting with something like the Q that's got a very good trend and looks very nicely upward to say, let's go here. QQQ, we're going to the option chains. And if you're going to give yourself some room, you might say, all right, let me go to October or maybe even November. The further down you go, the more it's going to cost, right? Because you're buying time premium. So this one is $1,900. So maybe you go, holy cow, that's a lot. Maybe what you do is you buy a spread. So you buy the 291s and you sell the 300s, right? And so what that does is give you something for $484. And the risk, you have $484 at risk, and then you have $9 of upside potential if the market continues to rise. So when we're looking at something like this, we say, okay, I have a risk event. A lot of folks say, hey, if my option goes down 50%, I really am going to be very concerned about that. That's understandable. Risk is a personal thing. What I like to do is wait for opportunities. Several weeks ago, we got that with a big bounce well up over the close of the prior week, and we came into the prior weekly close and held. Notice this one. It bounces up. That's the daily event, and then pulls back and gives us that event that allows us to go into the prior day's close. So as a trader, you can always go, wow, you know, if I just wait for support, I'm going to minimize my risk and I'm going to maximize my opportunity for output. You have to get acclimated to the fact that taking risks will give you opportunities for upside, but if you have a small account and those opportunities do not transpire exactly as you want them, they are going to hurt you both psychologically, but also physically because of the size of your account. So slow is fast, all right? If you do look at that, I saw you were talking about this ALYI in the battery space. I think battery spaces are really fantastic at this juncture, but you can see something happened here with this big 88 move up into here, and they are buying support. So there's not really much more you can lose if you are buying a 2-penny stock. But the question is, do you want to buy 300 shares or do you want to buy 300,000 shares? Don't put all your eggs in a specific basket that's going to expose you to a tremendous amount of risk, right? So if you look at this, you go, hey, listen, I'm going to put a limit order in at $0.015, and I'll see if I can get 300 shares there. And listen, you want it to end up going to wherever, right? You want it to end up going to the moon, but you've got to think about how big money gets made. Think about folks that are extremely wealthy and then count how many gray hairs they have on their head. So the short answer to that is it takes time to make money. And you just have to realize that if you're looking to get rich quick, you really are pulling a slot machine handle. And those of us that are analysts simply do not do that. So let's recap. First thing, slope going up beautifully. Price action looks great. We know the pullback event is all the way to 273. We could go, but we could end up holding it. So from that perspective, you can say, hey, if I buy it right here and it rolls over, I've given it enough time to bounce, which is legitimate because when a chart is moving to the upside and it fails, there are going to be value buyers waiting here going, thank God that came back. Now I can buy some. Okay? That's really the thing that you think about. Let's go to something that is on a lot of people's minds, and that is this, they're calling it the social closeness trade. So MSC, I believe that's the name of that cruise line. They're the first cruise line to open up their doors. They're outside of Spain, which is bad because Spain just had a new outbreak. But they're sitting there and they're testing everybody that comes on the ship. It's costing them 500 to 750,000 euro per day doing that. So that is going to eat into a tremendous amount of profit. That being said, what Carnival Cruises did was bounce into old resistance. Take a look, always the same, folks, right? Remember how Nick said, look to the left? This is the most important skill set that you can have. Just don't do it on a 3-minute chart. Use big numbers and big levels, and you're going to notice the following. What this chart did was it had a terrible time. It didn't really make its low until 2 weeks after the broad market. That's saying one thing, right? And then right about June, when we had another shakeup and a future lockdown event, it fell all the way back down and now it's holding. So take a look. Low, high, higher low, higher high, higher low. This bounce zone gives us an area where we go, wow, that's my risk. Now, if you'll notice the chart, that's still quite a bit of risk where it's at, because where it's bouncing into, let's see where that is. If we look to the left, we really are up and over that bounce. So the reason I brought this was to share a different kind of formation with you. The cues are, of course, they look totally different. This chart is a chart that fell savagely, bounced into frontline resistance, and then faded, but is now holding a higher support zone. So really, the traders are trying to recover. But there are people here that are holding the bag that as soon as we get to these levels, they are going to try and sell it again. So now you have a support range at around 13 and a resistance range at around 25. And this gives you a place where you can say, you know, let me take a look at that on a daily chart. Really simple. Again, 5 simple moving average. Now we look at exactly the way the cues were working and we say the following. Hey, if this comes back into my 5 simple moving average, it's going to move down almost $1, right? And that's going to give me maybe a $3.50 risk. From an investing perspective, this is what you want to look at. You definitely don't want to lose 14. So if you're holding it on a swing, let me draw Fibonacci here very quickly. So if you're holding it here on a swing perspective, that 61.8 formation tells you, hey, you know, I could come all the way back into my 15 zone, right? But that really is great if you pull back here at the 16 and you set an alert that says, hey, watch this when it comes into 15. So what's the goal? The goal is, can I get to this high at 1749? And then can I get to this high at 1785? And guess what, folks? You take profit where you see it in a chart that is in this kind of pattern, because they're going to be trapped buyers everywhere you look. So the key event there as a trader is to say, can I take money where I see it, not worry about what you've left on the table, realizing the market is a buffet and you can come back at the next profitable line of support where you know that buyers will engage. So that really should anchor you in a place. Listen, I had a terrible time trading when I first began because I was such a technical person that I wanted more and more and more information. And I want to share this with you. Less is more. And if you're thinking about buying something, look for the last time everybody bought it. That means, where can I look? And everywhere I look, somebody's saying buy. Okay, right here they said buy because the next Monday they gapped up and they kept going. They kept going. So when you look at a chart and you say, can I trade this? If you're making higher lows, wait for it to come back to old resistance, new support, and that's between 16 and that 1550, if you want to look at this place. And you can enter. So you might say, let's go again to Carnival because we are looking at option spaces, trying to make them straightforward. When we're looking at this, we can see, again, we'll go to October, give it a little room, and we say, listen, tell me when this chart comes into 16, and I'm going to buy a 15 because I think it's going to go to 17. If I buy a 1750, most of the value will be extrinsic, and that means worthless, right? If price is 1712 and I buy 1750, this legitimately has no value. Zero. It's worth zero. If I executed it today, I would get nothing. If I buy the 15, however, it's got $2.13 of intrinsic value. That's 15 from 1715. And so I only have maybe $1 that I'm paying for this option to hold it for almost 2 months. So it's really a great place to look for these positions. Some of us don't have patience to do that. And if you rush into a trade, patience will cost you money, right? A lack of patience will cost you money. Is the chart rushing ahead? Not really. Not really. It looks like it is, but the last time it did this, it absolutely gapped down and came into support. Traders are going to look to the left. They're going to see that the next time after this close, it gapped down, and they are going to pull it back. So you wait on those elements to get yourself positioned. And at that point, you say, all right, if I take the trade and it goes to 16, let's take a look at that one more time. I will look at something, let's say it's $3.55. If my chart moves down $1 from where it is right now and I buy it, Delta says approximately my option here will be worth 71 cents less than it is right now. What that means is for every dollar that my price moves, Delta tells me how much the option will change. And so I know I'm looking at something that's going to be worth about 280. So that's going to be great if I can manage that. How will I want to do that? Listen, you have no upside barrier here over time. What you want to do is, if you take two of those options, when it gets to 1750 the next time around, take your profit. Absolutely. If it loses this zone, this 15, it should begin to bounce. So you have to give it a little bit of time if you are looking at the swing. All right. Neil, I wonder if there are any questions I could hone down on, or anything you would like for me to focus on to drill into the mechanical events that will help us move into making money.
Yep. So one thing I'll say is that I've sat through a enough of your presentations by now that I'm starting to really start to absorb what you're saying. There are a lot of things that have, like, every time I watch it, I'm like, oh, that's what she was talking about.
Yes.
A bit more. So we do have a comment. One is thank you, Nina, for dropping a question. Everyone in chat, drop your questions in now.
Hey, Nina.
They're on a little bit of like a delay. I think it's like 15 seconds. It'll take them 15 seconds. But one comment that we got from Joe B was, that's a lot of lines. And I was just getting ready to type in about Fibonacci bid. I was wondering if you could just explain.
All right. So what I'm going to do is I'm going to remove the price levels. And then I'm going to say the following thing. A lot of times we want to know, hey, where do I buy and where do I sell? This is really, I've been coaching folks and working with people at the Trading Book for a long time. And it's always the same. They want to know where to buy and where to sell. Now, if it were as easy as that, as saying, hey, there's one line to go after, and that's it, the markets would have a lot more people on the top of the pyramid than at the bottom of the pyramid. It might look actually like a box, right? With an even move across the top. So the first thing is, when we are looking at very big time frames, you are going to see a number of levels. So one of the first things I drew was a Fibonacci. And what this Fibonacci is, you'll notice I have Gann numbers actually written for the Fibonacci's, but if you know the fibs. So here's what a Fibonacci is. It is simply a measurement tool that tells you how much the market has moved through time. So if we go to Carnival and we look at the top, we're going to see that through the passage of time, June particularly, through August, we moved from $12 essentially to $25. So we cut our price position in half. Literally, the 50% got shaved off of this stock from this price point. So when we are thinking about looking upward, we really want to consider how long we want to be in a trade. So how long you want to be in a trade, that's when your lines make a difference. If you are saying to yourself, as this person might have, looking at their moving averages, saying, hey, listen, I made the low here, I've bounced here, and so the close of this week and the open of this week gives me my low entry of $14.31. So I know as this week comes to a close, I know coming into my following week, this is where my buy zone is. Absolutely. So essentially, because you're using a weekly chart, you only need one line where your target is. What you might want to do is after it goes up to the halfway point, you move your stop to 0 to break even. If you move it to break even and it doesn't continue upward, then you have a choice of going, I don't really like how this is behaving. It's making me nervous. I got to get out of here. And emotion is a very, very big part of trading. And so just embrace it. You can't trade without emotion. Emotion is what makes us know that we are who we are. What we have to do is sort of mechanize that emotion into saying, hey, listen, I feel emotional about this. This is why I'm concerned that I'm going to lose. And then you do things to mitigate the risk and the fear event. All right. So 1, here we are coming into this area. For the trader who got in last week, at the close of this week, they are thinking to themselves, I need to take some profit. All right. If, however, you are a trader that is looking for a quick strike, you might not be looking at these motions. You might be looking at the 1530 area, which is above this zone, and you say to yourself, hey, I'm going to look at that. That happened 2 days ago, and it's going to move me from here to here. And so you have to have a roadmap. If you are trading to generate revenue, you have to have a roadmap of where stock is going. If you're trading to invest, your thought might be, let's see where this goes. But if you're trading to make a living, or you're trading for revenue stream, you must take profit where you see it. And don't be concerned if you leave some on the table, because you're always going to leave some on the table. You're never going to catch the absolute bottom. You're never going to catch the absolute top. I know a lot of people like to write about how they've caught the bottoms and caught the tops. And listen, it feels great. But time after time after time after time, it is not going to be a reliable way to plan a strategy to make money in the market.
Okay, so now we've got some stuff to talk about.
Aha.
So I want to start off with one because I love. I'm not sure if this is like a Benzinga person who's seeding questions because this question's too good. So whoever you are, if you are, I'm going to find out who's doing this. But I like this one because they're asking about a specific situation that they're kind of in. So this person is holding a call on Microsoft.
Okay.
It's a September 25th expiration. Strike price is 255. And let me know if you need me to read back any of that.
September strike, right?
Yep, September 25.
255?
Yep.
Okay. All right. So let's take a look at that. Now, a lot of people have been making money just buying out of the money calls in charts that have been running, right?
Mm-hmm.
I mean, think about all the people that have made $1 bazillion in Tesla doing that. Okay, so 255, that's an interesting number. Whatever the case, the cause for why you might want to buy that is certainly something that you want to think about. It might be, hey, I don't really think it's going to go to 255, but maybe I just want my option to move by 30%. A lot of times that is something to think about. So let's do this. Let's actually look at this chart.
And guys, this is obviously very option specific. So Anne-Marie is going to talk about probably the implied volatility and stuff like that.
I'll try not to be too wonky.
Okay.
Yeah.
I like operative word being tried.
Yes.
But for these other picks, we'll certainly get down to
yes.
the charts and if options are too complex, we'll stick to just good old buying and selling.
Yes. All right. So let's take a look at what this chart look at what's happened to this option. So this is a 4-hour chart for this option. I'm going to just put it on a 90-day formation so you can see what's going on. So way back, holy smokes, when is this? Way back on the 18th, this option was 18 cents. And then Microsoft took off running. And when was the high? Thursday. So yesterday we had the high of 335, and now it's sitting at around 168. So obviously people buying into the giant spike. And so that really is what we are going to be concerned about. What makes for this giant spike? And notice prices stayed steady. But take a look at what's happened to the price of this option. When price action has legitimately stayed steady, it's only to within maybe $4 or $5 of the actual price. It is moving down and losing money. So your thought might be, why is it doing that? And should I be able to hold it? Now, depending on your depending on your thought about what the market is going to do, this will be just fine by the end of the month. That being said, you are very far out of the money. And when you are far out of the money, something called theta, as well as delta, begin to work against you inside of price action. I'm a huge fan of buying at the money or in the money options because I want them to be worth something at any time. And so that means I end up paying more for my option. But when the guy or gal who buys the 230 strike when price is at 200, they're going to make more from a percentage point than I will over time. And that's why these out of the money options are moving so dramatically. So the thought process for me is I would try to stem a little bit of the tide in terms of loss and say, why not sell a 260 against it? So now really the only thing more that you can lose other than what's already been gone is another 40 cents. And so 64 minus, 24. So that is my thought. If you've got this going to 250, the market doesn't feel as hot as it has been. It feels like it's stalling. And when it stalls, it's going to break out. But if it stalls for 4 weeks, your option is really going to erode dramatically. It's going to erode dramatically. To remember, that option was worth 18 cents on the 18th of August. That's just 10 days ago. So it can go back all the way down there. We just have to be cautious in terms of what's going on. And so you can stem the tide by saying, all right, I'm going to sell the option just underneath it. And if it does go to 250, then, I can close it there as a spread and I will still make some money. So that is my thought about what to do there. Do I see a trajectory up there? There might be one to 250. The question is when. And if you're using something on the, it's the 25th. I'm so sorry. That just fell into my head. The 25th at 255. It's funny if you could understand the cyclone going on in there. I would say do the same thing. Right now, it doesn't seem to have a 260 strike, but it may have one at a later date. So my thought is, could it run there? Yes, if you have a linear chart and you're saying, hey, could it run there? If it's moving at the same speed to get to this area, it would be October 26th. Do you see how I did that? Just a straight line up. It tells the speed of motion. If the speed is slower, the trend line will be lower. And if the speed is faster, the trend line will be higher. So this current trend line, even if I put it right in the middle of everything, it's still telling me it's October before this. And so it tells me there might be a little bit of trouble with that strike as it sits.
So this is turning into something. This is turning into single leg options anxiety therapy sessions with Anne-Marie Band. Because we've got 2 more. I think that I think that this might need to be a regular installment.
Yeah, absolutely. I'll go for the next one. What do we got?
So we got Square.
Okay.
SQ. Looks like we got another September 25th expiration. I'm assuming that's a call or Ermal.
That's a weekly option, actually. September 25th. It's the weekly. I'm not really sure why both of those are weeklies, but what is the strike on the?
It's in the money. It's a 160. Because I'm assuming it's a call.
Okay. Is that right? Is it a call?
Ermal, can you confirm?
160 is actually out of the money.
That's out of okay.
Yeah. Are we looking at a call or a put?
Dale says I'm lost. Smiley face. Ermal, if you don't confirm, we're going to switch to the next thing. Going once, going twice. Okay, let's look at Intel. We got INTC.
INTC. Oh, this one is good. All right.
So I believe in Dale. This will be the last options thing that we look at. Then we'll just look at the individual tickers.
Yes.
So September 11th, $53 strike.
Okay. A call.
Yep.
Yes. All right. Now September is 2 weeks away. And so let's think about this, right? Let's go to Square. And again, I know this sounds like elementary school stuff, but I promise you it works, right? So it's not Square, we're at Intel. All right, so let's have a peek. This one, of course, you know, with all the lines here that I certainly look at this one, I think this is on a beauty of a bounce, right? Apple came in and said, good night, see you later. And stock went off a cliff. Everybody said, hold the phone. It is Intel after all. And so 5 weeks ago, it made it slow. And now it's on the horizon. And so simple is as simple does. You're going to draw a line. This is a very linear chart right now, right? It's got a good bounce. Where are there trapped buyers? Now, why am I going to say that? Because somebody looked over here and they said, oh my gosh, this is the support zone I've been waiting for. And they buy it here and the bottom falls out of it and they go, holy cow, what's going on? And it's going to come into 51. What are you going to do if you bought 1,000 shares here or 500 shares here and now it's just coming back to break even after you've been down, you know, $7,000 or whatever? What are you going to do? You're going to go, see ya, goodbye. Thanks for taking me on that roller coaster. I don't want to be here. That's the average trader. So right now, you're going to run into some sellers sitting in Intel and look at them on the 4-hour chart. They came in at the open on the first 4-hour formation here, rose to the highs, and then stalled out, right? And so all day, they've been running here. Take a look at how Intel behaves. Big spike up, pull back down. So this is what we are sort of looking at. Now, that being said, the last time we had a big move up, this broke, and then neither of these held. Right now, this is holding. So this formation, in my mind, and this option is going to be fairly supported as long as the price action does not break the 49.50. If it does, you have to watch it recover immediately. Does it have the time to go to 53? So here's how you look at that. You take a look at the formation, right? Obviously, earnings absolutely terrible because of disruption in supply chain. We know that there are a band of sellers here, and the top of the wick is 52.30. All right? This is an auction vacuum. And so if it gets in here, it's going to grind its way up through these levels and try to get its way up. So if I take a look at the number 53 and I put it on this trend line here, let's maximize this cell. And I put it, I'm going to remove that. Let's draw a better one. Let's draw this trend line right here. If I move it over to try and run at the same rate, it's all the way to the 28th before I get to September, the September, yeah, before I get to the 53 edge, anywhere near there. So if you aren't using this simple mechanic to figure out how many weeks out you can go, give it a whirl. It really works.
That was so simple.
I know. I know.
So if you guys didn't catch that, she just drew a trend line just based on what data is available there, which is, I don't know what period of time that is.
It looks about like almost a month.
About a month. So just a very simple trend line, just drew it right through the middle, and guesstimated based on that. If at the current acceleration of the slope, the price of the stock would hit that, and that's how she timed her expiration date for the option.
Let me show you how good it actually is. Okay, so let's say, again, some of the best times you can find stock is when it hops up over its moving averages after it's stopped heading lower. Let's say you just looked at these guys right here from this edge to this edge, and you said, hey, I'm going to draw a line that covers these guys, just these guys right here, from peak to the middle. So I'm trying to catch as many of the candlesticks as possible. I might want to do something like this that puts me in the middle of all the candlesticks. And all I'm going to do is extend to the right. Yeah, I know. I don't even know why people don't use it. But, can I tell you why? It's because at heart, I love pictures and I love things that are simple. If you can't explain something simply, I don't think it's worth learning. And it's because our mind has too much to mechanize when we're in the business of trading, because we're so viscerally attached to our money, right? And so again, if you look at something like this and you go, all right, well, I'm just going to look at these guys, and this is a monthly chart, and I expand it to the right, it's going to tell me that, interestingly, even after this fade, it still ends up recovering and moving forward, and that's because it's holding relative trend. So you are going to be able to trust this one. You will. What it's going to do is choke around this 30 area, and then they're going to come back and say, all right, are we looking at something that looks like this, where we pop up and then pull back and kind of double bottom, or this, where we pop up and then pull back and make a higher low and then move forward? That is what is going on right here. And guess what? You know immediately when you're wrong. When the chart collapses, what it's going to do is close a week underneath the 49 area. That's all it has to do.
Okay, so I'm just answering a quick question in chat. Let's get out of options a little bit.
Yes.
Territory, and let's just talk about some of these stocks folks are interested in.
Yeah, absolutely.
The first one, no particular order here, guys. I'm just picking one that I actually don't know what it is. SWKS.
Okay, so that's Skyworks, SWKS. Yes. All right. So let's have a look at this. Let's look at it on a weekly perspective. I'm going to talk investor first, and then I'm going to talk trader.
Perfect.
Okay. Investor, old resistance, new support. So you can see them coming in. They're trying to buy this edge, right? So the investor here would say, this looks okay to buy down here, but I'm under my moving average. And so if I engage here, it's going to be with a small position. And I'm going to try engage right at the 140 area. And so if I hold above 145, I know that I am moving past these edges, and I'll be able to add to the position and then keep my eyes on these 149 areas to make sure that they open up for me versus close down for me. So if they open up, great. I can take profit at the first breakout because it will come back and retest. That's why we have old resistance, new support. Just like the guys who bought here, you said, hey, listen, time to take a little profit. Watch it. It's going to come back into these breakout areas. Great. That is the swing trader. As soon as it starts losing 137, The next area of critical support looks like 124. That's going to be a range, and it's going to be noisy. All right, let's talk about the intraday trader who looks at this and says, all right, where am I? I am underneath my moving averages, but I'm also above them depending on whatever time frame I look at. Essentially, what this chart is caught in a box. It's got support and it's got resistance. My favorite trades on earth are the trades of the box, because I can buy the low and I can see where my support is. So I have a limit order right in here. And if it loses the limit order, I give myself maybe $1.50. If it moves that limit order, I'm going to get out. If I see that it's broken, but I have a support edge that's a little bit lower than that, sometimes I will wait and hold on to the trade. It depends on how much risk I have at bay. Normally, though, if you can't hold this edge, what you're going to do is drop down into a really noisy patch that might end up sending you lower than you expect. So obey your stop and then reset your trade. Up here, you're going to sell. Everybody else is selling. If everybody else is selling, you sell too. Where do you want to buy? You want to start taking profit? Old support here on the edge that either turns to resistance or becomes support again. Because remember, two groups of people are trading. The groups of folks that are saying, oh, I want to buy this. Oh, this is great. And so it's going to come into here and, I'm just going to keep going. And then there's the person that goes, wait, this is a formation that's given me high, low, lower high by a few pennies, lower low, lower high. If it can come into this zone, I'm going to short it. And then I'm going to watch it head down further. If there are buyers and sellers on both sides of the mechanic, and you are seeing trades set up in that range, one person, either the buyer or the seller, has more income at their disposal, or one group is bigger than another, right? Just because there's one buyer and one seller, if you have 800 shares to sell, but I only have the money to buy 200 of those shares, you're going to use me up. I'm going to have my 200 shares that I've sold to you, and then you'll move on to the next person who's got the 600 shares, or somebody else who's got 200 shares, and so on and so forth. That's really how you can look at things and go, hey, there's another buyer and another seller. Yeah, but they have different pockets. Some of their pockets are very deep. And so you can sell to them, you and all your buddies can sell to them all day long, and they'll go, just keep bringing it. I'm going to buy all of it until you don't have anything left. And then I'm going to be able to be in charge of motion, and I'm going to start buying up even more. And so that really is how that moves. For Skyworks, it really is caught, and these are key areas to look at for frontline support. But as an intraday trader, all you want to do is go long at the support and close your trade at resistance, or go short at resistance and close your trade at support until it either gets up over 145 or gets below 139, tries to bounce back into 145 and doesn't. The warning sign is, am I going to close the week under that 5 simple moving average? People are going to try and buy it to get above it, but if they don't have the power, a short is going to open.
So we are at about 3 minutes remaining. Wondering if we can do a quick run through on AMD.
Ah, yes, Advanced Micro Devices.
And then we'll bring it to a close.
All right. Okay, so for Advanced Micro Devices, it looks just like the Qs, right? And so again, you want to look at the range, look at the speed that changes over time for this chart. If we do a drawing like this, right? This is where things look great for us. If we're out here and we do a drawing and we go, oh, okay, I can buy the July option of next year and it's going to give me XYZ, and instead it absolutely explodes even further from that area. So this is a great chart. Here's the thing, because it's just like the Qs, it's locked in a box. It's in a range. So for your trading strength, what you want to see is the breakout. Look at this, making higher lows, but still not really holding higher. It's got a ton of congestion here. So there are a lot of sellers trying to hold in this zone. The best play is going to be into the front line of support. You want to buy as it comes down here, knowing that if it comes down and it bounces again, traders are going to try and sell it up at 85. So that's going to be, again, the first place that you take profit. The moment that it loses this level, anytime it bounces, if it cannot get up over 81, it is going to stair step down into old resistance, new support. That's going to be it.
Can't be any simpler than that. Anne-Marie, thank you so much for taking us through all of this analysis. Wondering if you could tell us where folks can find more from you if they want to learn more from you.
If you want to learn more from me, you can come to thetradingbook.com. You can follow me on Twitter. You can follow me on StockTwits at Anne-Marie Trades. And if you just say, hey, can you share something with me on a chart, you can put it in the stream at StockTwits or Twitter, and I will answer you. I'm happy to help folks. Remember this, simple is always going to be the best route for you. So try something simple and don't overthink it. Just say, hey, where did everybody last buy? And where is everybody selling? And if you can't see where they're selling, don't assume it's going to the moon and you buy where you're at. Wait for the last time you saw all of them buying and get involved there. All right. Thank you so much for having me on. Super. Good luck with the rest of your day. And I will put a quick little snapshot together for the anatomy of a trade and how you want to look for your trends and that sort of thing. And I look forward to the next time we get to see each other.
Wonderful. Thank you so much, Anne-Marie.
My pleasure.
All right. So up next, let's take a look at the old notepad, Neil's notepad here. Ooh. All right. This one's going to be good, guys. Up next from Tradesmith, we've got Keith Kaplan to talk about profiting in any market. This is about timing entries and exits. So if Nick Shaheen didn't scare the crap out of you about how weird everything is right now, Keith might start off by scaring you a little bit. The markets are in a really weird place right now. How can we profit from this weirdness? How can we turn volatility into opportunity? Keith, great to have you. Welcome to the show.
Great to be here. Thank you, Neil. Can you hear me?
Yeah, I hear you perfectly. You have a great microphone. You sound good.
Wonderful. I'm going to go ahead and let's see here. I'm going to share PowerPoint. Oh, Zoom doesn't like that. System preferences. All right, give me 1 second here.
No problem. And while you're doing that, guys, just a reminder, you can get more from Anne-Marie Band at thetradingbook.com. You can also catch up with her during our 3-week intensive following today for that ongoing mentorship on technical analysis and just trading and investing in general. Hey, it looks like we got it up.
All right, we are up and running. So thank you so much, Neil. You want me to jump right in?
Jump right in.
All right, perfect. So we're going to cover how to profit in basically any market, and it's all about timing your entries and exits. We have free tools that we're going to give you. You do not need a credit card to get access to these free tools. So I hope you'll stay around just to see, just to get the free tools at least, and hopefully you'll learn a couple things as we go through. So back on February 27th, I was getting ready to hop on a plane as I do often, but I haven't been doing lately because of coronavirus, obviously. But I was getting ready to hop on a plane to head down to Florida and be with a group of my peers, some folks in the industry that I play in. I play in a publishing style industry, even though we have software that we give. It's a lot of newsletters in this industry, and I was going to meet with the best minds, and I was working on what my presentation would be for them. And the Thursday before I was to fly down there, I got these 7 alerts. And these alerts were generated by our system telling us that there was a bear market ahead. And the overall markets had typically fallen about, roughly 5 to 7% at the time. There was not that much coronavirus panic happening in the US. Florida, where I was about to fly to, had only had 1 reported case at the time. We had the outbreak in Washington. And it was a really weird time for me to get these signals. And I'll tell you, I've learned over and over as an investor to not trust your gut, but to trust signals and trust math. And that's exactly what these signals were. They helped me get out of the market. And after I got those alerts, the next day, which was Friday, February 28th, I pretty much sold all of my stocks and went into cash in both my 401k account as well as my personal investing accounts that I have. I would say if I had to put a number on it, it was probably 97% in cash. So after this, I fly down to Florida. I give my presentation on that Monday, and that Tuesday I was getting ready to fly to London. And when I gave that presentation on Monday and I told everybody that I sold most of my stocks on the Friday before, they all pretty much laughed at me. And they told me I was crazy. I was panicking too much. And just to give you perspective, at this time, you could go to any grocery store and get Purell, you could get Clorox wipes, anything you wanted, you could get back on February 28th when I sold my stocks. So I went to that conference. I got laughed at. I then went to London to do some work over in London. I had no idea that London was becoming one of the epicenters at the time, but I safely made it back home. And I locked in a lot of profits on my stocks before those stocks plummeted. So here's an example of Franco-Nevada. I bought in 2016 and I sold on February 28th. Right after I sold it, it ran back up, but then it ran back down during the coronavirus crash. I was able to have a 66% gain at that time and save myself from a lot of loss. And the markets, on average fell about 30% from the time I sold off until they hit their bottom. And at that time, when everybody was super complacent, this was around, I think March 23rd was when they bottomed. People were very they were getting out of stocks. They were going into cash at the point of when it bottomed, and they were just on the sidelines. At that point, I got this S&P 500 bull market signal ahead. And these are just simple alerts that are based on a lot of math and the algorithms in our system. And it told me that this bull market had triggered. It was on March 27th that it had triggered that we were going to enter a bull market. These are early warning systems to get us out of the market when there's bear markets and into the market when there's a bull market ahead. And so I went ahead and I went on a buying frenzy. And I can tell you that it was about a month I was out of stocks almost completely. And I slept great. And I slept great because I knew that my money was safe and I was just trusting the systems. I got a lot of text messages. It was really difficult to watch friends and family going through what they were going through. People ask me questions every single day. I try not to give out too much advice just because you never want to be wrong, especially with friends and family. But I told people what I had done. I had gone to cash at the end of February, and at the end of March, I was back into a really incredible buying frenzy. So a lot of people after the fact who laughed at me told me I was really brave, and they were really impressed with what I had done. And to me, it's like I almost feel like a fraud when people say that, and that's because I am definitely not your typical guru analyst. I don't have a major investing background. I actually have a systems and software architecture background. I've built many products. I probably built 100 different software platforms in over 20 years. I'm a big advocate of people doing things for themselves on their own, and investing falls right into that. So I'm not the type of person who's going to jump into a company, look at all the fundamentals, even though I understand that stuff. I'm a very strong investor now. But I don't jump in and look at all of those fundamentals, make a decision, and go buy a stock. I actually use a system that anybody could use, and it's perfect for people like myself, and hopefully for many of you watching, to be able to use. So what I've kind of learned in being in this industry, and this has really opened my eyes, it's that we're actually really, really good at picking stocks, but we are absolutely terrible at investing in those stocks in the right times. So that's buying and selling, and also knowing how much to buy when we buy a stock. So we're great. I tell people this all the time. It's not that you're bad at picking stocks. It's that you're bad at making decisions after you decide you want to buy a stock. And that's what we're here to help you solve. So our emotions make us terrible investors. Going with your gut makes you a terrible investor. There are 2 Nobel Prizes that have been awarded for these observations in behavioral finance. And they basically tell us 2 different things that are very, very important. The first one is that we're risk seeking when we are losing. Now, let me give you an example of this. I buy a stock. Let's say I buy Apple at $400 and I watch Apple go down, and it goes all the way down to $350. Never once when it was falling was I thinking I need to sell Apple and not lose any more money. What I was typically thinking, and this is probably happening to a lot of people out there, especially in 2020, is I better buy more Apple because it's going to come back. It has to come back. And I've got to make my money back. I've got to buy more until I make my money back. That is typically what people do when a stock is going down. And it's completely wrong. And what this really means is that we're looking for risk when that stock is falling, when we're losing. What is risk? I'm taking on more risk by buying a stock that I already see is trending down. And we want to follow trends. We want to understand that when a stock is falling, it's likely to keep on falling once it has that sort of confirmation. And when a stock is rising, it's likely to keep on rising once we have that confirmation. So the other big observation was that we are risk averse when we are winning. And the example of that would be I buy Apple at $400. It goes up to $420. And basically I've made 5%. I'm going to lock in those gains and I'm going to sell it. So I'm sure many, many people who are listening have heard themselves say, oh, the stock went up, I'm going to lock in my gains. And that is the worst thing you can do, especially when a stock makes a high. People think that just because a stock made a high, it can't possibly go higher. And that's totally not true. Again, you're following a trend. When something is winning, it has a much more likelihood that it's going to keep on winning. So you want to stay in those stocks that are winners. You want to cut stocks that are losers, but there's an optimal time to enter and exit a stock based on when it's winning and when it's losing. So what's the number one way to fix these problems of knowing when to buy, when to sell, or really it's when to sell? It's trailing stops. So let me just cover, in case there's investors of all backgrounds here, I just want to cover a couple common types of stops. And when I say stop, this is after I buy a stock, when do I exit that stock? So there's 2 types of stop orders that people typically put into the market. And you can do this to say, I want to sell a stock when it rises a certain amount of dollars or it falls a certain amount of dollars. So let's say I buy a stock for $100 and I want to prevent it from falling too much. I want to say, sell this stock when it hits $80 or less. So I could put in a stop order into my brokerage account and say, sell the stock when it hits $80. And I can do that one of 2 ways. I can do it by what's called a market order or a limit order. But here's the thing. A market order means that once $80 is triggered, it's going to sell the stock as soon as it can for whatever amount of money is being offered for that stock on the exchange. So let's say we have a flash crash and I say, I want to sell this stock if it falls below $80, and it not only hits $80, but it plummets. And the systems don't get enough of an opportunity to sell that stock at $80. You're going to get stuck with whatever price the market is offering for that stock at that time. It could be $50, who knows? But if you said with a limit order, I want to sell this once it hits $80 and I'm not going to accept anything below $80, the brokerage account will try to get you $80 or more. It might get you 81, might get you 80. But if that stock plummets, if you have let's say you have a flash crash, which doesn't happen often, but it happens, and that stock plummets but comes right back up, it's going to try to sell it at $80 or better. You're not going to have any sort of risk like you would with a market order of the stock falling way too much. And, does that happen often? Not really. I mean, typically you can get away with market orders, but you get a lot more control if you put in a specific amount of money you want to sell at. But here's the thing. I I think any type of stop but a trailing stop is a terrible thing. And I'll tell you why. A trailing stop loss is a percentage that trails the stock that you buy and determines when to sell it. And it's perfect for locking in profits. And it's also perfect for preventing you from losing too much money on a stock. The way a trailing stop percentage works, and the typical percent that people recommend is 25%. The way it works is that when you buy a stock, let's say you buy a stock for $100, every time that stock rises to a new high, let's say it goes to $110, then $120, then $150, you have a trailing stop loss that will be enacted once the stock falls that percentage amount from a high. So if I buy a stock at $100 and I put in a 25% trailing stop, and that stock falls to $75, I've now hit my stop and it's going to sell. But let's say that stock never fell let's say it never fell 25% or more and it rose. If that stock gets to $150, the stop would adjust to be 25% below 150, but it kept going up. It hit $200. Now the trailing stop is going to be $150 because it keeps trailing you as you make new highs. And our system makes this so easy to track, and it does all the work for you. But I want to make sure you understand this concept. So if I hit $200 and I have a 25% trailing stop associated with that, if that stock falls below $150, it's going to sell. And I just locked in $50 of profit. And you're probably thinking to yourself, I would have rather had $100 in profit. But you also probably, if you weren't using the system, would have sold at $105 or $110, because as humans, we take risk off the table and we typically sell stocks way too early when they're winning. I always say, don't double down on your losers. Don't buy double as much stock as you have when a stock is dropping, thinking it's going to come back. But I always say, double down on your winners. If a stock is winning, it has a much higher likelihood to keep winning. So ride that stock up and buy more of it. So here's the thing. I made a trade back in 2016 towards the end. This was before I started working for Tradesmith in late 2017. I bought AMD, Advanced Micro Devices. It was a very volatile stock. It moved around a lot. And I have so many examples of these from myself, from peers in our industry, as well as customers of ours that have come to us looking for help when they have, especially when they have millions of dollars in their portfolios. It's unbelievable how buying the same stock a different way can make you so much more money. So here's my example. I personally bought AMD back in the end of 2016. And right after I bought it, went down a little bit, went up a little bit, went down a little bit, went up a little bit, went down a little bit. I panicked and I sold it for a 0.7% gain. So let's say I put $10,000 into AMD at that time. I would have made $70 in a period of a few weeks, which isn't bad. And most people would say to themselves, well, I didn't lose money. And that's good enough for me. But let's just say I put a 25% trailing stop. So if you look at this chart, and hopefully you can see my mouse tracing, every time we make a high, the trailing stop is set at a fixed price until we make a new high. It gets set at a fixed price until we make a new high and so forth. But over here, you can see about 6 months after I bought, the stock fell more than 25%. So I would have triggered a 25% trailing stop sell. So originally I made 0.7%, but had I held on to this stock for the 6 months and let the trailing stop get me out, I would have sold about 6 months later for a 48% gain. Let me put this in perspective for you. If I invested $10,000, my original trade, I would have made $70. My secondary trade, where I just let the system do all the work and tell me when to get out, I would have made almost $5,000. It is quite a difference to go from $70 to $5,000. And I have so many charts that prove that this technique works over and over and over. And it's because it goes way back to those human biases that we have. Our emotions are terrible decision makers in everything we do in life. You know, it's just like when you're a couple, you have your partner, and you go ahead and you make a decision and you get in a fight over it. The things that you say in a fight are way, way different than what you would say in normal day-to-day. And a lot of times you don't mean what you say in a fight. And the same thing happens with our emotions when we're trading. A lot of times we don't mean to sell that stock early, or we don't mean to ride that stock late. Our goal when we buy a stock is to make a profit. And here I'm showing you how going with my gut, I didn't make that much of a profit, but using a system, I made a great profit. And this happens in trade over trade over trade, just because we're removing the emotions of making an investment compared to how we normally would invest. And remember, I'm going to give you free access to the software that does this and makes it super easy for you to track trailing stops. So let's look at Netflix. Netflix, since it IPO'd over about close to 20 years, fell 25% or more 32 times since it IPO'd. So when I was telling you that we use a generic 25% trailing stop, and that's kind of an industry standard, I'm now going to tell you that that generic 25% trailing stop is actually really bad for Netflix. And that's because Netflix is a roller coaster of a stock. It's a tech stock. It has a lot more volatility and movement built into it. And because of that movement, you have to sort of be willing to suffer a little bit more loss, a little bit more movement to get the benefit of investing in a riskier stock like Netflix compared to a stock like Johnson & Johnson. Johnson & Johnson over about 40 years has only fallen 25% or more about 5 times since it went public. So here's the thing. I would actually argue with Johnson & Johnson, by the time you hit 25% for a trailing stop, you've probably fallen too much and you should have had a much smaller trailing stop. So Netflix, it would have stopped out 32 different times, and Johnson & Johnson over double the period of time would have stopped out only 5 times since they went public. So there has to be a better way, and I'm leading to the way that we built many, many years ago that's algorithmic based, and it's based off of volatility. It looks at historical movement of a stock, and it looks at the most recent movement of a stock. And inside this formula, it figures out what it needs to do to tell you how much movement you should expect that stock to make. So let me just illustrate this with a couple different percents. And we sometimes call this the secret number. We call it the most important number in finance. And that is because every single stock, mutual fund, index fund, ETF, whatever you name, it has a different set of movement, and it is not the same as the stock next to it or the instrument next to it. So why would we buy Johnson & Johnson and expect it to move the same amount as Tesla, which is highly volatile? It moves around a lot. So the higher your VQ number, your volatility quotient, the higher this number, the more volatile and the more risky that stock is. I'm not saying don't buy a stock that has a lot of risk. I'm saying know exactly what you're getting into. Because when you buy Tesla, overnight you could feel like you've become rich, and then the next night you can feel like you've gone broke. So you have to understand what you're buying before you buy it. And you have to understand when is the right time to exit. If a stock doesn't fall enough from its high, it means that it has a lot more room to run. If it doesn't hit that VQ percent, it has more room to run. If it hits that VQ percent, it's now fallen enough that we say that the stock has gone against you and it's time to sell it. This VQ is pivotal in investing. It helps you determine exactly when to get out, and it helps you know how risky a stock is when you're about to enter it. So if I apply the smart, we call it a smart trailing stop because it's not generic. It's not this 25%. If I apply that to my AMD trade, I would still be an AMD. We generated this chart at the end of last year. And, I'd hate to regenerate it because AMD is probably doing much better, and I'd probably be out a lot more money. But basically what this is saying, and the VQ of AMD at the time was probably about 43% when I bought it. So you can see that we have to expect AMD to sort of move around a lot more than something like Johnson & Johnson that is a much less risky stock. And we have to give it room to breathe. And because it never fell more than about 43% from its high, we would stay in it. And every time you see these lines getting closer to stock price to the trailing stop loss, it basically is telling you that we're getting close to triggering a trailing stop, and you're probably going to have to get out. However, we just trust the math and we let it ride. And you can see in this case that the stock recovered, stayed within its normal expected volatility for that stock, and it went on to make a greater return. So if I asked you what's better, a 0.7%, a 48%, or almost 470%, you're probably going to say you'd rather have 470%. It's a massive gain on that $10,000 that you would have invested in AMD over the last 4 years. So here's the thing. We figured out when to sell a stock, and everybody kept saying to us, I want to know when the right time is to buy a stock or even get back into a stock after I've sold it. So I'm a huge Apple fan personally, and I used to just do what we call buy and hold of Apple. I bought it once many, many years ago, and I just held on to it. And every time it lost money, I would say, oh, that stinks. But it's going to come back because I love Apple. But really, this system that I'm about to show you would have allowed me to get out of Apple, wait for it to get confirmation that it's going back up, get back into Apple, get out of Apple, get back in, and I could have amplified my gains. So we took our VQ and we built it into a very, very easy to use system that we call the stock state indicator, or SSI for short. When it's red, sell. When it's green, buy. It's just like a stoplight. When the stock turns yellow, there's just some caution, watch it. It's getting closer to a stop loss. It might be time to exit soon if red comes. But if it stays in the yellow zone or goes back into what we call the green zone, that means it's a great time to either buy more or just ride it until it hits red. So it's super simple. If a stock is red, I don't buy it. And if I own it, I sell it. If a stock is green, that's time to buy. And if I already own it, I stay in it till it turns red, or I could even buy more, but I stay in it till it turns red and I keep that discipline. So let me show you an example on a really boring stock. I'm not a big fan of Domino's Pizza, but I am a big fan of their business model. They make a lot of money, and you can see that from 2010 all the way through about midway 2017. We would have triggered green in 2010, triggered red, and gotten out with about a 1,770% gain in about 7 years. That is a killer gain on any stock, no matter how you look at it. But here's the thing. As emotional beings, all the way back down here, about halfway through 2010, we probably would have gotten out and we would have barely made any money. And if we stayed in, we would have, chugged along. We probably would have wanted to get out in 2012, 2014, and so forth. But I want you to focus on this area. This area was a crazy time. Bull market had run for about 6.5 years. Investors were starting to panic. The S&P was falling, the Dow was falling, the markets were falling apart, and so was Domino's. But if you look really closely, Domino's had a high in April of that year, and it had this low in the beginning of May of that year, but that low never fell more than 18.98%, which was its current VQ at the time. So the system kept you in. We dipped into what we call the yellow zone. We dipped up into the green zone, back into the yellow, back up into the green, and we kept going and going for success. And this got us a 1,770% gain in that period of time. And that's designed to show you the system works. So here's a couple more charts that just show you the SSI system. Macy's, a retail stock. If you did buy and hold back in 2009 and 11 years in 2020, we're still holding that stock, you would have lost 30%. But had you used the SSI system to get in and out when it's green versus red, you would have turned that 10 plus year buy and hold loss into a gain of 256%. And you would have been out of the markets at the points where Macy's was doing the worst. You would have been in cash. You could have invested it somewhere else. Same thing with Wendy's. Wendy's is a great story because as a buy and hold investor, you would have still made 120% over about 4 years time period. But during the coronavirus, Macy's crashed, and it crashed really hard, but then it turned green right after we had the confirmation of the uptrend. You could have more than doubled your money in Wendy's. If you look at Colfax, you could have tripled your money using the SSI system just simply by getting in and getting out when it's green versus red. And you can use this with options and really do some tremendous things with options to amplify these gains as well. Same thing with Enphase Energy. This is an extremely volatile stock. Energy can be nuts, especially when these companies aren't profitable. You see Enphase go up, we take a profit, they go down, we're out of the market, they go back up, we take a profit, and so forth. And we do that by following the system. And the more volatile a stock is, the more you have to deal with it when you're invested in it. So here's the thing. We know when to buy a stock, we know when to sell a stock, but how much should you buy? No two stocks are equal. Remember, the VQ is different for every single stock compared to another stock out there. And if they ever overlap and become the same, it's going to be for a little bit of period of time because no two instruments move the same way. It just doesn't happen. So if I look at Apple, these are current VQs. The VQs I showed you earlier were a little bit out of date. Current VQ for Apple is a little bit more than, it's about 23.5%. and Tesla is just over 50%. So that means Tesla is more than twice as volatile as Apple. It gives you more heart attacks than Apple would give you, but there's a way to invest in both. And I never tell people don't invest in risky stocks. I tell them, make sure you blend your portfolio, low risk, medium risk, high risk stocks, whether you're trading or investing, doing options, whatever it is, you want to blend that portfolio, but there's a right way and a wrong way to blend it. I want you to blend it based on risk. Because Apple is of lower risk, it means that you want to put way more money into Apple. So if I had $10,000 to invest, I want to put $6,800 into Apple and about $3,200 into Tesla, applying $10,000 using the VQs of both of those stocks. And our system has something called a position size calculator, which you'll get access to for free just for listening to this broadcast, which will help you know exactly how much money to put in each stock, especially compared to what you invest in your portfolio. And this is very, very important when investing. You never want to put too much money into a risky stock. You never want to put too little into a low risk stock. Low risk stocks can outperform high risk stocks. It happens all the time. But high risk stocks give you those exciting stories and those big run-ups that you can capture gains on. So know exactly how much you're investing into these stocks and try to blend your investments to balance out the risk across your portfolio. There's one more thing I want to give you for free. That is what we call Tradesmith Trends. We send out this email every single week to our customers of Tradesmith Trends. And this email is chock full of all sorts of information. It comes out on Mondays. It has the bullish and bearish signals that I showed you. So you would get access to the same signals that help me invest and help a lot of our customers invest. And this is our market health, and we're covering 11 different indices across the world in this email. We also show you different stocks that our algorithms have flagged as potential winners. These stocks have to be in an uptrend, they have to be green, and then we apply some other mathematics and algorithms to them to determine if they are the stocks that we believe will take the biggest leaps. And those come out in this email, and you're going to get that for free. And the other thing that it does is it aggregates the news that we write from our Justice Clark Lytle, who is our chief research officer. We aggregate the news that we write and other news around the markets as well, and put it all into one little email that helps you to understand what's happening in the markets and how you should invest. So if you would like free access to our products, please go to freetradesmith.com. You do not need a credit card. All you need is a name and an email address, and we will send you access to both Trade Stops and Tradesmith Trends. And that's all I have. Really appreciate everybody's time.
I was muted. You nailed the timing perfectly, Keith. Very impressive. I want to say chat is very happy about the free stuff. And I'll say as a marketer, kudos for putting free right in the domain.
Thank you.
Good thinking. Guys, and so yeah, we dropped the URL there in chat. Make sure you go ahead and get over to that right now before you forget. So go ahead and copy and paste that into your URL bar and grab some of this free stuff. I got to say that newsletter was particularly attractive, looked very easy to understand. I know a lot of the stuff that we looked at today can be a little overwhelming. So for a lot of you folks that just want simple, just tell me what the data is saying and give it to me in a simple way. That newsletter looks like a great start. So guys, go ahead and get over there and check that out. Any questions for Keith? I know that we're on a little bit of a delay. I think we had, so one question really quick, Keith. If someone really wants to focus on options, how can they benefit from this system?
Okay, so with option, that's a great question. So we definitely track options in our system. We track, we can help you with trailing stop losses on the options. That's a great thing to do. So I'm a personal big fan of options. I'm also a long-term investor. The reason I like options is because they sort of give me some excitement and some energy between my trades. So for instance, I bought Visa back in March. Well, Visa has just been going up. It's kind of boring to wait for an alert to come on my phone to tell me to sell Visa. And I'm really happy when I don't get those alerts that tell me to sell, because it means it's still in an uptrend, it's doing great. So I will tend to buy options on stocks that I believe are going to outperform the markets based on when they turn green in our systems. And what I'll do is I'll put that option right into our system. And actually it'll, one thing I should have mentioned is if you synchronize your brokerage account like Fidelity, TD Ameritrade, whatever you have with our system, it'll automatically get the trades. It won't execute any trades, but it'll automatically get the trades that you've made, and it can set up alerts for you automatically. So you don't even have to do anything, and you don't have to work much in the system if you choose not to. But with options, they can come down into our system if you're synchronizing your brokerage account, or you can put them in yourself. And the best way to use our system with options is to buy a call when the stock is green in our system, or buy a put when a stock is red in our system, because that means it's trending down and you can make money off the put. And then use our system to have a trailing stop loss. So that way, if the option you bought goes against you, you can get out of that option just like you would a stock, but you get an alert. You don't have to, log in constantly and figure that out. So that's typically how people use our system with options.
Mm-hmm. So it sounds like a very simple system. A couple of people in chat are trying to sign up and having a little bit of difficulty, guys. I'm sure it's something that will resolve itself in the short term. It's probably the link that we gave you. Shelby or whoever is posting in the chat, can you just post that URL again? Otherwise, is there another website that folks can go to? Can they just go to tradesmith.com?
You can go to tradesmith.com. We have some free trials on tradesmith.com that you can sign up for. You will not get trends on there. So what I would say is, when we get off of this, I'm going to ping my team, make sure free tradesmith.com is working. We'll get it fixed. Definitely write that down and check it out. Maybe in a few hours to get access. You can also sign up for anything you want on a website. We love when people get free trials, because we know our products are easy to use. They enjoy them, and they usually become a customer.
Wonderful. All right, guys. So like you said, write it down so you have it. We'll remind everyone to make sure they get access to everything. Keith, thank you so much for your time and taking us through your awesome platform.
You got it. Thank you, Neil. Thanks, everybody.
Have a good weekend, man. All right. Do I have Hot Stocks Luke?
You got him, Neil. I'm here.
Oh my God, there he is.
You can stop looking.
All right, guys, we are at the part of the day where Luke and I do the best that we can.
A final joke?
Yeah, go ahead.
All right, Neil, let me ask you this. What is the strongest day of the week? Saturday and Sunday, because the rest are weekdays. All right. Now I need to get some laughter on this soundboard.
You're just like gradually pissing off the people in chat. One joke.
No, the people in chat love the jokes. It's an added bonus. We didn't even advertise the jokes as part of the day. It was like a free bonus that came with it. Okay.
Okay. So guys, about Tradesmith, they're gonna follow up with you guys so you can access the platform. You can access all the free stuff he talked about. Sounds like it was just a problem with that URL. So just stay put. It's okay. We're gonna get it to you. But in the meantime, if you guys have been with us all day, let's get some of your questions, some things you want some clarity on. Jean, I know, wanted us to talk about candlesticks and how to read them, which I'm happy to talk about. But if you guys have anything specific from the lessons today, Luke and I can go over them. I have a nice graphic that I like to go to. Let's see, candlestick. That I'm going to share on my screen. I'm sorry?
You should have had that pulled up ahead of time. I think everybody would have appreciated that.
So can you believe that it's dad jokes and sass is pretty much all he's here for. All right. I'm going to share my screen. All right. You guys should see this Google image, right? Luke, do you see this?
Yep. I see it, Neil.
All right. So with candlesticks, the most basic is just green and red. You can also have hollow and filled, but I think for the sake of keeping things simple, try to set your charts just for filled. So you're just seeing the green and red. Now, when the candle itself is green, that means that the close was higher than the open. So the open is actually the lower part, and then the close is the higher part. All right. So this is the open and the close. We call this the body. Now the wicks, or these lines, are that are what happened in between the open and the close. So this is as high as the stock was sold for during that period within the candle. So if you're looking at a weekly increment chart, this is the beginning of the week, this is the end of the week, and then this is like sometime in between those 2 dates. Now, when you get to the red ones, this is where it can get a little bit tricky. The open is actually on the top of the candle because it opens higher than it eventually closed. So if you're looking at a weekly candle, this is the whole week. And then this is as high as it got and as low as it got or sold for during that period. The same thing applies on monthly increments all the way down to seconds. So hopefully that helps, John. Let me scroll down in chats.
Yeah, dailies, seconds, minutes. People really like these candles because it's very clear to see the highest that the stock was and the lowest that the stock was. I think that's why a majority of more intermediate and advanced traders and investors prefer candles versus the line chart, because the line chart is smoothing it out over time. You can't see the spikes higher and lower. And if you're trying to capture some volatility, some trading opportunities, having those highs and lows on there is critical.
Yeah, and then actually here's a demonstration of that. So if you're looking at just a line chart and you see like a point in time, you don't have enough information to try to predict what will happen next. So if we're looking at these candles, if we see a large green candle, we know that it closed higher than it opened. So it's going up. The trend is upward. If we were just looking at a regular line chart, we wouldn't really know what happened during that period. But if we see this bullish candle, this green candle, we know that there's a higher likelihood that the next price point is actually going to be higher than the previous close. So that's just a demonstration. You're getting more information at each increment in time.
Yep. And there's a question about whether or not you can use these for options. The answer is you can. You can plot options on a candle chart.
Yep, absolutely. Yeah. And actually, that's a really interesting concept. When you see patterns or you see trends is probably a better way to put it. When you see trends on the price action of a chart, so if you're seeing, like, just for example, I'm just using a random image. If this is the price of a stock over time, markets are fractal, meaning that trends that you see over a short period of time will also appear over a much longer period of time. And that's just how it works. And then when you take this and you want to plot the price of an option over time, a lot of times you'll see similarities, and the same trends and patterns have the same significance, whether you're looking at the price of the option or the price of the underlying or the stock itself. Also for RSI, if you remember for Matt Maley's presentation, he was using RSI a lot. So let me just pull over a chart here. So if you look down here on my chart, you can see RSI. This is the relative strength index. When you see trends, higher highs and higher lows going up, those are also indicative of trends in the price action and are often foreshadowing. So you see these patterns across the board. Mm-hmm. Okay, and then do you include wicks when plotting? Yes. I would say the answer to most of these questions is going to be it depends. But yes, I do. So like, for example, right here, I've drawn two bullish pendants on a stock NIO. This is a real example from two trades that I previously made. This first bull pendant, I started watching it like right about here, and I was looking for three high points coming off of this sort of pull shape. And at this point, I did not use this wick because I started before that happened, and I didn't want to redraw it because that would change my target. But at any rate, here I did use this lower wick to sort of guide this. But then after I got out of that trade, it took a profit when it hit my price target here, this green line. I drew a bigger bullish pendant, and you can see here that I did use the wick for that, and then it did break out, and I was able to take a profit on the upside there. It's a little line I didn't understand. Yeah, the little line is just the high and low in between the open and close. Guys, got any more questions?
What about the competition, Neil? We got a question about the competition, the biggest stock trading competition on the internet. How does that work? How do people join? How is it judged?
All right, guys. So we are getting a lot of questions about this. This is the first time we are doing this, and it's going to be big. It's going to be up to $10,000, maybe $15,000 in cash prizes. It's going to be nonstop education. It is going to have a little competitive side to it, but if you're worried about being competitive, don't get too caught up in that. We're really here just to get you trading on a paper trading platform so that you can discover what your strengths and weaknesses are, so that you can get the right type of mentorship. That's why we're doing it. Everything else is just icing. If you do really well, if you 10x your paper trading account, yes, you're going to win some prizes. So what this is a paper trading competition. And if you don't know, paper trading means that it's like fantasy trading, simulated trading. We're going to get you on a platform with our partners at stocktrack.com. Details will come to you after today via email with instructions on how to sign up if you did register for this. And if you haven't registered, make sure you do now. By going up to buy now in the top right and getting the bootcamp bundle. This is the 3-week intensive. So you're going to get that paper trading competition. And then you're also going to get the mentorship sessions that are going to be a minimum of 3 video-based sessions each week during this 3-week intensive based on what's actually going on in the competition. Yes, we're going to target things like options. We're going to talk about swing trading. We're going to talk about fundamentals, current trends, macro, all that kind of stuff. But we're going to do those within the context of what you guys are doing in the competition. So it does not end today. Today is only the beginning.
And this idea actually came out of feedback from the previous few boot camps that we've done, which was, okay, the day is great, but the information is dense, right? I want to, be able to watch the videos again, take them home with me. So you get that in the bundle. And then 2, I need this on an ongoing basis. So I can get a little bit better as it goes.
Absolutely right. And then another thing that we didn't mention is this comes with a chat room. We want you guys to be learning from each other, talking with each other. We want you guys to be a tight-knit little group of boot campers so that you guys can communicate and elevate each other, because the truth is that when you trade together, when you invest together, you succeed. So make sure that you guys are hopping into the Discord. We're using Discord as our chat platform. We're going to send you instructions on how to get in there. So make sure that you're in there and you're actively communicating, because that's where we'll derive the content for our mentorship sessions.
Yeah. And if you don't want to participate in the competition, but you still want the mentorship, which again, I think is the really important part. You don't have to participate in the competition. That said, I believe, Neil, the grand prize is a visit to Benzinga HQ once we get this whole coronavirus thing worked out. A day to hang out with us. I got tons more jokes, guys.
No. Chat suggested a better prize, which is a used Toyota. So the highest returns, whoever makes the most money in the paper trading competition will get a used Toyota from Hot Stocks Lou Jacoby.
There we go. And that's a Benzinga bundle is what you want. So you're going to click on that button on Hey Summit. It says purchase replays. Scroll to the bottom. Then you want the bundle.
Can we have the chat box next to the video? Oh, you mean if you got the video, can you have the chat? Is that what you mean, Jung? No, we can send a transcript of the chat though if you want that. No, the private tutoring stuff is not just for the paper trading. That's just all part of the bundle. You get the bundle. You can participate in the competition. We encourage you to do so. But if that's not something you have the desire nor time to do, you can still come to the mentorship sessions and have your questions asked. Not unlike what we did with Anne-Marie today, where people were talking about their specific trades that they're in, whether they're options or simple stock trades, and getting an analysis, getting feedback, or even just peace of mind. +1 for the jokes. Priest with a bad battery. All right, guys. I think that pretty much concludes the day. Is there anything else that Luke or I can clear up for you in terms of, trading stocks, trading options?
Well, I think one thing for sure, Neil, is we should spin the wheel again. That was a lot of fun.
Okay, so this is where we left off with the wheel. Hold on. Did you see that? Let's get it down here. So when I type, I can. Okay, this is where we left off with the wheel.
That's an aggressive name.
Yep. The contest to win Benzinga stuff is part of that's the paper trading competition. So the Wheel of Destiny here has left off with I have to do a TikTok dance, which is fine, but I would like to redeem myself and respin, because the other options, guys, are we're going to gift 5 subscriptions to Stock Picks with Matt Maley, or 5 options, Benzinga option subscriptions with Nick Shaheen, or 5 Benzinga breakout subscriptions with Gianni DePoce. So we'll go ahead and give it another spin. What do you guys think?
All right, roll it.
So it looks like it's Stock Picks. I'm out of it is a lot of information. That's why you guys got to buy the video recording, guys. Yeah, we got this. We got the subs for you. So what we'll do is randomly select from some folks that attended today. You have to have attended. We're not going to give it to any schmoes that didn't show up today. So once we have the list of attendees today, we will randomly select 5 people and send those out. And yes, they are awesome.
And how are people going to see you do that WAP dance, Neil, on TikTok?
Wasn't planning on dancing to WAP.
Got it. Okay.
But now that you mention it, I thought I don't have to do it.
Oh, no, you're doing it.
Let me know in chat. Do you guys, what would you rather have, guys? Would you rather have me do the TikTok dance or do or gift you guys 5 subs to Benzinga Stock Picks?
They're not mutually exclusive. We can do both. We're not giving up the dance.
Come on, guys. But how do I know? We're able to see if you logged in or not. It doesn't go by your YouTube name. They were here all day. Gift. They want the gifts. They don't want the TikTok dance. Now so the 15-second delay has passed. Gift. TikTok dance. Okay.
Yep, see?
Okay. All right. Neil, we should do the WAP, even in our own
Wings
teams.
and pizza, baby. I'm having a WAP night. Wings and pizza.
Okay, guys. So, all right. So we're gonna gift the subs, and I will do a TikTok dance on the official Benzinga TikTok, which means you gotta follow us. You gotta go on TikTok and follow us, and it will be to the song by Cardi B, WAP.
Wings and pizza. I'm having a wings and pizza night.
Wings and that's what that stands for. All right. This has been the Benzinga Boot Camp. Thank you so much for spending your time with us. I wish I had some sad music to play as we
wait. I do. Hold on. Did you hear that? I love my soundboard.
What are my thoughts on the NIO offering? Neo, not looking good for Neo. I took my profits and I'm out. I'm not long-term Neo, Gary. I'll be completely honest.
So WAP, weighted average price. Yeah,
but
it's a good correction, Joe B.
Thank you guys so much for being here with us.
Yeah, this was awesome, guys. It was a blast. I can't wait to see you all in our 3 per week continuing mentorship program. So make sure you're signed up for that if you're not. I'll make sure to have some jokes ready. We'll play Neil's dance before each session. And I hope that everybody has an awesome weekend and a great trading week ahead.
Couldn't have said it better myself. Thanks, everyone.